Good morning. It is 9 a.m. on Friday, February 25th. This is Yahoo Finance Live. I'm Julie Hyman. That right there is Brian Sazi as we continue to navigate a very volatile market and try to follow all of the developing headlines that are coming to us out of Ukraine and Russia. We've got futures that are higher at this moment here, and we had a turnaround overnight. By the way, speaking of headlines, we also had economic data coming to us in the last half hour, including personal income, personal spending, and probably most so-called PCE deflator, which is the Fed's preferred measure of inflation. That coming in year over year with a 6.1% increase at the core, 0.6% month over month. That year over year increase is the biggest one since 1982. And by the way, the year over year increase also coming in 0.1% higher than estimated. Meantime, tougher sanctions, but maybe not tough enough. The Ukrainian capital of Kyiv is under bombardment from Russian forces, even after a ramping up of sanctions from the West. We'll have the latest and the market implications. Etsy unmasked. The pandemic effect for the e-commerce platform has faded, but the value of merchandise sold via Etsy still rose by 17% last quarter. CEO Josh Silverman will join us with his outlook. And Dorsey from the block. In its first report since Jack Dorsey resigned his other CEO post, the company formerly known as Square reassured investors with its 2022 forecast. We will have details on that as well as we are watching everything that is going on here this morning. We want to check in with our Jennifer Schonberger, who's been following all of the developments. And Jen, it is not an easy task because getting reports about potential more sanctions on individuals, including Vladimir Putin. We're also getting reports about potential being openness to talks. So where do you want to begin?
Good morning, Julie. Yeah, where do we start? Well, I will tell you that Russian forces moved by air and land to attack Ukraine's capital, Kyiv, Friday morning, as the administration warned that the capital could soon fall. President Biden commencing a meeting right now, actually, with NATO heads of state virtually in the Situation Room to discuss the situation in and around Ukraine. Kyiv was hit by a series of Russian airstrikes that shook the city center through the morning after Russian President Vladimir Putin ordered an all-out assault on Ukraine, pushing people to flee for shelter in subways and basements. Russia's assault has triggered a surge of calls from Western officials to completely cut Russia off from the global financial system. The European Union expected to sign off on sanctions today that will cut 70% of Russia's banking system off from international financial markets and place limits on the amount of money Russian elites can hold in the EU. The FT reporting this morning that they could be preparing to freeze assets of Putin and Lavrov. Now, the U.S. slapped a second set of new sanctions on Russia Thursday, cutting off Russia's largest bank from the U.S. financial system. The U.S. has now frozen out every single Russian bank from the U.S., together accounting for about $1 trillion in assets. New export controls are also cutting off more than half of Russia's high-tech imports. Biden says these sanctions are the equivalent consequence of cutting off SWIFT, which was not used, but Biden says that option is always on the table, that Europeans right now prefer not to use that trigger. As well, sanctioning Putin remains on the table, the president says. The president not scheduled to appear on camera today, but given that he is meeting right now with NATO heads of state, this is a fluid situation. We'll see how things progress as the day goes on. Julie?
Yes, we will indeed. Thanks so much, Jen. And we want to talk about some of the most important assets that you have to be watching right now. For that, I want to take you inside the Yahoo Finance Interactive. And I want to start with U.S. futures and the reactiveness that we have seen in the futures here. Overnight, obviously, we saw a decline after that big turnaround that we saw during yesterday's session, which was pretty remarkable. And on the perception that the sanctions were not going to dissuade Putin and perhaps maybe not cause as much disruption to global markets. We're going to talk about the read through for all of this in just a moment. But again, we are trying to see how people react to all of these sort of conflicting headlines. If there are headlines on the one hand that there is openness on the part of the Russians to talks in Minsk, and then on the other hand, that the EU is potentially considering sanctions on Putin and Lavrov specifically, what does all of that equal when all is said and done? Well, obviously, that is quite confusing. I also want to take a look at the futures from an 11-day perspective, because that's when all of this began to sort of ramp up here. And you can see just the extraordinary volatility that we have seen in markets, and obviously the big drop when the invasion actually happened. So that's what I have been watching here. Saz, I know you've been watching what's been going on in the commodity markets as well, and we're going to switch on over and take a look at that market.
Yeah, all morning long, Julie, locked and loaded on all things oil prices. Yesterday, Brent crude oil hit $105 a barrel. It has since come down. You can see there on the screen about $97 here, towards the lows of the session so far. But reading a good note from our friend over at Goldman Sachs, Jeff Curry, who we talked to earlier in the week, he's noting that his base case is that commodity supply disruptions are unlikely. That's good, but he's also noting that the uncertainty regarding the situation between Russia and Ukraine, that we could see a potential supply shock. Curry calling out the potential for $125 a barrel oil prices here in the near term really is quite striking here. Again, Brent was just at 105 yesterday, back down to 97. A little more on this now in his story on Yahoo Finance's homepage, but still $125 a barrel here. That could really go a long way to sending gas prices in this country, in the U.S., up even higher than they are right now. And that is the last thing I think consumers want to see in this inflationary environment.
Yeah, I mean, to be clear, President Biden was very firm on this point in his comments yesterday, that he is very cognizant of gasoline prices, does not want to allow them to rise too much, and therefore would authorize releases to the Strategic Petroleum Reserve in order to try to exert some downward pressure on those prices. There's one more thing that I want to check on, folks, as we are talking about all of these many things that we are watching, and that has to do with Russian markets and kind of the feed through to the perception of these sanctions and the effect of them. Just trying to call up what's going on with Russia on the Yahoo Finance Interactive. Maybe we have the chart of it. But in any case, we saw a big surge in Russian stocks overnight, which again, sort of a relief being expressed here within the Russian markets that the sanctions were not more severe, and sort of ironically enriching the very oligarchs that sanctions are meant to target, because they also hold Russian stocks. So on that note, let's talk more about the implications of the sanctions and all of these issues. I want to bring in Karen Alter, Northwestern Professor of International Relations and Professor of Political Science and Law, co-director of the Research Group on Global Capitalism and Law as well, and Julian Emanuel, a Senior Managing Director of Equity Derivatives and Quantitative Strategy at Evercore ISI. Thank you both for being here this morning. Karen, I want to start with you as we try to figure out what the implications of these sanctions are going to be. I saw something earlier that it's kind of like trying to take the meat away from a vegan who's at a steakhouse. In other words, Russia's already fairly independent on this front. What's your read through for all of this?
Well, Russia as a country, as its like state budget, has insulated itself from sanctions. Something that I read was that the budget is designed to function at $44 a barrel in oil. So in that sense, it won't be a hit on the everyday Russians, but that's not really the strategy. The strategy is to really target Putin's inner circle and the people that really matter. Let me step back a second. If the SWIFT sanctions hit in, that would really hit anyone who has any international connections. So that would go to a deeper everyday person level. But the overall targeting strategy is to target Putin's friends, to try to put more pressure on Putin personally. I don't think Putin himself is deterrable. So you just have to try to get his support circle to try to change their perspective.
Julian, we saw a major market reversal yesterday midday. We're seeing some of that strength carry on over today. Is this a sucker's rally we're seeing in these markets here?
We don't think it's a sucker's rally, Brian. What this is a bottoming process. It's going to be volatile for weeks to come in all likelihood. So we're telling people that you can start deploying a little bit of capital, but be careful about it, be patient about it, because we're going to have an enormous. If you think about the last 6 hours, at 4 in the morning, the market, the S&Ps were down 50, and we were worried about the imminent pictures of troops coming into Kyiv. And here we are right now, and there's talks about more talks. And, S&Ps were up 30 or 40 not too long ago. So what it is a time, because of the market volatility, there's a lot of emotion in the markets. And this is one of these times, as an investor, you don't want to get caught up in the moment-to-moment fluctuations in the headlines and really focus on the bigger picture, which we think is eventually higher stock prices.
Where should one be putting capital right now? Is it time, Julian, to fade that move in commodities and dabble a little bit here in Bitcoin? Bitcoin backed up about 40,000 here, seeing some other high-risk areas of the markets come back here. What do you think?
Well, I think cryptocurrencies right now are sort of caught in this cross current of, use case versus inflation hedge versus geopolitical hedge versus, frankly, as they've been for the last number of months, a risk-on asset. So for us, there's a lot of noise surrounding there. It's likely to go on for a number of more months. Frankly, though, when you think about it, what was interesting yesterday was that when West Texas hit $100 a barrel, you really had the start of the about face. And what we've seen is some of our investors that have been involved in the energy space starting to take profits a little bit, really redeploying into places where there's high short interest, places like the home builders, which have a domestic focus, and really starting to dip their toes into some of these technology names down 30, 40, 50% that have earnings.
I want to take a little bit of a step back here, because obviously there's a little bit of a dissonance, right? Because obviously we have to talk about the markets. That's what we do. It's important for our viewers. At the same time, you have a disaster going on. I think we're all cognizant of that, but I just wanted to sort of say it out loud, as it were. And Karen, on that front, when we're talking about sanctions, we're talking about something that is not going to prevent tanks today necessarily from rolling on Kyiv, right? I mean, we're talking about something that takes more time to take effect. What kind of timetable are we looking at here potentially? And at some point, will it actually stop what Russia is doing?
It's going to take time, and also sanctions are going to grow in response to how much violence one finds in Ukraine. So it's easy to win a battle, and Russia will succeed in taking over the capital. But Putin has some larger objectives, instilling a government that is friendly to himself. I'm sure he wants to get a promise that the Crimea is really his, for whatever that is worth. But he also has these historic agendas that he wants to establish a greater Russia in the larger region. And for those agendas, it has to be seen as succeeding. So sanctions are trying to ebb and take away what Putin wants to achieve in his larger agenda in the war, to the extent that we know what his larger agenda in the war actually is. And so I do think that there'll be more support for tighter sanctions. This is a kind of a gallows analysis, the more the violence grows. So if you think about the Ukrainian military strategy, it's going to be asymmetric warfare, because they can't deter the tanks and the overwhelming air power and the overwhelming missile power. What they're going to do is try to send a lot of body bags back to Russia. Russia got the Crimea almost for free, and they want to make sure that this becomes bloody and costly, and that Russians don't have a stomach to pay for this element of the war. The sanction side of the equation is to make Europe and the West unfriendly place for Russians to be, and to really hurt them where it counts. Now, as the West is closing the door, it looks like, and this is a bit early to say, but it looks like China's going to open up its door. Now, it's going to open up its door, I heard this morning, to grain exports. But also, if you think about where the oligarchs like to hang out, I mean, if they switch their financial transactions through China and start selling to China, then they're going to have to also want to have a fancy apartment in Shanghai, in Beijing. And I don't know if that's really where they want to be and where they're going to be grumping about. So it is a long game strategy. And in the short game, it's going to look like Putin keeps winning. If I can say something as well about the economic effects in the U.S. economy, which is a question I know is on people's minds, And we heard that the stock market might go up. And that's because our economy is a global economy. So on the one hand, we're energy efficient and we're food self-sufficient. And that is a really fantastic thing. But we're also a market economy, which means that when global prices go up, the prices of all the goods that we buy also go up, but also the profits that all the companies that sell these goods make goes up. I think it's really Europe that's going to be paying hugely for this because, well, we look at our gas prices at the pump, and that, of course, does affect the family's budget. We're not dependent for our heating on Russia's energy, and Europe is dependent for their heating, and it is winter there, and their energy bills, that's not an optional expense. That's going to go up. As well as the trade is going to impact them more directly. We're not as dependent on Russian trade. So it's because we're involved in this global economy that the prices are going to fluctuate.
And Julian, that brings me back to the Fed, of course, if we're talking about fluctuating prices and what's going on with inflation. We are hearing, it keeps sort of going back and forth whether we're going to see 50 basis points in March as we react to each new Fed speaker. What's your current thinking, of the moment thinking on that issue and the implications for the market?
We think the Fed is very committed to doing 25 on March 16th. I know that there has been talk, and frankly, surprisingly yesterday from some of the Fed officials, of really towing the line with regard to the market expectations of 6 25 basis point hikes in 2022, and the start of quantitative tightening, which also happens to be Evercore ISI's view. But frankly, I think what you have to ask yourself now is, is the risk to that number of 6 asymmetrical? And we would say that if you start seeing more negative headlines, which again, at some point you certainly are, out of Ukraine, and that starts to affect other asset markets and the volatility starts spiking once again, that the risks are going to be fewer hikes, but they really do need to do 25 at March 16th to deliver a commitment and really to sort of satisfy markets.
Thanks so much, guys. Really great to get both of your perspective on this very busy morning once again. Julian Emanuel of Evercore ISI and Karen Alter at Northwestern. Thanks to you both. Just want to bring you some breaking news as well. According to reports, President Joe Biden has selected Ketanji Brown Jackson as his nominee for the Supreme Court. Again, that's according to multiple reports. If confirmed, this would be a historic nomination, of course, and confirmation of the first Black woman to sit on the Supreme Court. This is a commitment that the president had made to nominate a Black woman. And she was among the names that was floated. She is 51 years old. She currently sits on Washington, D.C.'s Federal Appellate Court, and she had been considered as one of these front runners here. Apparently, she received and accepted President Biden's offer in a call last night. That's according to reporting by CNN. We'll keep you posted for any official announcement as well. Coming up next, amidst all of this, we're still in earnings season. We got some big names to talk about. Etsy, Coinbase, and Block all reporting. Block shares up by 20%. We'll have details on its report next.
Amidst everything going on in Russia and Ukraine, investors are still being hammered by earnings reports. Julie, let's start with a look at Etsy here, the second trending ticker right now on the Yahoo Finance platform. Really interesting quarter here. Company showing strong gross merchandise sales versus last year. I believe they were up 17% year over year, which was, it's good because last year at this time they showed 115% year over year growth, in large part because they have sold, or they did sell, a lot of masks. So mask sales in the most recent quarter from Etsy down, I believe 70% year over year, but still a good quarter for this company. The one red flag, if you have to toss any red flag on the field here, Julie, on Etsy, they did highlight or signal they might see slowing growth again in the first quarter, but still, the street really doesn't care about any of it.
Yeah, that's what, that also was the thing that stood out to me as if there's any negatives, it's the forecast. The company said for the first quarter, sales are going to be as much as $590 million, which is below estimates, and gross merchandise volume also going to be below estimates. But that's something that the street was bracing for. And so most of the commentary I saw around the forecast was that it was largely in line and therefore reassuring. A couple other things I want to mention. And one thing that really stood out to me, Brian, is the fact that the company is raising prices. It's raising its base transaction fee from 5% to 6.5% effective April 11th. It's not saying it's doing it because of its own rising costs, which I think is really fascinating here. It's doing it to invest that increased fee. So that's definitely something I want to ask Josh Silverman about when we speak to him a little bit later in the show.
Well, I have one too. I need to ask Josh Silverman when we talk to him shortly, Julie. They talked about in the conference call, that is Etsy, 50% of males surveyed that they surveyed have never even heard of Etsy. So I'm very interested to see how Josh Silverman will in fact be targeting more male consumers. That is a big potential, I think, missed opportunity for Etsy. Very curious on how they in fact target those male consumers. And besides Etsy, the top trending ticker on the platform right now, it's Coinbase. Coinbase, another, I would say, a very strong quarter, much stronger, Julie, than I think a lot of folks on the street expected. We did see crypto rebound towards the end of last year, so maybe not unexpected totally.
Yeah, no, definitely not unexpected. We saw the stock fall after the results because of the company saying things are going to slow in the second half of the year. And I was sort of, a lot of analysts were saying they were sort of confused by it. I was a little bit confused by it because we did have last quarter so much stronger than estimated. You see there $2.5 billion in revenue above estimates, and that earnings per share above estimates as well. Monthly transacting users last quarter, 11.4 million versus the 9.8 million estimated. So all of that perhaps explains why the stock has turned around.
Yeah, and by and large, the street is coming out here, Julie, and I would say just defending Coinbase here. A lot of positive notes, seeing some upward estimate revisions here. So that is another interesting as well. And then, of course, one of the top tickers here, it's Square/Block. A pretty good quarter out of Block, comeback quarter here. But again, another company, Julie, not unlike Etsy, that is warning about a little bit slower growth here to kick off the first quarter.
Yeah, the company, though, up by 7%. And it looks like that the interpretation of the outlook for 2022 is that it is largely positive here after the company's numbers beat estimates. Gross payment volume is indeed going to be lower than expected in the current quarter. But then Block said it's going to increase gross profit each quarter for both its Cash App and the Square seller business for the remainder of the year. So that seems to be reassuring investors here. By the way, revenue from Bitcoin purchases in the fourth quarter, $1.96 billion. That's almost half of the company's sales overall last quarter, even though they don't necessarily feed through to the bottom line, but still interesting there that is obviously such a big part of the business and part of the reason why they changed the name.
Julie, what did you say in your intro? What, Dorsey out of the block, Dorsey on the block?
Dorsey from the block. And Jenny from the block.
Julie, I can't put you in a box. That is very, very impressive as always. All right, we'll leave that there. I can't. I got to stop the puns here on this Friday morning. All right, coming up, Federal Reserve is in a much tougher spot now that Russia has invaded Ukraine, sending commodity prices higher globally. We'll dive into what the Fed may do at its March meeting with Mike Schumacher, Wells Fargo, next.
Well, about 90 seconds to the opening bell on this Friday morning as we continue to try to decipher all the headlines coming out of Russia and Ukraine. We do see futures higher at this moment. Pertinent headlines this morning as we see evidence that the Russian military continues to push toward and even into Kyiv, the Ukrainian capital, including bombardment there. Also, some headlines this morning from Interfax that the Russians could still be open to some sort of negotiations in Minsk in particular, and the FT reporting that the EU is preparing sanctions on Vladimir Putin and Lavrov, his foreign minister, at some point that they're preparing to introduce that. Brian Sazi, all of this equaling futures that are a little bit higher for now.
Yeah, markets always fascinate me, Julie. It was just really interesting to hear Julie and Emmanuel just tell us that folks are starting to tip their or dip their toes back into these markets here in more, I would say, risk-on areas of the market. So tech, I believe you mentioned home builders too as well. It's fascinating to see these moves, this buying interest as we watch this situation continue to develop and in many cases, perhaps get even worse.
Yes, indeed, perhaps get even worse, even as we see Western markets maybe try to game out what the eventual effect of all of this is going to be. One of the read-throughs that we've been watching really carefully, the implications of the Russia invasion of Ukraine for inflation, for in particular energy and food prices, but not just that, metals prices as well, semiconductor prices around the globe. And then, of course, there are implications for the Federal Reserve. We've been talking a lot about that this week. Last evening, we had a Federal Reserve Governor, Christopher Waller, say he would support an increase of 50 basis points in the interest rate, in the federal funds rate at the March meeting. But there's a lot of debate about that. We just heard from Julian Emmanuel over at Evercore ISI that he thinks 25 basis points is really still the base case. Mike Schumacher is with us now, Wells Fargo head of macro strategy. Mike, it's great to see you. What is your current thinking on what type of increase we're going to get at that March meeting? And then, we're seeing yields push up a little bit this morning.
That's right. Thanks, Julie. It's certainly a pleasure to be on. Yeah, thinking about the Federal Reserve at the upcoming meeting and also at the next few, we think 25 is the number. From our perspective, 50 was never seriously on the table. And the reason I say that is the Fed's number one problem is inflation. We all understand that. But whatever it does in March or in April or going out a few months beyond that, it'll take a while to impact inflation. It's probably going to be 6, 9, 12 months later. So really the Fed has to focus on what signal do we want to send to investors today? Going 50 basis points out of the chute, I think that signal is, hey, we've lost our grip, we've lost the handle on the situation. That's not a good look for the Fed. So we think 25 is right. Yes, the situation in Ukraine makes the inflation picture worse and tougher for the Fed, but still, we do think 25 is a number.
Mike, so we could have the Fed, let's say, raise rates by 25 basis points in March. We have very high levels of inflation. You have Russia invading Ukraine. How fast is the U.S. economy growing in the spring with all those factors combined?
Yeah, it's putting a lot of pressure on growth. But I think, again, the inflation side is the bigger concern for the Fed. It really is a tough balancing act. How quickly do you try to slow things down? And it's an incredibly difficult situation. It was always going to be when you consider the amount of stimulus injected into the economy, both on the fiscal side and the monetary side. How does the Fed try to navigate that? So the growth picture is, I'd say it's fuzzy at best at this point. Probably need to wait for another month or two and see what the fallout is from Ukraine and Russia with respect to commodities to get a better handle on that.
And on that front, in your latest note, you made an interesting point, which is that it's difficult to make some sort of historical parallel for this situation and its impact on the market. So how do you then sort of frame it in your work if you can't find that direct historical parallel?
Yeah, it's been tough, Julie, not just for us, but I think for everyone, all of your viewers out there to think about, does this really compare to the situation in Crimea when the markets weren't really terribly off put, let's say, for any length of time, or does it map to the Gulf War, the Iraq War? And the answer is really none of the above. So I think you can take a look at the reaction on the commodity side and say, does that translate through to equities, probably to interest rates, almost certainly. And that's where we've been taking our cues. We've been trying to think about the impact of this move on commodities, so pushing oil up quite a bit, making inflation worse over the next probably 3 to 6 months, and therefore getting a bit more bearish on rates. But you're right, there's just not a great playbook for this type of thing, so we have to improvise.
Mike, have you and your team crunched the numbers on what gas over $5 a gallon nationally in the U.S., what would that do to the economy?
Yeah, we haven't really worked on the pass-through from gas over $5 into growth, let's say, but I think you've got a number of effects to consider. One is just in terms of consumer sentiment. That's about as negative as it gets. $5 gas, people don't like that. Gas goes up, milk goes up, that's a pretty big negative. And I think that puts more political pressure on the Fed and also on policymakers in general. So can't quantify the growth effect per se, but in terms of the other pressures, they become a lot more intense.
And Mike, we got some economic data this morning. We got some numbers on inflation, on spending as well. We talked about this earlier. PCE deflator up 6.1% year over year, 5.2% at the core level. Personal spending up 2.1% as well, although obviously if you look at real personal spending, it's lower at 1.5%. How did you read these numbers? And it feels like, when you're looking at the outlook for the Fed and the economy at this point, all of the data is sort of confirming their next move and that there's a certain glide path right now for the economy.
Yeah, it's an excellent point, Julie. Yeah, we interpreted the data sort of collectively as being relatively stronger than expected. And I think you're right on in terms of confirmation. So looking at the PCE, the inflation data, it's from January. It feels almost stale. I know it's only been a few weeks, but so many things have happened. But still, is that really going to cause the Fed to say, hey, inflation's actually behaving better? No, I think not. And really, given the shift over the last week or two in commodities, probably PCE on top of that makes the Fed more convinced that now is the time to tighten. So I think you're right that things have been lining up, and generally having strong data consistently over the last 6 months makes the Fed's call, although challenging, maybe it's pretty clear it's the right one.
Mike, good to see you. Hope you're well. Mike Schumacher, Wells Fargo head of
Thanks,
macro strategy, talking to us on this Friday morning. And just want to do a quick check of stocks here. Now that we're about 5 minutes in, we've got the Dow trading higher by about 0.9%. The Nasdaq, look, the Nasdaq's in the middle there. It's up to 0.25%. And the S&P 500 up about 0.2%. Just glancing at some of the groups here, financials appear to be in the leading position today as we get out of the gate. Coming up next, we're going to go down to the floor of the New York Stock Exchange, talk to our Jared Blickery for what's going on, for more on today's market action. Stay with us.
Welcome back. Jared Blickery standing by for us down at the New York Stock Exchange. Jared.
I just want to go over what happened yesterday. Huge reversal day. These things don't happen that often. I'm looking at the S&P 500 futures contract just because it actually trades as opposed to the S&P 500 index, and it shows what I'm talking about a little bit better, especially because it's open 23 hours per day. So yesterday we were down 3% in the Nasdaq, so that's a little bit different. I could show you the Nasdaq 100, but it looks very similar, and we closed up over 3%. And let me just, to be consistent here, show you what that Nasdaq 100 futures chart looks like. Now you'll notice that there's on this candlestick, there's a little wick at the bottom. That shows that there was indecision there, that there was a strong reaction off of a support point. And in fact, these are the May lows and March lows from last year. And I just want to point out, I said this doesn't happen this often, happened exactly 1 month ago yesterday. It happened in this candle right here, and you can see what happened afterwards. Chopped around for a few days, then launched higher, and then quickly sold off of this resistance point. And there's no guarantee what happens this time. It could be that the fact that this is the low. However, I will preface this by saying that you can have a lot of these events clustering when you have a bear market. And we saw this in 2000, from 2000 to 2002. This particular configuration happened 8 different times. In 2008, it happened 3 times. So if there's a full land war erupting in Europe, you can bet we're going to see lower prices, and we might see a few more of these signals. In the meantime, traders saw this as a tradable bounce, and I just want to show you what's been happening over the last day or two with some of my leading markets. So this is a sector action. Let me go to my leaders, and you can see regional banks in the upper left. That's KRX, the KRX Regional Bank Index, that's up 2.5%. We got transports in there, value, but over the last 2 days, you can see a lot more risk on. In fact, yesterday, a lot of these markets were bought. You could call it potentially a short covering bounce. That is also part of the equation. But then take a look at what's happened over the last 11 days. As we've been talking about, that was kind of the start of this confrontation. At the bottom, you can see what's really been taken to the woodshed here. ARK Invest, KWeb, that's Chinese internet stocks, IPO, cannabis, gambling, retail, software. All these things are probably poised for some kind of a comeback if we can keep the momentum in this rally. So I think the major pain point here is going to be a rotation back into growth, out of value, and also that's going to be prefaced on the Fed simply taking a less hawkish tone. So the element of timing here is we have until the Fed's meeting in mid-March or so to figure out exactly where we're going to stand with interest rate policy, and anything can happen geopolitical wise from there. But in the meantime, we have this tradable bounce, and we'll see where it leads, guys.
Great way to sum up the week there, Jared. Anything could happen. We'll check back with you later. All right, another stock lighting up the Yahoo Finance trending ticker page is Beyond Meat. Shares are getting pounded after the company posted a wider than expected loss, citing increased competition and a slow recovery over at restaurants. But Beyond did say on the earnings call last night it would slow expense growth this year to improve its bottom line. Founder Ethan Brown added, quote, "This is the year of execution." Coming up, a big quarter from Etsy Thursday night, and the market likes it. We'll chat with Etsy CEO Josh Silverman on the other side of the break. Do not go anywhere.
Etsy reported after the close of trading last night, and the company, as you can see, came in above estimates. In particular, that revenue number is a 16% increase to $717 million. Also, gross merchandise volumes rose by 17% to about $4.2 billion. The share's up by a little under 7% at the moment. Josh Silverman is joining us now. He is the CEO of Etsy. It's good to see you, Josh. We've talked with you in the past during the pandemic about mask sales and how big they were on Etsy. Obviously, that's less of a factor for you guys right now. And so I'm curious in the quarter, as you continue to see momentum, even with that huge push, where now a lot of the strength is coming from?
Yeah, so true. Masks are now less than 2%, but the tremendous variety of things for sale on Etsy is a huge strength of ours. There's over 100 million things for sale on Etsy in almost every category. So our largest category has been home furnishings. And you won't be surprised to hear that home furnishings is about flat year over year. People have spent the last 2 years sprucing up their home, and with interest rates rising, probably people will be buying fewer new homes or moving into new homes for the moment. But weddings are up in the mid 20% year over year. And I think people are excited to get out of their house and start gathering again. And so the ability to participate in many different categories, we think is a real strength of the vibrancy and the size of our market.
Yeah, that's definitely interesting about weddings. And it is interesting how the product flow kind of mimics what's going on in the outside world, obviously. Something else I wanted to ask you about is you guys, like many other companies, are raising prices. In your case, specifically, it's the base transaction fee, which is going to 6.5% from 5%. What was interesting to me, Josh, is you didn't talk so much about inflation pushing that change. It's that you guys are reinvesting in the business. So talk to me about how you made that decision and where that money is going.
Yeah, we always think about our fees in terms of a fair exchange of value and making sure that we are the best value for our sellers. And we think that 6.5% as a commission is fair. Etsy now has 90 million active buyers, and sales per seller grew by 23% last year alone. The number of sellers on our platform has more than doubled since the start of the pandemic. Last time we raised fees in 2018, Etsy was spending about $70 million a year on advertising. Last year, we spent $500 million a year on advertising. And so what our sellers are asking us to invest in is marketing, service, and product. So we're going to spend more than $600 million this year on marketing. We're investing significantly in service to make buyers and sellers able to work within our platform in a really worry-free way. We spent more than $100 million on service last year, and doing things like having live phone support and chat support for buyers and sellers, and also making sure we're really enforcing our policies around things like the handmade policies. So we have a level playing field for all of our sellers and deliver on our brand promise for buyers. And on the product side, investing to make sure that search and discovery is really world class, that things like reliability of the platform work. We mentioned in this earnings call that the work we did on product just last year, added over $1 billion of incremental sales for our sellers through the efforts of our product and engineering team. So those are the examples of where we plan to reinvest in our sellers.
Josh, you shared a stat on the call last night that took me by surprise. You noted consumers that identify as male, 50% of them have never heard of Etsy. Why is that the case, and what are you doing on the platform to get their business?
It's a great point. I'm really glad you raised it. We have always been a female-led company. Over 80% of our sellers identify as women. About 80% of our buyers identify as women. And as we looked at our opportunities going forward, we realized we've never really tried to speak to men. And there's tremendous amounts of merchandise on our platform that are great for men. And so we're now starting to merchandise more directly to men. We're starting to advertise in channels where men are a bigger part of the viewership. So for example, you're starting to see Etsy advertisements in the NFL. And we're seeing great response from men. So we think it points to there's still a tremendous opportunity, and it's early days for Etsy overall.
And how big of an opportunity do you think that could be? I mean, if it's something that you haven't really ever put a lot of effort into. Now you're putting the effort into it. Men are a big market. I mean, have you guys put any sort of modeling around what that could do for sales?
We have, obviously men is about 50% of the US population. Women control more of the wallet in terms of consumer spending. And so, we think it's a big opportunity. We also think international is a very big opportunity. We're really investing in a few select international markets like the UK, France, Germany, and Canada. But it's a big world out there. And we've been planting seeds in the UK for a number of years. The UK is now 4 times as big as it was before the pandemic. I mean, we've seen an explosion of growth in the United Kingdom. It's a great example of the seeds we've been planting growing into a huge forest almost overnight. And we think that opportunity exists in many markets outside the United States.
Josh, your first quarter outlook or your guidance, your outlook for the company, does it incorporate anything, consumers pushing back or resistance to any price increases from sellers?
We guided to 5% growth for Etsy consolidated for the first quarter. And that's about holding flat year over year for the core Etsy marketplace, not including our subsidiaries. What we think is remarkable about that is if we think about this time last year, Etsy grew 132% year over year this quarter last year. And that's among the highest growth rates any public e-commerce company has published ever. And that was hugely benefited from things like stimulus checks that were coming out this time last year and lockdowns. If we remember 1 year ago, there were severe lockdowns in many parts of the United States and in fact, many parts of the world. And Etsy, it was obviously a huge beneficiary of that as there were very few other places you could go to shop. This year, the world looks very different. There's no federal stimulus, and in fact, almost every shop is open and operating, and yet people are choosing to come back to Etsy again and again. So maintaining all of the gains that we had from this time last year, we think is a really fantastic signal of the durability of the benefit that we've seen and what we offer to people that makes them want to come back again and again.
And Josh, finally, before I let you go, I would be remiss if I didn't ask about Ukraine and Russia and what's going on. And I was thinking back to the early days of the pandemic. I actually ordered something off of Etsy from a former colleague of mine who's Ukrainian American, and it was sort of her family shop. So even though she's not based in Ukraine, she obviously has ties to Ukraine still. And so I'm wondering what the sort of direct and indirect effects are that you're thinking about.
Thanks for asking. It's obviously an incredibly sad moment for all of us with really far-reaching effects. And we absolutely have sellers in the Ukraine and in Russia. But in fact, about 2% of sales on Etsy come from Ukrainian sellers, another 1% from Russian sellers. And they do a great job delivering artisanal products that delight our customers. In fact, we have some ceramic bowls that just arrived from a seller in the Ukraine, and they're beautiful. And so our hearts go out to everyone that's impacted. We want to do everything we can to support our sellers in that region who are just trying to make a living and provide for their family like anyone else. And of course, we're going to respect sanctions from the US and Europe and do everything we need to do to comply with the law.
Josh, it's great to see you this morning. Thank you so much for taking the time to talk to us. Josh Silverman, CEO of Etsy. We're going to take a quick break. When we come back, we'll get you updated on what's going on in stocks today. Stay with us. Almost 30 minutes into the session now, and we see stocks hanging on to gains, except for the Nasdaq, which is now off by almost 0.5% here. So mixed session as we head through it, and we're going to talk more about what's behind all of this in the next hour. In the meantime, I do want to bring you one more mover that we are watching, and that is Zscaler. The company is plunging today. It's down by 20%. It's a security software company, and this numbers actually beat most estimates, but there's a lot of optimism baked in here, according to analysts. For example, the folks over at Deutsche Bank say after a stellar run of near flawless execution by Zscaler, the second quarter was mixed. Federal contracts haven't been closing, lack of mega deals were some of the issues that are in focus and the reason that the stock is trading a little bit off. As we mentioned, coming up in the next hour, we'll continue to update you on what's going on here with markets. As you can see there, the Dow still gaining, but paring those gains.
Welcome back to Yahoo Finance Live on this Friday morning. I'm Brian Sazi alongside Julie Hyman. The markets remain on high alert for any developments on the Russia-Ukraine front. All three major indices are seeing some mixed action so far. The Dow up almost 100 points, the S&P 500 and Nasdaq in the red. But Bitcoin, something else we're watching, is rallying back a bit off decent earnings results from Coinbase and Block. Now, Julie, over to you with some breaking news on the consumer.
Yes, we've got the latest from the University of Michigan in terms of their consumer sentiment reading for February. This is the final read for February. They had already come out with a preliminary read. It comes in at 68.2. That's just very slightly below the initial read. Expectations above the initial read of 59.4 here. And inflation expectations, a year from now at 4.9%. So that is what's going on at the moment. Also pending home sales just out, 5.7% drop in pending home sales. So that a little bit less good news, obviously, coming out at the moment. Saz?
All right, investors are carefully watching whether Russia gets kicked out of SWIFT. Well, what is SWIFT and why does it matter to markets? Yahoo Finance's Brian Chung is here with the new Yahoo U. Brian.
Hey, Brian. Well, amid all the sanctions on Russia, one we keep hearing about is a ban from SWIFT, one that President Joe Biden said yesterday is off the table. Take a listen.
The sanctions that we have proposed on all their banks have of equal consequence, maybe more consequence than SWIFT, number one. Number two, it is always an option, but right now that's not the position that the rest of Europe wishes to take.
But still, top Ukrainian officials are begging Western nations to ban Russia from SWIFT, which begs the question exactly what is SWIFT? So let me show you some slides here that kind of break down exactly what we're talking about when we hear the buzzword of SWIFT. It stands for the Society for Worldwide Interbank Financial Telecommunication. And really what this is the primary comms channel for banks internationally. So this facilitates payment requests, and it does the record keeping for the trillions of dollars of funds that zigzag around the world, which means if you disconnect them, it's going to be hard to settle any payments. It's going to cripple a country's ability to settle payments for their exports like oil or gas or metals. And that's what happened when Iran was blocked in 2012 and then again in 2018. Now, people might already be familiar with SWIFT if you've tried to wire money overseas. So let's make an example out of this, right? Let's say Brian's in Hong Kong. He owes Julie a bunch of money for whatever reason. He's got the money and now he can finally pay her back. Well, Brian can use a SWIFT code, right, to wire the money to Julie. Let's say Brian's banking with HSBC. I don't know this for a fact. Let's say Julie uses Wells Fargo. He's going to enter in that SWIFT number, and then HSBC is going to use SWIFT to communicate with Wells Fargo to make sure that that payment can be done. The payment's not done on SWIFT. It's just a communications channel. So imagine what happens if you're banned from SWIFT. Let's say one of these banks is no longer connected to the network. Well, you can't facilitate the payment there. But that doesn't mean that Brian can't get his money over to Julie, right? Just means that you'll have to use other types of channels. So maybe he's going to use a cryptocurrency, for example, or maybe he's just going to put a bunch of cash into an envelope and then send it over to Julie. Think of what's going on here within the context of nations and large institutions. It's exactly the same thing. Just because a bank is disconnected from the SWIFT network doesn't mean they can't facilitate the payment. It just means they can't use the comms channel of SWIFT to get that transaction done. So really, at the end of the day, SWIFT is just a messaging service provider, and they've made it clear that they're neutral. It's overseen by G10 central banks. That's the structure of SWIFT, which is based out of Belgium. But they've made it clear that, quote, any decision to impose or to lift sanctions on countries or individual entities rests solely with the competent government bodies and legislators. So kind of in closing here, guys, think of SWIFT as more like the Slack messaging that we use here at work even, right? Just because Slack goes down doesn't mean we can't get back to business. It just means we have to figure out other ways to get around it. That's one reason why people have said, maybe banning Russia from SWIFT would actually just accelerate the use of non-US dollar denominated assets or perhaps cryptocurrencies, which could disintermediate things. And then within the context of Germany, consider that their reliance on using SWIFT to close settlements for, let's say, for example, oil and gas is something that might be factoring into their decision to not want to support a ban on Russia from accessing the SWIFT network. All things to think about as we continue to get these headlines on the sanctions, guys.
Brian, I think those pictures perfectly captured things. You could see how I was depressed sending Julie all that money, and she was very excited about receiving it. So it's a big win for Julie, a big loss for me. But while we have you, real quick, Brian, what is the impact, or what would be the impact to U.S. banks like a JP Morgan, a Citigroup, if this actually happens?
Yeah, well, as I kind of showed through that diagram earlier, right, if you X a counterparty bank from the SWIFT network, that means that another bank somewhere else, which is not necessarily in a jurisdiction that's being sanctioned, is going to get impacted as well. They can't complete the other side of the transaction, whether they're the person sending or receiving the money. So when we talk about the banking industry, we have to remember that it's not like the SWIFT network, again, is going to be the end all for getting payments done. It's just going to mean that these banks will have to find longer, more complicated, and in many cases, more expensive ways to transact these types of settlements. So any way you cut or slice it, that's one reason why perhaps Germany is saying, well, we might not support a SWIFT sanction here because the reliance, for example, on Russian natural gas specifically, as we've seen with the Nord Stream 2 pipeline, is perhaps one reason why German banks, for example, might be more exposed than, say, United States banks, where the dealings with Russia might not be as intricately intertwined. So I think that's going to be a big threat to watch as well. But important to note that yesterday, despite the weird rebound that we saw back in equities, actually U.S. bank stocks still took a harder hit as well.
Brian Chung, catch you in the 11 o'clock hour. Appreciate that. Okay, the Russian invasion of Ukraine tilts the risk to the global economy sharply to the downside, warns our next guest. Paul Grunwald is the global chief economist at S&P Global Ratings. Paul, always nice to get some time with you. So walk us through this. How much downside risk are you looking for here?
Yeah, great. Good morning. Great to be back on the show with you guys. Well, as you said, we just put out a report looking at the macro credit implications of the invasion in Ukraine. So we've got three channels we've identified to watch. The first is energy prices. Obviously, those are heading higher. That's good if you're a producer or an exporter, and it's bad if you're a consumer or an importer. Kind of net, that tends to be negative. So that's going to be a drag on growth. We also have capital flows. We know that in situations like this, many fund managers are de-risking. So we're moving away from riskier credits, whether those be on the corporate side, the bank side, or the sovereign side. That's going to tighten credit conditions. And then finally, confidence. We just heard some confidence numbers from February, but we would expect both consumer and business confidence to decline in the months ahead. So that means lower consumer spending and lower firm investment. So you put all that together, and we've got some material downside risks to growth. We just started our forecasting round, which we call the quarterly credit conditions round. So we don't have updated numbers, but we've already flagged to our clients and stakeholders that the invasion of Ukraine holds serious downside growth potential.
Paul, good morning. It's good to see you. It feels like there's a little bit of a disconnect here because you're painting a relatively dire picture. And yes, we have seen some turbulence in the markets here, but it doesn't feel as though most of the folks we're talking about are as concerned about the situation as the scenario that you're painting would seem to imply. Why do you think that is, or do you think that we're not sort of yet at that scenario, or it has to play out a little bit more, perhaps?
Right. Well, I think you answered it at the end there, Julie. It's very early days. And as I said, each of the channels we identified is going to have a negative impact on spending and growth. It doesn't necessarily mean, for example, that the U.S. is going into recession. Our standing growth forecast is for growth just below 4 in the U.S. and just above 4 for Europe this year. I mean, those will almost certainly be coming down. We don't know the magnitude right now. So I think it's a bit too early to say it's going to be, the effect on growth is going to be X. But I think directionally we know where we're going. And, that's going to feed into things like monetary policy as well. So again, we're digesting the data as they come in. We're looking at the macro credit effects, and we're going to continue to inform the market. I think it's directionally clear, but to your point, we don't know the magnitude yet. We're going to discover that, obviously, as the data continue to come in.
Paul, just given where things are now, in your models, do you see or do you project a quarter of negative growth for the U.S. this year?
No, we don't. Let's remember, we've got a roughly just under 4% growth forecast this year. That's double the trend growth for the U.S. Usually we think of the U.S. as kind of a 2% growth economy or a bit less. So, do simple math, that's about a 0.25% increase every quarter. So getting to a negative quarter would be a big drop. We do have a recession indicator from our U.S. team, and that's still at a very low level. So I wouldn't put the risk of a normal recession, which would be 2 consecutive quarters of growth below 0. I wouldn't put the probability of that very high. But again, we're going to be lowering the forecast almost certainly. But the recession scenario is still a tail risk for us.
Paul, what is your current inflation outlook? We got the PCE numbers today for the U.S. at least for last month, coming in 6.1% overall, 5.2% core. I'm curious, sort of with the Russia scenario and without, what you're seeing as U.S. inflation, and then also what you see as global inflation.
Right. So I think we need to keep two things really clear as we think through the Russia-Ukraine scenario. One is we will get a jump in prices in the short term that will be led by energy and any of the spillovers for that. But going forward, and let's remember, monetary policy making is a forward-looking exercise, the demand pressures will be lower for the reasons I explained just a few minutes ago. So again, we don't have a new inflation forecast, but if you kind of put all that together, that to me would suggest that central banks are going to go a little bit easier on the normalization than they were, let's say, a couple of weeks ago. The inflation prints going forward will be a little bit lower, and I would expect the language to start to change, maybe away from kind of an aggressive normalization to something more balanced. Another way to think about it is if we were at, the textbook steady state right now in monetary policy was neutral, if we had a shock like the one we're seeing with Russia and Ukraine, central banks would probably be thinking about easing monetary conditions and lowering rates. So we've got to kind of overlay that with the fact that we were starting a tightening cycle. So, the prints on inflation are going to be high for the next couple of months, reflecting energy. But going forward in the way that central banks do their job, if they're looking into late 2022, early 2023, I would expect not just in the US, but globally, a more moderate pace of monetary policy normalization, or in a few cases, if we get into a bad scenario, that might even stop and reverse.
Paul, next week we get a jobs report. What's your projection, and do you expect companies will pause their hiring plans because of what's going on with Ukraine and Russia, but also a lot of uncertainty around Fed policy?
Yeah, well, Fed policy, I just addressed. I would expect some change in the language to acknowledge that inflation is still higher than the Fed wants, but also saying that the outlook could be a bit weaker going forward. So that might be a slower pace of normalization. The job market, we know we're in good shape. The unemployment rate's around 4%. We're creating 400,000 or 500,000 jobs per month. We don't think that's going to have a material difference in the report next week. That's going to be a bit backward looking. But again, I would be watching the confidence numbers going forward. We're going to get those before the actual macro number. If we start to see a big drop in consumer confidence and spending, and we start to see a big drop in firm confidence and investment spending, then that would feed back directly into lower job creation. We're not there yet in the US. We would argue would be sort of moderately affected by all of this, less than Europe, let's say. But again, watching the numbers going forward, directionally, we know where we're going. The next few prints should be pretty much on the recent trend, but then when the effects of the Russia-Ukraine situation start to feed into the data, then they'll probably get softer from them.
Paul, great to catch up with you and get your insight on all of this morning. Paul Grunwald is Global Chief Economist at S&P Global. Thank you. Well, just wanted to bring you some breaking news. The confirmation from the White House that indeed President Biden plans to nominate that woman, Judge Ketanji Brown Jackson, to the U.S. Supreme Court. Remember, President Biden had pledged to nominate a black woman to the court, and indeed that is what he is planning to do now. She is currently a judge on the U.S. Court of Appeals for the D.C. Circuit. If she is confirmed, she will be, again, the first black woman to serve on the Supreme Court, and she would be nominated to replace Justice Stephen Breyer, who announced his retirement. So we will be looking for him to make the announcement. Right now, it's a plan to make the announcement, and an important one for the country. We're going to take a quick break. When we come back, when we have conflicts like this that are happening in Russia and Ukraine, what's the historic effect in the market? How do we even game that out? Our friend Sam Rowe from ticker.co is going to join us next to discuss.
Welcome back. Our next guest decodes a simple question on the minds of many investors out there, and that is, why are geopolitics rocking the U.S. stock market? Ticker.co editor Sam Rowe joins us now. Sam, always nice to get some time with you. So what do you make of the market action this week?
I think a lot of it has to do with the fact that no one actually really imagined that Russia was going to invade Ukraine. Even though we've been hearing this from the White House for weeks and maybe even months, it was just not a concern among investors and traders and professionals that they would actually list it as a thing that was a major concern. And why would they list it as a major concern? It's not something that actually happened yet. Whereas right now, investors are already concerned about stuff like high inflation and interest rate hikes and earnings growth decelerating, and we still have a pandemic happening. So I think it's just a matter of the markets just not having taken the likelihood of an invasion very seriously.
And so I wonder, Sam, even though it was sort of telegraphed, even if people were not taking that seriously, I wonder if it sort of counts as a black swan, sort of a traditional type black swan. And if it is that the thing that sort of it's already taken down the market some, but not that much. So how are people sort of gaming out at this point, now that it has happened, how much it could continue to take down the market?
Sure. I think what I would probably, put it in the same sort of field as a black swan, in that, again, I don't think anybody was really, making a bet that this would actually happen. But, if we know anything about markets historically, the move is by investors is to price in, a worst case scenario very early on. And, sometimes those worst case scenarios do, play out. But, for the most part, whatever the worst case scenario might be doesn't play out. And so when you do get, new developments of how, things are escalating, if tensions and if, what's going on with the invasion in Ukraine, if the developments, we're going to get bad headlines. First of all, we're going to get bad headlines for a while, but the bad headlines aren't as bad as what, some might imagine them to be, then yeah, you could continue to see the market rally.
Sam, are you surprised by how resilient the U.S. consumer is right now? We just had consumer confidence out moments ago. I was expecting a plunge, and we haven't gotten those readings yet.
Yeah, that's a great question. And, I was just listening to your guest before us talking about how, something like geopolitics can weigh on consumer confidence, and that's supposed to, send shockwaves through the economy. But the thing is, consumer confidence has been deteriorating for months now. I think it was like last summer, I remember writing about this. It might have been in July or August when we had this initial plunge in consumer sentiment. And, consumers were blaming this on inflationary forces. And, since then, we've gotten nothing but worse than expected inflation data, and consumer sentiment has continued to deteriorate. But the hard data has been telling us that consumers have been spending increasingly so through that entire period, all the way into January, when we just had, the height of the Omicron variant causing all of these disruptions. And not to mention the fact, January coincided with a month where we're getting all these reports of inflation hitting, 40-year highs. And all that has to do with the fact that consumers are just much more healthy from a financial perspective.
Yeah, I'm just looking at the numbers again from this morning. Personal spending up 2.1%, even as personal income was flat, although it was expected to decline. So I guess all things being equal, it was maybe better than estimated, Sam.
Right.
So, yeah.
Keeping in mind that, during the early parts of the pandemic, there was no, as all this stimulus and people were still working, as all of this was happening, there weren't a whole lot of options to spend, during the early parts of 2020. So consumers are still sitting on a tremendous amount of accumulated excess savings that they can continue to tap into.
All right, we'll leave it there. Our friend Sam Rowe from Ticker.co, always good to see you. I'll check you on Twitter. Have a great weekend. All right, straight ahead, how will the situation between Russia and Ukraine impact deal making on Wall Street this year? One top deal maker joins us next with her take, so stick around.
Global deal volume topped $5 trillion last year. But as we get into 2022, well, obviously we've seen a big uptick in market volatility. Does that mean a rocky road for M&A as well? Elizabeth Crane is joining us now. She is COO and co-founder of Moelis & Company. Good to see you, Elizabeth. Thanks for being here. I want to start with the sort of most front of mind, perhaps, obstacle to M&A, and that's what's going on in Russia, Ukraine. And I just wonder, among the clients you're talking to, among the folks that are considering deals, whether they indeed see it as an obstacle just because it creates that short-term uncertainty.
So good to see you, and thank you for having me on. I think it's really too early to tell. Our clients are global businesses, and while their exposure to Russia or Ukraine is probably de minimis, they are certainly may have exposure to Europe and beyond, exposure to oil prices, and sort of there will be an impact to consider. They will consider their their next transaction in light of the overall market environment and overall volatility. But what is happening right now, these last couple of days, I think it's really too early to say how that will ultimately play out.
I've been hearing from a lot of folks on deals, Elizabeth, that there's likely to be a pause until the second half of this year, until companies get more clarity, more insight, not just into the geopolitical situation, but also Fed policy. Is that what you're hearing as well?
I think that what we're seeing is those underlying trends that I think we've talked about in terms of credit availability, the availability of capital on the part of financial sponsors to deploy, the desire to use M&A to drive business strategy and transformation. That is still very much in place. And we have many transactions that are underway where we are sort of midstream in those transactions. We're not seeing that really let up. I do think these headwinds from the geopolitical environment, volatility, antitrust, and the focus on antitrust certainly can have an impact, may have an impact. But we're not seeing a complete let up at this point in time.
And we were just showing some of the trends you expect on the side of the screen there. I want to pick up on the mega cap deal point, that you expect more larger deals this year. What is driving that trend?
Well, I think what's interesting is companies are continuing, as I mentioned, they're looking for M&A to drive that transformation, to drive enhanced resiliency, and coming out of a 2-year pandemic where business models have really been tested. So I think we are seeing that. I think we're also seeing in the news, this heightened focus in some sectors on larger cap deals from an antitrust standpoint. And what will be interesting to watch is, do boards and do executive teams, if they don't believe they can complete a transaction, will they launch it? So I think there may be some headwinds from that, or some tension with respect to the regulatory environment.
It's been a bit of a weird year in terms of tech deals. You had Microsoft making its play for Activision Blizzard, but then you had earnings season for a lot of these big cap tech companies, and the stocks have been hammered. What's the mood out there in tech land when it comes to just getting any form of deal done?
So I think what we are certainly seeing from a technology sector standpoint is, with the market volatility, emerging companies are really reassessing whether or not they're going to access the private market, the public markets, the IPO market. So that is creating opportunity for sell side mandates. On the other hand, when you have an environment where there has been a sell-off in valuations, the way we've seen in technology, and that mismatch of perhaps expectations or valuation expectations between buyers and sellers, that makes it more difficult to price a transaction. And we may see with larger transactions in the tech sector that it's going to have an impact on that activity in the near term.
You've mentioned antitrust a couple of times, and it's definitely been more of a topic. Just this morning, there was a story in the Wall Street Journal about United Health Group's latest transaction being potentially under scrutiny from regulators. Is in your discussions with folks, is it enough that they are not making the offers, or are people sort of taking their chances, making the deals, and then letting the chips fall where they may?
Well, I think companies, executive teams, and boards do not want to undertake an offer if they don't have confidence they can get it done. So I think they will look at this environment and really assess whether or not they're going to proceed or pause for a period of time.
There's also been a lot of, and I think this started late last year, but it's continued into this year, carve-outs, corporate carve-outs, where a lot of large publicly traded companies may not be getting the valuations they want. So they're looking to spin off or just get rid of businesses that might have more value in public markets. What's the outlook for those type of deals?
I think companies are looking at their core businesses and their areas of strength and responding to this environment to reinforce, growth areas and their fundamentals for core businesses. So we would expect to see that activity continue. And I think when you look at going back to sort of financial sponsors and the availability of financial sponsors to deploy that capital and transact, we're going to see, I think, a heightened interest in some of those spinouts.
Elizabeth, thanks so much for your expertise and your outlook here. Elizabeth Crane is COO and co-founder of Moelis & Company. Appreciate it. We're going to take a quick break. When we come back, a major U.S. bank getting rid of overdraft fees. It's the largest one to do so. We're going to tell you which it is when we come back. Well, Tesla CEO Elon Musk and his brother are under investigation by the Securities and Exchange Commission over allegedly violating insider trading regulations. That's according to the Wall Street Journal. Officials expressed concern that Musk might have told his brother that he planned to ask his Twitter followers about selling Tesla stock, leaving his brother, Kimball, to sell over 88,000 shares just a day before the November 6th tweet. This investigation would add to a years-long feud between Musk and the SEC. It started back in 2018 when the SEC took action against Musk for tweeting about taking Tesla private. Citibank will become the largest bank so far to eliminate overdraft fees. The bank announced that it plans to remove returned item fees and overdraft fees by the summer. Citi was the worst performer out of the largest banks after making this announcement yesterday. Other banks have already made the move to eliminate overdraft fees, including Bank of America and Capital One. And the Biden administration made another attempt to crack down on corporate consolidation. The Justice Department soon to block United Health's $2 billion acquisition of Change Healthcare, arguing that the deal would limit competition in the healthcare system. United Health defended the deal, saying the combination would increase efficiency and reduce friction in healthcare, producing a better experience and lower costs. Sas?
Bitcoin prices are rallying back into the weekend despite Russia's ongoing invasion of Ukraine. Yahoo Finance crypto reporter David Hollerith is here with an interesting story he is tracking. So, Davis, walk us through this. Crypto donations appear to be flowing into Ukraine, correct?
That's right, Brian. Crypto assets in the last 2 days have been flowing to the Ukraine at a surging rate. We've seen about $4 million in crypto assets go to NGOs and other sort of volunteer groups. And the idea is that it will eventually make its way to the military, to the Ukrainian military, to sort of pay for medical supplies, sort of support kind of things like that. But the real interesting thing here is that the Ukrainian military cannot directly accept cryptocurrency payments right now. So there's a little bit of a sort of change that needs to happen at a legislative level. We'll see how quickly that is. Ukraine has sort of been pushing to adopt cryptocurrency more broadly, but the donations have been coming actually since back in August. But they were coming in much smaller amounts. And the last 2 days, it significantly ramped up. And this is being tracked at a live rate by the blockchain analysis company Elliptic.
Very interesting. I'm going to take, that's a fascinating story. I'm going to take a little bit of a hard turn to another interesting story, David, in the cryptoverse that caught my attention yesterday. And that's Senator Ted Cruz apparently giving a pretty fiery speech in support of crypto at the CPAC conference. And that seemed to be causing some waves in the crypto community. Can you tell us about that?
Well, Julie, one thing I can say is that, we've seen a ton of politicians sort of adopt cryptocurrency as a pretty important issue on their platform, especially as they sort of move towards re-election or something like that. And so, whenever this is seen, it's mostly been by Republican candidates as opposed to the Democrat side. And that doesn't mean necessarily that Democratic candidates aren't interested in it, but we're seeing more on the Republican side. And sort of, I think that might have to do with sort of who the critics and proponents have been in Congress and sort of the loudest voices, if you will. But Senator Cruz has come in with some pretty interesting language yesterday. Just sort of out of hearsay, a lot of people sort of talk about who is like a good representative for Bitcoin or cryptocurrency in terms of like, helping it sort of reach more acceptance by sort of mainstream investors. And there's been plenty of talk around that. And I think that the one thing about something like Bitcoin is that it's completely decentralized. So when you do see a politician coming on and sort of taking it and promoting it, it has very little to do with what the technology actually, fundamentally what it represents, because, no one sort of, it doesn't have a political opinion, if that makes sense.
Indeed it does. David Hollerith, thanks so much. And before we head to break, here is your Yahoo Finance stat of the day. Since 2009, there have been 24 other periods where the S&P 500 has pulled back more than 5%. Each of these pullbacks came with bad news, of course. Once stocks found their low, the average rebound over the next 5 months was 19.8%. Source for this factoid is Truist Co-Chief Investment Officer Keith Lerner. And we'll be right back.
Well, Russia's invasion into Ukraine has been causing ripple effects across the globe, as we have talked a lot about. What about business actually in Ukraine? I want to bring in someone who has experience in that area as well as broad experience in tech investing. That is Charles Phillips. He's managing partner and co-founder of Recognize. And Charles, there's a lot I want to talk to you about, but I think we do have to start with Ukraine because your first investment as part of this newest venture of yours is called Cyclum. It is a cloud-native digital engineering firm, and it's got a big presence in Ukraine. So what are you hearing from your employees, and what do you see the company do in a situation like this?
Yeah, good morning. As you can imagine, it's a pretty complex situation. And so Cyclum is technically headquartered in London, which is where the CEO and the CFO are. But you're correct, there's about 3,000 engineers, software engineers on the ground in the Ukraine. And I've been over there in the fall, in October. One of my partners just returned from there, and we're doing daily calls with people on the ground there. And so I think near term is the safety of all the people. That's our biggest concern. And we're moving people to areas that are easiest and most logical to go to, Bulgaria and Poland. We're able to get visas. In some cases, you don't need visas. But more importantly, I think we're looking at kind of what's the long-term trajectory of the business as well, and how can we preserve those jobs in the business and help people transition. And these are very resilient people. People who don't know Ukraine, it's a very fertile area for software engineers. The Russian space program used to be there for years, and so they're great engineers. Many IPOs have come out of there, out of the Ukraine-based engineering. And so we're moving some work to other locations. This is software development on the internet, and it's cloud-based, so it's somewhat easy to move work around the globe. So that's another option we're looking at right now. The clients have been fantastic. They want to support all the Ukrainian companies in the tech sector for a lot of different reasons. And so we're working through it as we speak, and obviously it's an unusual time period.
It is a very unusual time period, and it's also sort of very early in this unusual time period. It still feels like we don't know what's going to happen in the coming days, weeks, months. And so under that situation, do you operate under the assumption that these folks are going to have to be outside of Ukraine for some period of time and that you have to set up sort of alternative infrastructure?
Yes, some people will be outside of Ukraine. Not everyone wanted to move. There's different reasons. People have allegiances to the Ukraine. They have family there. They own homes. Some have extended family. So not everyone can leave. But for the people who are, we are arranging for them to kind of have a long-term stay if need be. And we're funding that and bringing their families as well. So who knows how long this will last and when they can return and if they can return. So we will figure it out week by week as things change.
You sit on some very prominent boards. I think we should large companies known around the world. What are some of the biggest challenges inside the boardrooms at these very big companies outside of the situation going on between Russia and Ukraine?
So Viacom CBS is of course now Paramount. So just get that out there, the new name. I would say it's less impactful for some of those companies, although you'd be surprised at how many companies have contractors who are based in the Ukraine, because you have to go where the talent is, whether it's India, the Ukraine, or Czech Republic. So that's not unusual, but it's not a material event for them. The more prominent issue for the larger companies right now is just talent and inflation. Those are the two things that we're dealing with. It's more expensive to hire people. Even if you can hire them, it's hard to retain them. And some of them don't want to come back to work yet. So it's that whole talent inflation issue.
And, this is a good, I think, companion conversation to the one we were just having with Elizabeth Crane of Moelis a few moments ago, because we were talking about the M&A environment right now. And I think we can also talk about the sort of VC and tech investing environment from your perspective, how it's being affected by talent inflation and also market volatility. And so I'm curious, as you're looking for new investing opportunities, how all of that is playing in. Is it tougher right now to find those opportunities?
Well, I would say there's a disconnect between the public markets and the private markets. As the public markets are gotten more volatile because of inflation, it takes longer for the private markets to adjust to that. And sometimes it doesn't happen. Right now, I would say the valuations are still pretty solid, holding up well, and we're finding companies, but it's still competitive. We have a pretty big sourcing engine between myself and one of my co-founders, Frank D'Souza, former CEO of Cognizant. We've had almost a couple million people work for us over the last 2 decades. So we have a pretty good sourcing network. There's not a lack of companies to look at, but the competition on the valuation is still significant right now. And all these private equity funds have plenty of cash. As you know, they had a banner year last year, over almost 4,000 exits last year. The distributions were phenomenal. So they're all raising even more capital this year. And so all that capital floating around in the private markets makes valuations still at a premium.
And that's so fascinating to me, because obviously then we're seeing sort of a disconnect, right, from what's happening in public markets. Is that something that is typical, and how long do you think that can persist?
It is typical that the two markets can diverge for some period of time. Remember, most exits today in private equity aren't to the IPO market. They're to other strategics. They're to other private equity firms. So it's a somewhat contained market, and some portion of that anyway. So those valuations can stay there for a while. If this continues, though, the same trends that are affecting the public market, i.e. higher talent cost, inflation, and to some extent, a tougher IPO market starts to seep in over time.
Charles, finally, I want to ask you, because it's still Black History Month here, although obviously we like to talk about these issues all the time. You helped found something called the Black Economic Alliance. And I guess what I'm curious about is we're sort of now some months from the height of attention on diversity, on Black Lives Matter, et cetera. What are the conversations that you're having right now? Is it still sort of front of mind for people? And do you think that we're sort of moving the needle in the correct direction?
It may not be as prominent in the news because there's been no, visible event like that happened. But I would say it's still certainly a prominent topic in boardrooms, and companies have continued to try to make progress in this area. I've been encouraged by that, actually. And so one of the most visible efforts that I've been involved in, along with Ken Chenault from American Express and Ken Frazier from Merck, is a project called 110, hiring 1 million Black people over the next 10 years. And we have about 62 companies that are committed to helping fund that and doing that and hiring people. But more importantly, they're hiring people who don't have college degrees. So that's the issue. Something like 75% of Black people do not have a college degree. And so if you don't include them, you're not really moving the needle. So we're getting them other skills training for them to participate. And the companies are actually doing that, committing and hiring people right now. So on that one project, it's been about 25,000 people hired under that program in the last 4 months. And so we are, of course, tracking the commitments that they've made. The companies want to do the right thing. And by the way, they have a shortage of talent, as we've talked about earlier. So they need to do this anyway. This is good for businesses. This is not just some social program for them. This is something they need to do to kind of fill those open slots.
Charles, really fascinating there. And we got to leave it there. But I do want to follow up with you and talk with you more about that issue in particular. There's just too much to talk to you about. Charles Phillips, thank you so much, managing partner and co-founder of Recognize. Appreciate your time this morning.
Thanks for having me on.
Thank you. Before we head to break, just want to take a look at some of the trending tickers we are watching and that you're watching on the Yahoo Finance platform this morning. We've talked about most of these except for Foot Locker, down 34% today. We'll touch on that next. Well, we just saw Foot Locker. It's down 34.5% today. You can blame, at least in part, perhaps Nike. Nike doing a lot more direct-to-consumer sales, and Foot Locker saying no single vendor now is expected to represent more than 60% of total purchases this fiscal year. Last year, that number was 70%. In 2020, it was 75%. And so Foot Locker is now forecasting profit and comp sales below expectations for this current fiscal year, which ends next January. Brian Sozzi, that is quite a tumble in those shares.
It's an unfortunate, and this is a bad look, I would say, by Nike CEO, still new CEO, John Donahoe. Foot Locker has worked very closely with Nike for decades, for a long period of time, to cultivate a strong relationship with this company, to better, I would say, renovate their stores to support what Nike has done, and in turn, it really has become a good destination, or the top destination for kids, for adults to go for Nike products. And I understand Nike wants to come out here, broaden their distribution, but at the end of the day, we do not think about buying our Nike shoes from Nike.com. We don't care. We want to go to the mall, we want to go to Foot Locker, we want our shoes, and we want to get out. So this is a bad look. I think Foot Locker's done a good job managing that Nike business, and they deserve to be treated a lot better.
I mean, speak for yourself, Saz. A lot of people, just like, they know what shoes they want, they know what size they wear, they go on Nike.com. I mean,
well, you go to footlocker.com. You go to footlocker.com too. So for Nike to sit here and it's what looks to be pullback merchandise from the top shoe retailer in the mall in the country, to me is ridiculous.
Doesn't Nike have to do what's best for Nike? It's not in It's not in the business of. I don't know. I'm not getting your position here. Nike's it's a company that's in it to make money. It's not in it to make sure. I don't know. We'll take this offline. Maybe we have to get an
say it
opinion
offline. I can't get hot. The lights are hot
Okay.
here on the Nasdaq. I can't get fired up. I can't do it. Please, just keep going.
Your dial is always at 11. We know this, Brian Sozzi. All right, we got to leave it there, both for timing purposes and perhaps for Brian Sozzi's health. And we want to show you markets one more time before we let you go. And we have stocks at the highs of the session. Look at that. The Dow is now up 1.4%. The S&P up 1.25%. Nasdaq up 0.7% right now, as we see a real comeback going on this Friday. Interesting. We'll see if it holds through the close, because people sometimes don't want to be long into a weekend, especially a weekend where you have global events going on. But we'll see what ends up happening. Keep it right here. Kiko and Brian are going to take you through the next 2 hours. We'll be back on Monday.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are 90 minutes into the trading day on this Friday, and we are seeing stocks edging higher after that sharp rebound that we saw in the session on Thursday. The Dow is now up more than 400 points, the Nasdaq up 67, and the S&P 500 up 44. Stocks gaining as Russian state media reports President Vladimir Putin is ready to meet with Ukrainian officials for negotiations. On the ground, though, Russian forces set their sights on the capital city of Kyiv, with gunfire and bombings intensifying. Bitcoin is bouncing back alongside equities, moving above that $39,000 handle, but still well off of its highs. We're going to be talking to one strategist who says Ethereum is the better buy in the face of conflict in Eastern Europe. And a slow start to the tax season, dragging on shares of Intuit, pushing lower here in the session. The company behind TurboTax falling on lower guidance. We've got a conversation with CEO Sasan Goodarzi up ahead. We're going to begin yet again, though, with the Russian invasion of Ukraine, with Russian forces reportedly closing in on the capital city of Kyiv. Kyiv, as Ukrainian military vehicles also entering the city to defend against any attacks. There have been reports of gunfire erupting in several neighborhoods, while aerial images show Russian bombing intensifying. The European Union is reportedly preparing to freeze the assets of President Vladimir Putin and Foreign Minister Sergei Lavrov, with an approved sanctions package expected today. Meanwhile, Russian state media is reporting that the Kremlin is prepared to send a delegation to Minsk for talks with Ukraine. This comes as Chinese state media says President Putin spoke with China's President Xi Jinping, telling him he is willing to negotiate with Ukraine. And Brian, of course, we're tracking all of those geopolitical headlines alongside the market action. A wild swing yesterday into the close. At this hour yesterday, I think we were down about 600 points, even more, and yet we saw things close, or claw back, I should say, going into the close. And here we are today talking about the Dow up more than 400 points.
We were, and you can see the bounce back that we've been getting so far. When you take a look after the numbers that we had gotten from inflation, at least, personal consumption expenditures coming in 6.1% year over year in January. When you strip out food and energy components, it did grow by 5.2%. But take a look at how the markets are responding. Take a look at the Dow Jones Industrial up 1.5%. Take a look at the S&P 500 up 1.25%. Obviously, there's a lot going on here. Even though the Nasdaq, for example, not getting as much of a bounce back, only up about 0.5%. But something that I'm watching closely is the Nasdaq 100. This is very interesting because if you take a look actually at a 4-day chart of the Nasdaq, take a look. That basically recovered the losses that we have gotten. Heaviest parts of the Russian
Brian, your connection is cutting in and out right now. We're going to try to see if we can get that reestablished there. But let's talk about what's playing out on the geopolitical front. President Biden announced tough new sanctions on Russia yesterday, blocking off 4 additional banks, including VTB, Russia's second largest financial institution. The White House also implemented a ban on selling U.S. semiconductors to Russia. This was accompanied by a slew of additional restrictions that were placed on Russia alongside European allies. And as we noted at the top of the show, the EU now looking into freezing the assets of Putin and Foreign Minister Lavrov. Let's bring in Maximilian Hess, Foreign Policy Research Institute Fellow. It's good to talk to you today. Give me your assessment of where things stand right now, the sanctions on the one hand and the military action on the other.
Thank you so much for having me. On the military action, there are Russian troops already in Kyiv. That has been confirmed. It's unclear if they're diversionary groups or an actual front, but the Ukrainians have managed to hold on for quite a bit longer and inflict a lot more pain on Russia than many initially thought. However, a large amount of Russia's firepower, including its heavy technical units, remain in reserve. So that situation very much could escalate. As for Russia's offer to have talks, it quietly swallowed up Belarus. Minsk is no longer a neutral territory, and its demands are frankly egregious and not survivable for any Ukrainian government. So far, I don't think we're there. On the sanctions front, this is really the first major salvo in Biden's threatened package. He had made it quite clear what sanctions would come against Russia if it took this action, and has been fairly effective at coordinating with the European Union, although now that it's actually happening, there's been some pushback from Europe on some of the key measures. What I would note is there are key carve-outs in these sanctions, licenses from the U.S. Treasury Department for dealings in agriculture and energy commodities. So those leave a quite gaping loophole that will mean these don't really have the full impact they have now. But the Biden administration has been signaling that it will close those and tighten sanctions even further if the conflict continues. I think the markets are really in a lull right now, and this could still become a major economic war with huge impacts.
Specifically on the sanctions on the big banks over in Russia, the president yesterday was pressed on why, in fact, the U.S. wasn't taking that extra step in cutting Russia off of the SWIFT payment system. He replied saying, number one, Europe isn't unified in it, but number two, the sanctions we put in place now are going to be much more effective. Do you agree?
So if one takes away those treasury licenses, then yes, because the key business these banks do, they no longer really borrow as much financing from Western capital markets as a result of the 2014 sanctions, but their role in the plumbing of Russian oil, gas, commodities trading, and its government debt payments, those are really critical. The licenses largely allow those to go through. If those licenses are withdrawn or circumscribed, then yes, effectively these sanctions, in particular the targeting of another Russian bank, VEB, but VTB as well, those will effectively have the same impact. And so we could get there, but it's not there yet.
Max, it's Brian Chung here. We've been hearing some kind of commentary about China wanting to get involved here and possibly wanting to talk with Russia about a possible resolution before things escalate further. How important do you think Xi is to what we're seeing develop there?
China is hugely important for Russia's attempts to move away from the dollar system, which have been largely ineffective, only settling rather than actually contracting things in alternative currencies. China is the only one who can really give them that alternative with the cancellation of Nord Stream 2 and the upcoming Power of Siberia 2 pipeline being discussed. Those are really where Russia's alternatives are in the future, and China has a lot more political weight. I would say it's been interesting comments so far from Xi and the Chinese Foreign Ministry. I wouldn't try to speculate myself as to exactly what they're thinking, but they seem to be reaching a position that says, we'll go along with you, Russia, for now, but this can't continue and go further. China is Russia's partner, but it's not an ally, and we often forget that.
The big question here is still, what is the end game for President Putin? It sounds like you're a little skeptical about these Russian state media reports about President Putin willing to have talks with Ukraine, but you did make that comparison to what has played out in Belarus, which is essentially a pro-Russian government. Is that what President Putin is seeking at this point? Essentially removing Vladimir Zelensky and putting in a government that is willing to toe the line for Russia?
For Russia, even more than having a pro-Russian government, while that would be nice, it might not be sustainable. Ukrainians have had years of a Western agenda, and many Ukrainians are dedicated to that. We've seen how many have taken up arms. Zelensky has offered up the arsenal to Ukrainians willing to volunteer to fight for their country, and there's a real risk of a counterinsurgency if that kind of situation happens. The sad reality of it is what Putin wants, probably even more than that, is for Ukraine to be a failed state, so that for anybody domestically within Russia, a pro-Western democratic agenda seems something that brings disaster and destruction and is therefore not so attractive.
And finally, it does feel like the White House is really trying to find this balance in imposing sanctions, on the one hand, inflicting pain economically on Russia, but also being mindful of the economic impact that's likely to have on European allies. Does that limit the extent to which the White House is willing to go? And is that sort of why we're seeing President Putin move in this way, his understanding that the U.S. will only go so far?
You know, I think Putin is willing to accept even far more drastic sanctions than we have now. He essentially has realized that there is no more future for him with the West. That's as a result of his own actions, not necessarily the West's. But we saw this there was his a very well publicized press conference a few days ago where he brought together a bunch of government officials, but he also brought together Russia's oligarchs yesterday and sat them all down for a lecture, essentially said, I don't care what happens to your businesses. If you do anything to step out of line, consider the rest of those businesses that aren't already mine. So, I think in some ways he really is choosing to draw a new iron curtain around Russia and as much of Ukraine as he can grab hold of.
Maximilian Hess, Foreign Policy Research Institute Fellow. It is good to have you on this Friday. Appreciate the time. Let's turn our attention back to the markets. As we said, we have seen a significant turnaround in equities, with the rally gaining momentum here in this session. The Dow now up about 520 points. Want to bring in Ann Berry, Wheelhouse Chief Investment Officer, and explain this turnaround we've seen. I mean, yesterday we were talking about the big sell-off in response to the Russian invasion. Now we're talking about a rally up more than 500 points. What do you make of the turnaround?
Yeah, it's almost inexplicable. It's a tricky one to try to unpack. I think there could be a couple of possible factors going into explaining a little bit of this perplexing upward trend in the US markets this morning. I think one of them could be that the Fed perhaps, instead of raising rates as much as 9 times, which has been speculated, perhaps will dial it back a little bit because there is this uncertainty, and perhaps will look to see what happens in coming weeks and months before deciding to have a more aggressive stance on rates. That's factor number one. Factor number two, I do think that China is perhaps, needs to be confirmed, trying to encourage talks between Russia and Ukraine, is something that perhaps the market feels will be able to temper some of the aggression that's being seen. And then the third piece of this also is the fact that really, when you think about the most effective sanctions here, they're going to have to be driven by Europe. And so I think you're seeing some flight to quality, flight to the US markets from international flows as well. Speculative, 3 hypotheses, really tough to unpack in this market.
Yeah, and it does beg the question about, whether in fact geopolitics, this being a very specific case, but when you think historically, they haven't created a significant overhang for stocks. We've had a number of guests on this week who say at the end of the day, it is still about Fed policy, with investors eyeing that March meeting. Is that how you view it?
I think it's partly true, but I do think this is slightly different. And the reason I think that is there is one view of this, which is the world is going to be watching to see what the US does response into Russia. In order to understand whether there's then risk of China moving on Taiwan. That's a massive geopolitical play. And so I do think that there's a lot more to unpack here. Typically, yes, there hasn't been long-range geopolitical overhang, but the short-term pain has tended to be really quite painful. One place where we saw huge political volatility was during the trade wars with China, which the Trump administration initiated. Ultimately, the markets went up anyway, but the roller coaster that happened in response to very small pieces of new information for an 18 to 24-month period, I think that's something that we all need to be ready for, because there's just a ton that the market doesn't understand and can't see right now.
And you mentioned the possibility of more international exposure. I know that some of the thinking here prior to this invasion was that European equities offered some good opportunities, largely because of evaluation, but also because of this expectation of the economy bouncing back. Does this change that completely? And if so, would you advise investors maybe to look more to emerging markets like China for potential opportunity?
Well, I think Germany is a good case in point. So the German leadership has actually publicly come out in response to the situation in Ukraine and said, effectively, Germany's going to have to learn to live with fewer gas and oil imports from Russia. We saw the Nord Stream 2 pipeline has been halted. That's a major pipeline that connected Germany to Russia to try and support Germany's energy needs. We're waiting to hear from the European Union to see how far the region is willing to go to restrict Russian flows of oil and gas to the EU, one of the biggest energy partners. If the EU is willing to take a tough stance here, there is going to be a struggle to find alternative sources of energy in the short run for that region that's going to have real ramifications for the European nation economies and economic growth outlook. So I would be holding right now on redeploying capital as an investor to that region in the public markets to wait and see. I would not be sending money right now, to be honest, to other emerging regions. We need to see how this shakes out. We need to see how supply chains respond to these shifts in where we can see flows in goods and services. We don't know the full extent yet of what these sanctions are going to look like.
So where do you think investors should be deploying some of that cash if it's not over in Europe, not necessarily in EMs? Is it about just U.S. equities at the end of the day, or a better mix with bonds potentially?
Well, we're seeing the movement into bonds. We've seen bond yields go down, and that's a reflection of the flow of capital that's been going in the last couple of days towards bonds, driving up prices and yields down as a result. So I think we're already seeing that. So we've got a lot of folks who are holding cash. I do think, again, it's part of the reason we're seeing the rally in the markets today. I do think there is a flow of flight to quality capital to the US markets. We'll have to see in terms of flows of capital also to Japan, flows of capital also to the UK. You know, we're talking about the G7 economies here. I think those are the markets I'd be watching as well.
And Barry Wheelhouse, Chief Investment Officer. Always good to have you on the show. Appreciate you stopping by. Coming up on the other side, shares of Etsy are surging on strong earnings. We're going to break down the numbers on the other side of this break. We'll be right back. Welcome back to Yahoo Finance Live. We are continuing to keep a close watch on some big movers in the market as we see a broader rally taking shape on this Friday. Let's start by taking a look at Coinbase, and you see a steep loss there in terms of shares, a steep decline, I should say, down about 1.75%. Coinbase did beat on earnings and revenue in a big way, posting revenue of $2.5 billion compared to the $1.9 billion expected. But shares are moving on concerns about this current quarter. And Brian, when you look at the numbers, monthly transaction users were up to 11.4 million in the quarter, but it is expected to come in lower, at least according to the company, quarter on quarter here. And Coinbase saying essentially, look, it is about trading volume and also the declining market cap for crypto as a whole.
I mean, first of all, that's a massive jump, right? From 7.4 million in the third quarter to 11.4 million. So it's no surprise that the industry is already saying, look, we may have reached a peak, at least for right now, in terms of the amount of people that are going to be using our platforms. But I think more interesting than just the count of people that are using Coinbase is really the macro environment in which people might be interested in getting into crypto. I think it was management on the call saying that there could be a crypto winter, essentially a bear market where, honestly, there could be a lot of pain for people that are hodling coins, at least in the short term. And we've already seen that when you consider Bitcoin, for example, in the later parts of last year at 65,000, I think it was. And now, obviously, it's been far below that, around 39,000, at least as of this moment. So I think that we need to consider cryptocurrency hasn't necessarily endured a bear market in its history, at least not at the stage of adoption that it is right now. Even the last time the Fed was hiking rates in 2015, crypto was much, much smaller than it is today. So I think that this is something that we've never seen before. The kind of thesis that's out there about whether or not you use Bitcoin to hedge against certain types of macro headlines is very much a thesis that's uncertain. And I think that as a company that really relies on people trading crypto, Coinbase is just along for the ride, as is a number of other crypto industry companies now that they're public companies.
Yeah, with that said, CEO Brian Armstrong on the call sort of dismissing these concerns about a crypto winter coming, saying the use cases haven't necessarily changed despite the price fluctuations. But Brian, if you look at where things have moved, it does feel like there's a bit of re-rating that's happening in that space. And really what we've been talking about over the last few weeks is that they have moved in tandem with U.S. equities, potentially being seen more as sort of in tandem with like high growth risk assets, as opposed to, I think, the narrative that was there, I would say, more than a year ago about this potentially being a safe haven. So something to watch there. Let's take a look at another stock that is moving in the opposite direction, and that is Etsy. That stock is up in a big way in the session, earning $1.11 a share on revenue of $717 million. The company saying 96.3 million buyers are now on the platform as of Q4. We should mention revenue growth did slow to 16% year on year, but when you compare it to last year, that was kind of at the height of things, at the height of one of the waves during the pandemic. And we've sort of looked at the stock as kind of a pandemic stock, just seeing that we saw a huge growth on that. A lot of people staying at home, people going on the platform to try and add additional income too. Our morning team did have a chance to speak with the CEO of Etsy. Take a listen.
If we remember 1 year ago, there were severe lockdowns in many parts of the United States and in fact, many parts of the world. And Etsy, it was obviously a huge beneficiary of that, as there were very few other places you could go to shop. This year, the world looks very different. There's no federal stimulus, and in fact, almost every shop is open and operating, and yet people are choosing to come back to Etsy again and again. So maintaining all of the gains that we had from this time last year, we think is a really fantastic signal of the durability of the benefit that we've seen and what we offer to people that makes them want to come back again and again.
Speaking to our morning team today about their most recent quarter. Brian, let's move on to another stock that I know you are watching closely. And this is a steep decline. We're talking about Foot Locker here, moving on news that the company will no longer be able to sell as many Nike products.
Yeah, certainly. And I think what's interesting here is that Foot Locker, the big move here really is contingent on the commentary that we had heard from management that beginning in the fourth quarter of this year, no single vendor, this is according to Foot Locker, will represent more than 55% of Nike's supplier purchases. That's compared to 65% in the year ago period. So essentially these types of distributors, and it's not just Foot Locker, right? These are all of the other kind of third party brick and mortar stores that sell and distribute Nike products will no longer be having as much of a share of the pie now that Nike is really leaning into that direct to consumer aspect here. It's very interesting because Nike, obviously I pay attention very closely to that company, and just the sneaker space broadly, has realized that the mall model of these types of distribution just no longer are adequate. And I think that makes sense. If you rewind to the early 2000s era, where there was a Foot Locker and a Foot Action and a Champs Sports and all these other types of stores, like a Finish Line in the same mall, you didn't need to have all of that. It was redundant. The same pair of Nike Cortezes that were being sold on the east wing of the mall were the same pair that were being sold in the west wing of the mall. So I think that we need to just consider that this is part of a secular trend that we've already been seeing. What's interesting is apparently the investors in Foot Locker just didn't see it coming until the retailer itself kind of finally admitted that stone is starting to turn. But again, we'll see if other shoes drop, pun intended, happen on that side of things as well, Akiko. Definitely worth watching.
Brian, we can't have this conversation without acknowledging the sneakers behind you, right? How many of those did you buy at Foot Locker?
Now
I
I
want to say
think
zero.
about it, only one. This one, the Air Max 97s, I did buy at a Foot Locker, but other than that, yeah, a lot of them were direct from the maker themselves. There you go.
A lot of people watching, Brian. I'm surprised how often people watch.
I know
to
they've
see,
been wondering.
They notice when you swap out the sneakers there. I don't know if that's why they're watching, but worth noting there. Again, we're talking about Foot Locker right now. Shares there down significantly as we get that news on their ability to essentially carry Nike products. Coming up on the other side, Intuit is in the red after reporting earnings that missed expectations. We're going to speak with the CEO on the other side. We'll be right back. We are watching shares of Intuit, the parent company of brands, including TurboTax and QuickBooks. Shares there down about 2.4% on the back of its second quarter earnings. The company missed estimates on earnings per share while revenue came in line. But Intuit seeing solid year-over-year growth following the acquisitions of both Credit Karma and MailChimp. Here to break it down all for us is the CEO of Intuit. We've got Sasan Goodarzi joining alongside our very own Brian Sazzi. Sasan, it's good to talk to you today. I want to see if we can move the conversation forward because you did reiterate your guidance for the fiscal year. You actually guided higher on the quarter. Seems like the stock is moving on the back of the latest report, but I wonder how you see the momentum shifting as we go into the height of tax season.
Yeah, sure. Well, first of all, good morning. Thank you so much for having me. In context of your question, first of all, we reiterated the guidance for the year, which we actually raised in the first quarter. And what we reiterated was that we would grow revenues 26 to 28%. And we have great momentum across the company. In fact, in Credit Karma and small business, we had record quarters. And really what we saw in the second quarter is just a shift of tax revenue. And it's primarily because consumers are just filing their taxes a little bit later in tax season. This has actually been, really happening for the last, 10 years. And the great news is everybody will file their taxes by April the 18th. So it is simply a shift. And based on our early analysis, we are actually taking share, which we expect to take share. So we feel very good about the momentum across every segment of the company.
Sasan, Brian here. This is the second straight quarter. I would say I heard you guys talk more about what you're doing for investors, helping them file returns or what other services that might need. Have you thought about building out a trading platform or acquiring one? We both know you've been very acquisitive the past 2 years.
Well, yes. Well, first and foremost, you're absolutely right. We actually, about 3 years ago, before the significant increase in a number of just digital natives that are doing trading on their own across the globe, and of course, a huge piece of that is also crypto, we really decided to declare this as a focus area and revamp our experiences and ultimately ensure that we have the right experts that can help those that invest, especially at tax time and then over time, with financial advice. With respect to, trading capabilities, for us, what's most important is truly our mission around powering prosperity around the world. We want to be thoughtful that if we enable trading capabilities, that in no way, shape, or form do we enable what may seem sometime like gambling with your money, especially with crypto assets. And so there are so many trading capabilities that are out there. And so we're always thinking about, do we do it through partnership? Does it need to be on our platform? Or do we really just help people with understanding not only advice on how to think about investing, but also ensuring that we are there for them throughout the year and particularly at tax time. So it's something that we're continuing to think about. But the thing we want to stay away from is really people playing with their money. What we're really focused on is ensuring that people are educated and to make good decisions to really power their prosperity and enable their financial freedom. Education on this topic is really important.
Hey, it's Brian Chung here. I want to shift to other brands that are a part of your holdings now. MailChimp, obviously a big focus. You were talking on the earnings call about acceleration priorities with MailChimp, which could involve integration with other brands, like, for example, QuickBooks. Can you tell me a little bit more about that?
Yeah, absolutely. First I'll start with the small business customer. What's most important to them, two of their biggest needs are, one, being able to find and keep customers. And the second is really cash flow. Those two reasons are why 50% of small businesses actually go out of business after 5 years. And so we ultimately want to reverse that. By the way, if you're on our platform, we actually increase the success rate of that by about 20 points. And so the whole nature of MailChimp is we want in one place for a small business to be able to grow their business and to be able to run their business. So what that means is really helping them market their business, use our CRM capabilities to be able to manage their existing customers, be able to do experimentation online, which many small businesses can't do, but they can now with our platform. At the same time, give them the ability to be able to run their business, which is where all the QuickBooks capabilities come in. And so we are working to integrate the platforms. So MailChimp and QuickBooks capabilities are really serve as one for small businesses so we can fuel their success. And that's really where the acceleration priorities that you mentioned come in. We have three of them. One, it's to create a growth platform. Two, it's actually to go up to mid-market to serve small businesses between 10 to 100 employees. And then international, 50% of MailChimp's customers and revenues outside of the US, they have a wonderful self-serve platform, but they've not actually invested a lot internationally. And we believe that's an area where we can double down. So those are the three priorities where we believe it will serve as fueling the success of small businesses and ultimately the growth for the company.
Let's talk about back to tax season, because we had a guest on yesterday who was talking about just how constrained the IRS is right now. I think his words was that he hasn't seen it this bad in many, many years. I wonder how you're looking at that, the potential for delays, and what does that ultimately mean from Intuit's perspective? Certainly a lot of Americans are going to be going on using your software to file. What do you see on that front? In what's the impact to your company?
Well, first and foremost, we truly focus on owning the whole experience for consumers, which means we have a very close partnership with the IRS, just to ensure that at the end of the day, the customer can get their maximum refund, get it on time, and understand all their deductions. And so one is just a close partnership with the IRS. I would say two, you're absolutely right. The IRS has been, really overwhelmed to try to serve consumers, both from an administration perspective of the refund or collecting money, but also now they've had to shift to becoming a benefits administrator. When you think about the stimulus checks, when you think about child tax credit, that puts a lot more pressure on the infrastructure of the IRS. And then having to do all of that while they had to work virtually is just very, very tough. So we've just really doubled down on ensuring that our customers understand how to get their taxes done if they choose to do it themselves. If they choose to have access to experts on our TurboTax Live platform, making sure we have experts that can really help them understand the nuances of the child tax credit or how the stimulus checks plays into their, to their tax refund, or if they have to, ultimately owe money. And so we've just really doubled down on our experiences and high communication. We've invested a lot of not only automating communication, but also making sure our experts are there to help them, just to make the experience as smooth as possible for the customers. I mean, other than potentially more contacts by customers, if they don't understand where their refund is, we don't see much implication to our company beyond that, but we're really focused on the customer and really ensuring that their experience can be as smooth as possible.
Yeah, and a reminder to get your taxes done. That day is fast approaching. It's almost March already. Sazan Godarzi, Intuit CEO. Thanks so much for stopping by.
Great.
Coming up on the other side of this break, world leaders are divided on whether to remove Russia from SWIFT. What exactly is SWIFT? We'll explain next. You know, amid all the sanctions on Russia, one that we keep hearing about is a ban of Russia from SWIFT, something that President Joe Biden said yesterday is an option that's currently not on the table, although they could leave that open for debate at some other time. But still, top Ukrainian officials are begging Western nations to block Russia from the SWIFT network, which begs the question, what exactly is it? So class is in session. Let's take a look at the Wi-Fi Interactive, where we've got our handy slides here. SWIFT itself stands for the Society for Worldwide Interbank Financial Telecommunication, which is really the primary comms channel for banks internationally. So it facilitates payment requests and it does the record keeping for the trillions of dollars of funds that slosh around the world, which means if you disconnect them, it's going to be really hard for a bank to settle any payments. So it's going to cripple that country's ability to, let's say, settle payments for exports like oil or gas or metals. And this is exactly what happened when Iran was blocked in 2012 and then again in 2018. Now, some random people might already be familiar with SWIFT, and that's because if you've ever tried to wire money overseas, you may have seen something like this. So let's kind of create an example. I'm based in Hong Kong, and Akiko in Los Angeles owes me a bunch of money. For what reason? Let's just say she had a lost bet, right? Now, she got a bunch of sports bets in, she hit the money, she hit the jackpot, and now she can finally pay me back. How she's going to do this is she's going to use a SWIFT code and then wire the money to my bank. So she enters in the SWIFT code, and then Wells Fargo uses that SWIFT code, let's just say that's the bank that she uses, I don't know that for sure, to contact my bank, HSBC, in Hong Kong, and then they use that communication to facilitate the payment. So think about what happens if, for example, a bank is not able to access SWIFT. Well, it's pretty easy to imagine. You can no longer have your bank communicate to another bank overseas, but that does not mean that Akiko can't get her money to me, right? She just has to get a little bit creative about how to do that. Maybe she's going to use a cryptocurrency. Maybe she's just going to send me a bunch of cash by snail mail in an envelope. Either way, SWIFT is just the messaging provider. It's not the actual payment system itself. And it's clear that because of that reason, SWIFT itself prefers to be neutral. That's how they describe themselves. And SWIFT is overseen structurally by G10 central banks, but they can't make sanctions decisions on their own. They made it clear that, quote, any decision to impose or to lift sanctions on countries or individual entities rests solely with the competent government bodies and legislators. And we can take the Wi-Fi Interactive down now and just kind of chat a little bit about how, in totality, really what this means, Akiko, is that SWIFT is more like a Slack messaging system than anything else. So if it goes down, which we've had that experience before, Akiko, you could just use other methods to get the job done. You could text message, you could have your producer show up outside your balcony and knock on the window. There are other ways to get around this, which is why President Joe Biden may have emphasized that unilaterally targeting certain financial institutions like a Sberbank or a VTB in Russia might be more effective, which is all part of the policy discussions as we continue to hear whether or not Europe wants to get behind a SWIFT ban.
Brian, two questions here. Number one, we're talking about cutting out Russia from the SWIFT payment system, but that also has implications for other countries, which is partly why we have heard German Chancellor Olaf Scholz, for example, push back against that, while UK Prime Minister Boris Johnson has said he wants to take that more aggressive move. Can you help us understand what that would mean for other countries if, in fact, Russia is cut out?
Yeah, well, the example that I had right there, right? If you cut off SWIFT, that means that one counterparty, which may be in the country that's the bad actor, can't facilitate their payment, but also means that the person receiving it on the other end won't get it also, even if they're in a jurisdiction that's not being sanctioned. And that's a big reason why Germany is in such focus, because of their close energy ties to Russia. Even though the Nord Stream 2 pipeline has been halted, we know that there's a lot of natural gas relationship between Russia and Germany. And if that's frozen and ultimately there needs to be payments settled, well, if they ban them from SWIFT, they won't be able to do that. So that's perhaps one reason why Germany doesn't want to take Russia out of SWIFT. And another big reason, too, that we need to remember is imagine if, for example, which a lot of US dollar denominated settlements are done via SWIFT. If Russia's not using that, if they're banned from it, then what do they turn to? Maybe they turn to cryptocurrencies or to the digital yuan. Maybe that disintermediates the US dollar, although that might be a moot point because, for what it's worth, the Russian central bank has already made a lot of efforts to de-dollarize in the years leading up to the crisis.
Yeah, and that leads to the other counter argument, which has been that maybe the impact from SWIFT has been overstated. Of course, still part of the broader debate about whether, in fact, the U.S. and its allies should go for what some have considered the nuclear option. All right, we are off for a quick break, but coming up on the other side, Bitcoin bouncing back. We're going to break down the latest price action on the other side. We'll be right back.
Welcome back to Yahoo Finance Live. Time for our Crypto Corner presented by Intuit TurboTax Live. Bitcoin on the move as markets continue to digest the headlines out of Russia's attack on Ukraine. You can see up to about 39,000 as of right now. So joining us to break down the price action is Mike McLone, Bloomberg Intelligence commodity strategist. Mike, it's great to have you on the program this morning. There's been a lot of action, and it's a bit of a fool's errand to attribute any individual movement, especially for Bitcoin, to any one news headline. But look, we were as low as 34,500 as of Thursday, yesterday. What do you think is behind the movement?
Well, hello, Brian, and I'm glad you opened it up with that. Let's try not to make it a fool's game by trying to figure out the nuances of each day. It's the big picture that's happening in Bitcoin is it's actually showing quite divergent strength versus stock market. Now, all risk assets are going down this year, and Bitcoin or cryptos are among the riskiest assets. Just Bitcoin is the least risky crypto. So it's divergent strength versus Nasdaq. Is right now Nasdaq on the year is down about 14%, and Bitcoin's down about 14%. But Bitcoin typically on a 260-day annual basis trades about 4 to 5x that volatility, risk of Nasdaq. So what I see happening is all risk that's going down, and that divergent strength kicking in Bitcoin. I expect by the end of this year, we might see more reversion in risk assets lower, i.e., because they have to, because of inflation, the Fed, and now we have a war. But I see Bitcoin coming out ahead, and we're seeing a little bit of that lately.
And Mike, you put out a tweet earlier this week that got some attention about the fact that you think that Bitcoin's on the cusp of getting strong support. What is that support level you're looking at, and how much more do you think it falls before we get there?
Well, right now it's between 30 and 40,000. I don't think it gets much below 30,000 because what I sense and I see is responsive buyers coming into space, and they're not the than the day trader types. This is more the institutional types, I think, are thinking, okay, I got to allocate to this space for the risk that it just continues to do what it has been, and I'm under allocated compared to maybe some other assets like equities where I'm over allocated. So I think it holds 30,000 this year, despite the fact I think, you know, the S&P 500 could correct 20%. It means maybe another 10%. But the key resistance right now is 40,000. So it's locked in a range, but I like to look at it. Let's look at it, you know, a couple of years from now. We're going to look at this period as kind of, I think, the transition, kind of the noise in its process towards becoming global digital collateral. Now, that's a fact what it's been doing. I don't think it's going to change. And I fully expect it's on its way to get to 100,000. It's just a question of time. And right now, you know, all risk assets are under pressure. The Fed's going to be tightening. Who knows what's going to happen with the war in Europe? But there's a lot of reasons for caution, but Bitcoin is on its way to becoming a global digital reserve asset.
100,000. I mean, that's a pretty big call there. I think one thing that's been kind of in the minds of investors is whether or not it's becoming correlated as a risk asset to the tune of the big tech companies. I mean, interesting correlation between the Nasdaq 100 and the and Bitcoin over the past few days of the Russia-Ukraine headlines. I mean, do you see that as a fair comparison, and is that kind of broadly in line with your expectations for where Bitcoin can go from here?
No, absolutely. I'm glad you went there, Brian, because when we have the stock market going down a lot, all correlations go to 1. Now, that's what's been happening a little bit this year. Cryptos are very risky. They're going down. Now, remember, there's 17,000 cryptos, massive speculative excesses. We're purging some of that. Remember what happened in 2021, massive fiscal monetary stimulus, all assets go up. So we're reverting some of that. But what I sense is Bitcoin coming out ahead. Remember, it's in the stage right now. It's a price discovery stage. It's a nascent asset / technology, and it's just gaining adoption. It's very small portion of most portfolios, and it's just picking up. I mean, you can get ETFs easily in Canada and Europe, but not in the US yet. They're not proper ETFs. So to me, that's the stage we're in. It's in a transition, and what's happened so far is China banning it is really beholden the US to embrace this technology. And now what's happening in Russia, I think, is all more the US needs to embrace. And the key thing to remember about cryptos is the most widely traded cryptos are crypto dollars. Some people call them stable coins, but crypto dollars are, you know, they all trade on the Ethereum token, and the market organically has gone for the dollar, which means US dollar dominant in this world that's a bit dicey at the moment, which I think the US regulators are really going to say, okay, thank you, let's just embrace this and not mess it up.
Mike, Russia is one of those countries, of course, where we have seen big growth in crypto adoption. Russians accounting for, I think, roughly 12% of global crypto assets. I wonder what you make of this idea that Russia may be able to evade some of these U.S. sanctions with the tools they have in place in crypto. I mean, is that overstated, or you think that works to their advantage?
Well, what's the thing? Let's point out what's really happening in a lot of the world. You can get access to a dollar now via your phone. I mean, look at a lot of the countries in the world with melting currencies. We can name a few, but you know where they are. Russia is one of them that lately, where the average citizen doesn't have to go through a bank anymore. They can go through that decentralized network and get access to the buck. And there's no better currency on the planet than the dollar. So then there's things like Bitcoin. Now, Bitcoin you might want to store some of your value there and get that appreciation. But the thing about Bitcoin, as we learned recently, is you can track every transaction. It's not good for criminals. In fact, our authorities love it because they can track those transactions. So it's the key thing that we're starting to learn. This nascent technology has a lot of advantages. And the key thing to remember is, yes, Russia is involved. A lot of Russian citizens who are protesting against this war probably are saying, okay, thanks, I need to diversify some of my rubles into dollars via my phone, which they couldn't in the past. And then you look at the rest of the world thinking, okay, where's the stability place? Where can I get access to the dollar? I can do it now via stable coins, and they all are based, you know, on Ethereum tokens. So that's part of that trickle up, trickle down that leaves digital assets. To me, this is part of that defining moment now where the world says, I can get away from my oppressive government and get access to outside it, and I can get access to the dollar via a token. So to me, that's what's happening. And it's a question of, does it continue? I think it's going to accelerate.
Yeah, it's an interesting thesis. We'll be watching closely to see if, in fact, it does move in that direction. Michael McGlone, Bloomberg Intelligence Commodities Strategist, good to talk to you today. Well, coming up on the other side, we're talking about the potential for cyber warfare as Russia steps up military attacks against Ukraine. That discussion is up ahead after this short break. We'll be right back. Well, the White House is pushing back against reports President Biden is looking at a long list of options for the U.S. to carry out massive cyber attacks against Russia. Cyber attacks have already shut down Ukrainian banks. It brought government websites offline earlier this week as well, leading to fears that cyber warfare could escalate alongside conventional military action. Let's bring in Yahoo Finance's Dan Halley, who's following the story for us. And Dan, we're talking about these NBC News reports that came out earlier this week that looked at, or at least said the president has been looking at potential options for cyber attacks against Russia. Interesting to see that the actions the U.S. is looking at are the very actions that are feared Russia would actually take in retaliation.
Yeah, it's interesting that we're seeing these reports, and some of the experts that I spoke to said that a widespread heavy duty cyber attack on Russia from the U.S. is very unlikely, and vice versa, quite frankly. And the reason for that is that if Russia, for instance, attacked us and turned off our power grid, which they certainly have the capability to do, we would do the exact same to them. It's kind of a deterrent where it's the idea of obviously at not the same kind of scale, but a form of mutually assured destruction almost, where they would launch a cyber attack against us, we would launch a similar cyber attack. And while we've talked a lot about Russia's capabilities, it's not to discount the U.S.'s capabilities. We are more or less on par with each other as far as what we're able to do and what they're able to do to each other in cyberspace. And whether that's turning off the power grid, shutting off the internet, disrupting everyday life, we're more than capable of doing that just as they are to us. So I think that if we were to see some kind of cyber attack, it would be in addition to some other form of warfare where, you wouldn't just go ahead and turn off the US's power systems. You would do that as a form of disruption in addition to something else, a kind of physical attack. Same deal with the US to Russia. So it's not as though we can expect them likely to launch wide-scale cyber attacks, or for us to launch wide-scale cyber attacks that are very visible. Now, that doesn't mean that the U.S. isn't penetrating their systems, just as they aren't penetrating ours. Everybody in the world is basically just breaking into each other's computer systems, like bandits in the night. So we are in their systems, they are in our systems. That's just a fact of life. Really, what we're likely doing is gathering intelligence for espionage, and the same thing with them, and trying to be disruptive at that level, not necessarily at the kind of wide scale, very visible level that a power grid failure or turning off the capabilities for hospitals to function would be.
Yeah, and certainly we hope that things don't escalate further from here. Yahoo Finance's Dan Howley, thanks so much. Coming up, stocks are in the green as investors continue to eye Russia's invasion of Ukraine, actually hitting session highs here. We'll break down the market action next. Welcome back to Yahoo Finance Live, just a few minutes after the noon hour here on the East Coast. I am Brian Chung, alongside Akiko Fujita here with you for the next hour. A lot on dock, but of course the numbers right now looking solid in the green, actually at session highs as the Dow up over 2%, S&P 500 up 2%, and the Nasdaq up about 1.5%. Coming up in the show, a look into the Russian economy as the invasion extends deeper into the heart of Ukraine. How will sanctions impact Russia? And are we already seeing the consequences in the sovereign debt market? Alina Rybakov of International Finance will stop by to answer that question. And then it's been a rough few weeks for the stock market. Those who have peaked at their 401k account, well, don't do that. Might be wondering if they need to do something. We'll explain how to think about retirement funds through volatility. But of course, first, watching the Russia-Ukraine headlines at as tensions continue to flare up closer and closer to the nation's capital of Kyiv.
Yeah, no, well, the Russian military is already in the capital city of Kyiv. And as we reported at the top of the 11 o'clock, we have gotten a number of reports of gunfire erupting in several neighborhoods. Of course, we've been also tracking the aerial bombings that have been happening, targeting specifically military infrastructure there, although there have certainly been reports of civilian casualties as well. We're also getting reports here of Ukrainian President Vladimir Zelensky saying that Russian advance has been stopped in most directions. So a bit of a mixed report coming out here. We've also gotten reports of fierce fighting in Kharkiv, which is the second largest city over in Ukraine. On the sanctions front, a number of moving parts here. The European Union moving to freeze the assets of President Vladimir Putin and Russian Foreign Minister Sergei Lavrov. We've also gotten these reports from Russian state media that the Kremlin is prepared to send a delegation to Minsk for talks with Ukraine. And that it coincides with what we have heard from Chinese state media in terms of a conversation that President Putin had with Chinese President Xi Jinping, where he reportedly said that President Putin is willing to negotiate with Ukraine. So on the one hand, Brian, we're getting these reports of a potential, and I stress a potential, for some diplomatic moves here. And the hope here is that could at least create a pause in military action. But a number of fronts we're tracking right now as Western allies, the U.S., of course, alongside Western allies, really move to try and choke the Russian economy, thinking that that is the most effective way to get President Putin to pull back.
Yeah, and it seems like a lot of these headlines aren't necessarily reversals of what we had seen yesterday. But if you take a look at markets on the Wi-Fi Interactive, seems like things really being shrugged off, at least by investors. When you take a look at the S&P 500 on our board here, up almost 2%. We just nudged off of the session highs a few seconds ago, but take a look at the VIX index. When you consider it's been down considerably, about 3 points in the session today, down to about 27. And also take a look at the 10-year note, up about 1 basis point to 198 basis points. Interesting to see under the hood when you take a look at some of the individual components here. XLY over the last 5 days, despite the rebound, has really actually had, even though today it's up 1 1/3%, but it's been one of the biggest laggards in terms of industries. Consumer discretionary, again, down over 3% over the 5-day period. It has been XLV, the healthcare select spider fund, that's really been carrying things up, at least as measured by these sector components as carved out by the spider funds. And then one last thing I kind of want to point out here is just kind of the reversal that we've seen in global markets. We were talking about this yesterday, Kiko, when you take a look at the European markets, the DAX and the CAC 40 in Paris were down 4% yesterday, essentially rebounding and getting back a lot of those losses, with the CAC 40 up 3.5%. In Frankfurt, same story, up 3.7%. And then take a look at Russia, when we saw the MOEX down by over 1/3 yesterday, now rebounding today by 20%. So all interesting threads there from the Wi-Fi Interactive. But we'll leave that there for right now and talk to an expert about what they're seeing on the investing fund. Jason Draho is head of Asset Allocation Americas at UBS Global Wealth Management. Jason, great to have you on the program this afternoon. I was just kind of walking through the market action. It's been a pretty remarkable rebound here. But again, the headlines coming out of Russia and Ukraine politically haven't seemed to point to a better situation over there. So what do you think is going on?
I think today at least, there's probably two factors driving the rebound. One is that based on the sanctions that have been announced thus far, I think it's clear, or at least investors believe, that the most severe outcomes are unlikely to happen. I think it's, from both the US and European perspective, they don't want to inflict sanctions that would ultimately cause, any sort of significant pain for, their domestic consumers. As a result, I think that's kind of given some comfort to markets that, this economic damage overall from this might be relatively limited. I think there's also a view that the containment, or this might end up being like sort of a Russia-Ukraine situation specifically. That's very speculative. We don't know how this is all going to play out. We don't know President Putin's kind of end game. But I think the markets are sort of believing, rightly or wrongly, that this is going to be sort of a self-contained event to those two countries specifically. So I think that's giving some sort of balance that we're seeing today. The other factor is that people, I think, were kind of cautious going into it. There was definitely sort of de-risking, buying protection. You showed the VIX kind of, coming down today. I think some of that is a case of people taking off some of that protection. They're buying back the puts, and that's going to, drive volatility down. There's been short covering. So I think it's a mix of, a little bit more optimistic on the fundamental story, but then it's more of a technically driven rally, certainly given the magnitudes of the comeback that we've seen today.
Jason, what are you advising your clients to do right now?
Well, there's a few things. One, first and foremost, don't panic. Stay invested. And I think the bias that we're seeing among our clients more is, we've been waiting to maybe put cash to work. Is this a good time to put money into the markets? And what we'd say is, from a long-term perspective, I think it's certainly become more attractive. We don't think this is the start of a significant bear market. And given the size of the pullbacks we've seen thus far, whether it's in the U.S. or European equities, where they were down, at their worst around like 13 to 15%. This starts to become kind of the maximum kind of drawdown you get outside of bear markets. So I think what we're saying is there's opportunities in the marketplace. Be prepared for sort of ongoing volatility. That this is not going to be resolved soon. On top of this, we have the Fed coming up in March, but also make sure your portfolio is diversified. We've seen this year that both stocks and bonds, public markets have been down. So look for other asset classes that can help diversify. Commodities are an asset class that has done well. It's a good hedge in case things escalate. And also looking into private markets. So I think those are some of the key messages we're conveying to clients right now.
Jason, you mentioned the central banks there. We're starting to see the escalation on the geopolitical front escalate to a point where central banks are now saying, well, maybe this could impact our policy. Fed Governor Christopher Waller speaking last night saying that a more modest tightening might be appropriate if things do escalate further in Ukraine. How do you see what's going on there weighing on the trajectory for these central banks that across the board are eager to start pulling their pandemic era easy money policies?
So I think they wouldn't be doing their job if they didn't have to consider all options. If this does escalate, it has knock-on effects for growth. They have to be prepared to respond for that. So I don't think those comments are anything overly kind of illuminated in terms of what might be going on. But I think the reality for central banks historically is that when you get, say, oil price shocks or food price shocks, it doesn't alter their monetary policy because, by definition, their shocks, the price rises and then declines. So anything they would be worried about in terms of an inflation impulse as a first order effect, I think they would look through that. So that doesn't sort of change what they're going to do. I think with the Fed is clearly sort of behind the curve in terms of starting to kind of reduce accommodation. So a rate hike in March is very, very likely. Already before this past week, the market was kind of moving past the idea of a 50 basis point hike to something more like 25 basis points. I think it's only around a 20% probability in the markets for 50 basis points. From that, it's very likely they're going to do a hike in meeting, probably at least until the summer, announce balance sheet reduction at some point, say May or June. I think the question really becomes what happens later in the year. Once the policy has an impact in terms of impacting inflation. As inflation moderates for other reasons, what does the Fed do there? I think that's where this dynamic with Russia and Ukraine could have an impact. If it starts to slow growth or have negative consequences for inflation, I think it affects policy later on down the line, but not right now.
So Jason, what's the base case you're operating under? If we're talking specifically about that March meeting, is the 50 basis point hike off the table? What have you priced in?
So we're assuming it's not going to happen. They're going to go for 25 basis points. I think the markets. Some people might have been disappointed 2 weeks ago that they could have done 50. They need to do 50. They only did 25. The way I'd sort of look at the March hike is that finally the Fed has started hiking. We know in the near term for the next couple of quarters what its path is likely to be. A hike per meeting, announcement of balance sheet reduction. We'll get more clarity on all of that. I think in the March meeting, along with updated economic projections and updated dot plot. So it's a chance for the Fed to sort of take back a little bit of the narrative in terms of how inflation is going to play out and what their policy is. And so I think there's an element of once we get a little bit of that clarity, I think that's actually going to be a help for the markets because so far there's been this uncertainty of like how much is the Fed going to hike? They've been continually surprising to the upside in terms of hawkish sentiment, debates about 50 or 25 in March. Once they start, I think at least in the near term, some of that uncertainty goes away. We know they're going to move forward. Open questions on what it means for later this year, but I think for the time being, I think there'll be a welcome sort of reprieve in terms of like, all right, the Fed's sort of started. We know where they're going. I guess now we sort of see how this plays out.
Yeah, the macro picture only getting cloudier, at least for right now. Jason Draho, head of Asset Allocation Americas at UBS Global Wealth Management. Thanks so much. I want to zoom in now specifically to the tech sector. And for more on that, Ted Mortensen, Baird Technology Desk Senior Sector Strategist, joins us now. Ted, thanks so much for hopping on the show. An interesting thread with regards to chips, because the U.S. embargo on American semiconductors might, on the surface, sounds like that should be impactful to Russia. But when you consider that that's a nation that buys about 70% of their chips from China, so how impactful are these measures, and what do you think it's going to do to the global chip market?
It's really, thanks for having me, by the way. It's really de minimis in the whole scheme of things. As you alluded to, the real focus in the tech sector is what's happening in China and Taiwan versus what's happening in China and Ukraine, or Russia and Ukraine. The issue on the supply chain right now and the tightness you have is everybody's just building just in case inventories. And the real focus is more on what's happening in China, and if they decide to go forward with some kind of action in Taiwan, that would influence the tech market much more than the Russian-Ukraine situation.
Well, Ted, with that said, I mean, this comes at a time when we have seen increasingly countries look, I mean, I'm talking specifically about the US, but other countries too, look increasingly at localizing the manufacturing of chips, especially given what has played out during the pandemic. There's sort of this acceptance of the over-reliance on those like Taiwan Semi, for example. And I wonder if you think this particular case, the US cutting off semiconductor supply and technology to Russia, does that put other countries more back in their corners? I mean, is that kind of the realignment that's happening here?
I think if you look at our supply chain dependency on China right now, it's very obvious that not only through the Biden administration CHIP Act, but bringing production back to the U.S. will happen. This is one of the reasons why you're seeing strength in global foundries, Texas Instruments, Micron, and specifically on Intel. The government, from a military perspective, has to secure supply on that leading edge node that's roughly 7 nanometers and below, which TSM dominates. And to have that production both in, I would say, friendly Far East democratic countries like Japan, South Korea, or the EU or the US, that's where we're headed. It is really a game of risk arbitration and management of that supply chain.
Jason, interestingly, there's been a lot of global M&A when you take a look, for example, at the Intel Tower Semiconductor deal, which links obviously an American company to an Israeli company. So on that point, then, would you expect the geopolitical tensions that we've seen to either accelerate that M&A trend or pare back on that M&A trend, or does that not affect any of that really at all?
I think that's really an Intel specific issue. I think as you look at these next generation chip designs, they're very, very specific. And if you look at Qualcomm, NVIDIA, AMD, who generally manufacture a fair amount of AMD, I'm sure this is not going unnoticed. And I'm sure they're looking for alternative supplies, like the entire semi food chain right now is looking for alternative supply channels. But it's obvious that it has to migrate to sovereign entities. And I think this is the new economic dynamic that we are seeing, that you not only do you have to control your data for AI, but you have to control your production from a sovereign perspective. And there are a myriad of new fabs being contemplated, whether it be in Europe or in the US. That doesn't happen, obviously, until 2025. These fabs do not get built overnight. It's a 3 to 4 year process.
I called you Jason. I meant to call you Ted. I'm mixing up our guests now. But Ted Mortensen, of course, Baird Tech. It's Friday at least. Baird Technology Desk Sector Strategist. Thanks so much for hopping on Yahoo Finance this afternoon. Well, coming up on the other side of this break, President Biden and other world leaders are targeting sovereign debt in the latest sanctions against Russia. We'll break down the impact this could have after the break. Well, as we continue to cover the Russian invasion of Ukraine, we turn our heads to the impact that these sanctions handed out by the United States government might have on Russia's sovereign debt. So for more on this, we welcome in Alina Rybakova, Institute of International Finance Deputy Chief Economist. Alina, thank you so much for hopping on our show. And I just wanted to kind of kick off this question by asking about, some eye-popping headlines that we had seen about some banks taking margin calls on Russian debt exposure. Have you seen already, just in the first few days, a pretty sharp falling out in the Russian sovereign debt market?
Absolutely. I think the sovereign debt market is now effectively untradeable. The liquidity is very low. Even though the sanctions on the secondary market are only on the new government debt, but of course, existing holders of the outstanding government debt are struggling to get out. So it's definitely having a massive impact on the market. It's having an impact on ruble, on CDS, and of course, the government bond yields.
Yeah, can you explain a little bit more about the CDS? Because that was something that a lot of people were watching in the immediate hours of the invasion here. How significant of an exposure is that to not just those that are invested in emerging markets, but is there any sort of international finance risk that could come of this in terms of financial stability, or is it pretty contained?
Well, I think at this stage it's pretty contained. We have been preparing for sovereign debt sanctions should Russian authorities escalate for a while now. And we have already seen sanctions on the primary market. You might remember last year and some years ago, where the foreign institutions, the US institutions, cannot participate in the primary market already. So since then, they have been thinking whether they'd be able to actually have this any access to the government bond of Russia. CDS is an instrument that helps you hedge risk. So if, for example, you might have difficulty exiting an instrument that is less liquid, for example, Russian OFZ, Russian local government bond market or external bond market, or maybe even equities, CDS is somewhat easier to use to hedge your exposure to Russia.
Alina, I want to go back to the first point that you made there about the impact we're already seeing. What does that suggest about the effectiveness of sanctioning sovereign debt for Russia? And on a second question here, if Russia is unable to raise debt in the West, does that push the country even more towards a country like China?
So I think it's important to look at it that it's a whole package. You know, if we would have been in the environment where it's just sovereign debt and the conflict is contained and we can sort of move forward to those negotiations, that would be one scenario. We are right now in the scenario was, as the administration has very clearly said, you know, it's in a all the countries are coming together, putting the sanctions and there is room for more. So not only sovereign debt is sanctioned, but also the authorities are sanctioning systemically important banks in Russia. There is room to do more, but I think it's sort of the everything put together that's having an impact. In terms of sovereign debt in Russia, they're right now in surplus. You know, probably after these shocks, they will have to go in a small deficit, but they have enough ability to lean on to domestic financial system in order to finance themselves and get new debt. At the same time, they also have about 630 billion in reserves, and they can use some of that because it's a wealth fund saved for the rainy day should they need to finance their budget deficit.
Alina, I want to focus on the Russian central bank. They had made a lot of efforts in the years leading up to COVID to de-dollarize. They really beefed up their exposure to gold, reduced their exposure to US dollar denominated assets. I mean, how important is that when it comes to the debate about SWIFT and whether or not it would be helpful to take Russia out of that comms channel?
Well, definitely. As you say, they have prepared. They've sort of tried to keep Fortress Russia strategy. They turned around completely after 2014, but they're not prepared for this kind of sanctions. We're living in the new reality. As you just mentioned yourself, we're discussing SWIFT. We're discussing adding potentially all Russian systemic banks to the full exclusion from the global financial industry. And of course, there are energy sanctions, which we might want to touch upon later. But so yes, so they're prepared. They have a lot, about 20% of their reserves holdings are in gold, and it's onshore in Russia. They hold almost nothing in terms of the US treasuries because they were prepared. They hold very little in the US or European countries' jurisdictions because they were afraid of sanctions. I think that sanctions even on the central bank might not be off the table. SWIFT is a global payments messaging system. It doesn't really settle, but it helps us communicate with each other. You know, what are the payments going through? I think the risks that potentially European partners were particularly pointing out is that it would also hold trade and all communications with Russia, and that might have spillover on international markets and potentially the economy. And I think that's why global community has been cautious about SWIFT.
And Alina, lastly here, I want to acknowledge that you are wearing the Ukrainian colors and you do have family that's over there. Just kind of curious at a human level, I mean, what are you hearing on the ground there? A lot of people obviously trying to flee the capital, flee the country. What's going on based off of what you're hearing?
It is absolute tragedy, and it's tragedy for Ukrainian people, and it's also tragedy for everybody who is from the region more broadly, including from Russia itself. So we really appreciate your support, and we hope that the international community will continue to stand by Ukraine and will provide more support.
Well, certainly keeping your family in our thoughts. Alina, appreciate the time today. Alina Rybakova, Institute of International Finance Deputy Chief Economist. Coming up on the other side, the CDC is pulling back on COVID mandates, but how does the public feel? We've got the results of our Twitter poll after the break. Well, the CDC is set to ease guidelines for indoor mask wearing as we continue to see the number of COVID-19 infections decline. That decision is set to be announced this afternoon. I want to bring in Yahoo Finance's Anjali Kamlani, who's following that story for us. And Anjali, it does feel like things have moved pretty quickly when you consider we were just talking about the Omicron wave a few months ago. When are we expecting that decision to come down today?
Well, Akiko, we know that the decision really has already been made, and it looks like we're going to get the details of what exactly the guidance is sometime today. Based on various reports, it looks like the CDC has been contemplating tying the masking rules and guidance very specifically to local transmission and understanding, for example, things like hospital capacity and hospitalizations rather than just case counts, because as we know, 2 years into this pandemic, we've started to understand understand a little bit more about this virus, including the fact that, within indoor spaces, it's more prevalent, as well as the idea that some people could be asymptomatic and not test positive, or will test positive days after overcoming the infection. So a lot of that has gone into play when it comes to the contemplation of that. CDC Director Dr. Rochelle Walensky last night tweeting out about this, basically teasing any expected changes, noting specifically that things like testing, masking, treatments, and focusing on indoor ventilation are all keys to preventing transmission, as well as, of course, the vaccines that are widely available. So we're in a different place this year now than we were, say, last year, even though we were having a similar discussion last year, with the COVID fatigue that has really set in. We know this is going to impact indoor spaces specifically, possibly schools and or gatherings. But we do also see reports of airlines still looking at keeping in place the masking on flights. So we'll wait to hear a little bit more later today. Back to you.
Okay, Anjali Kamlani with the update. Thanks so much for that. Well, this ties right into our Twitter poll for the week. And we asked you this question, specifically, should cities end COVID-19 vaccine mandate requirements for indoor settings? 69% of you said yes, 30% said no. And Brian, this was really prompted by a conversation we had internally here after there were reports earlier this week that New York City Mayor Eric Adams was considering lifting the requirement to show proof of vaccine in order to be in indoor settings, mainly restaurants. And we have seen a move in that direction. If you look at some of the major cities, like a Washington, D.C., like a Minneapolis, even Philadelphia, Seattle, all tweaking their indoor vaccine mandates. And it does point to the fact that we're sort of shifting from a pandemic to this being endemic, and the requirements are being tweaked as a result.
Yeah, and for what it's worth, we had a few hundred responses on that poll, but actually I was almost surprised that there were no replies to it. I mean, usually on a thing like this, you would expect to see some people kind of feverishly debating the merits of either keeping or taking down the vaccine mandates. But I think, as you pointed out, in a lot of these major cities that have, either thought about, proposed, or already gone through taking down their vaccine mandates, you've already seen across the board just kind of the behavior change. And I think some of that might actually be leading the changes by the state rules themselves. I mean, just over the last few weeks, it's been anecdotally observed when you go to a restaurant or when you go to a store, maybe more lax enforcement of the rules if they're still in place. I noticed here in New York, not 100% of the places that I've stepped into have asked or stopped or asked me to show my vaccine card. So I think it's just kind of interesting to see how the human behavior might actually be driving the policy instead of vice versa. But Akiko, I mean, certainly still a topic that at least about 30% of our Yahoo Finance Twitter followers at least feel is maybe a little bit too early to do.
Well, there's the economic impact, which I'd imagine a lot of these leaders, if we're talking about mayors of cities, are really looking at. The question is to what extent all that comes back because you no longer have a vaccine requirement to eat indoors. It's interesting to me, Brian, that it's moving in that direction. I don't know how you feel personally, but lifting a mask mandate, I can understand to a certain extent. It's not the most comfortable thing to be wearing. I think after 2 years, people are just saying, let's just check the vaccine card and then just move on with it. But it feels like no longer requiring proof of vaccine would be a significant step when you consider where we were just a few months ago.
Yeah, well, and I think that the whole point of the vaccine mandate was to try to encourage more vaccinations. At some point, I think all policymakers would have said, well, we were not going to keep these vaccine mandates in place forever. The idea was to keep it in place long enough so that a substantial enough amount of the population by percentage would be vaccinated such that the risk of then spreading it en masse would be a lot lower. And apparently that time is about now, such that, even when the vaccine mandates do go down, the people that aren't vaccinated will be assuming the risk themselves of getting seriously ill if they do go eat out or go to, a museum and what have you. So, that's apparently the vaccination rate that we're reaching right now is enough and comfortable for policymakers.
Yeah, I mean, that all just points to the fact that I think regardless of where you stand on this debate, everybody is just kind of ready to move forward. They have been ready to move forward. And the reality is, as we've heard from those like Dr. Fauci, COVID-19 isn't necessarily going anywhere, but it's about learning to live with it. And part of that is being a little more comfortable without a mask and potentially proof of vaccine. All right, we are off for a short break, but on the other side, we're going to be talking about your 401ks. A lot of Americans watching their 401ks very nervously as we've seen the volatility kick up in the equity space. What should you be watching for specifically? We've got a guest who can answer that on the other side. We are seeing the rally on Wall Street picking up steam in the afternoon session here, with the Dow now up roughly 780 points. The S&P 500 also seeing big gains there, up about 2%, and the Nasdaq up about 1.3. Well, the wild swings in the markets this week have inflicted a lot of pain, some would say anxiety, for millions of Americans who have been tracking their retirement portfolio very nervously. We've got a guest who can answer some of those questions about what exactly you should be doing in this time of volatility. Let's bring in Catherine George, financial advisor at WealthStream Advisors. And Catherine, I know the rule of thumb is always don't panic when you're seeing these swings, but what are you advising your clients who've called in this week to say, what do I do as I see things chip away in my portfolio?
Right. Well, I think the first thing is acknowledging that what we've been seeing in the news, coupled with market volatility, is frightening. And our instinct might tell us that we have to do something in order to protect ourselves. It's all about education on the front end. Our retirement accounts specifically might have the longest time horizon. You're not required to pull money out of your 401k until you're 72 years old. So you have plenty of time to ride the ups and downs of the stock market. And there has never been a geopolitical event or any other type of event where the stock market as a whole has never recovered. That's why it's so important to be well diversified across different stocks. So I think once you really understand that there are ups and downs and sticking through it is important, it's easier to ride that wave.
Hey, Catherine, it's Brian Chung here. But even though, not everyone's going to say, well, should I pull my money out of my retirement account? Some people might be wondering, well, should I change the allocation of my fund and where my retirement money is parked at? And what would you say to those people based off of the essential thesis that you just offered up, which is stocks still go up?
Yeah, so I would say kind of the first course of action is to rebalance. If you're feeling optimistic, you could take some profits in what has done better than others and buy things that haven't done as well this year, such as stocks. And ultimately, you're buying on sale. There should, in a lot of 401k plans, there should be an automatic rebalancing. However, you can go into your 401k plan and rebalance yourself. We often hear this age-old kind of saying, buy low, sell high. And sometimes our instinct tells us the opposite, is that when stocks go down, we should sell. And that's really not the best course of action. So I'd say if you're feeling optimistic, you could rebalance. But these events do teach us something about our risk tolerance. And I would say probably more than this event would be March of 2020. That was a much more drastic downfall. And any of these events can say, did my stomach drop? Was I watching the news every day? Could I not stomach that volatility? In which case, maybe you should reduce the risk in your portfolio for a long-term plan. We don't advise making short-term decisions. So maybe changing your allocation now, but adjusting it when you're feeling like stocks are back up again. But for long-term decisions, it's important to see how you're feeling and what amount of risk you can take.
What about those who are a little closer to retirement age? Obviously, your risk tolerance, it depends on what your time horizon is. But if you are, a few years out from retirement, that's going to be a scary thought looking at your portfolio. Is that when you advise putting aside more cash?
Well, really, we think about retirement and kind of post-retirement in our heads as two different things. But really, even after you retire, you still may have 35 years where you need this money to grow for you. So we try to take a longer picture such that we're not making any drastic change, whether it's at retirement or in the middle of your retirement. We try to just determine what is the rate of return you need to earn over these next X amount of years to reach your goals. Corrections or even bear markets can be scary, but history and data shows that the recovery period is typically months rather than years. And so, it can be a little bit scarier when you're approaching retirement, but it is something you can kind of pull back on that risk if it's something that you're looking at the screens all day and you really can't stomach the thought. But it is something to consider.
Well, essentially for at least most people, at least for right now, just HODL, something transferable from Bitcoin to 401k. Catherine George, financial advisor at WealthStream Advisors. Thanks so much and have a great weekend. Coming up on the other side of the break, President Biden announces his nomination to the Supreme Court. We'll share the details on his pick after the break. President Biden has made his pick for the next Supreme Court justice, replacing retiring Justice Stephen Breyer. In a tweet earlier this morning, Biden announced he would nominate Judge Ketanji Brown Jackson, saying, quote, currently serving on the U.S. Court of Appeals for the D.C. Circuit. She is one of our nation's brightest legal minds and will be an exceptional justice. The former public defender is the first Black woman to be nominated to the nation's highest court. Here with more is our very own Alexis Keenan, who's been following the story. Alexis, tell us a little bit more about the resume of Judge Brown Jackson.
She's got a good one, as you might expect. Judge Jackson is 51 years old, and she's now serving as an appellate court judge for the D.C. Circuit. She was actually just confirmed for that post by the Senate in June, so she hasn't been serving in that position for very long. Now, if she's confirmed by the High Court, by the Senate for the High Court, she'll become the first Black woman to serve on the Supreme Court, as you said, and also the court's sixth woman to serve. Along with her bio, Jackson is a graduate of Harvard Law School, and she was a former clerk for retiring Justice Stephen Breyer, who she'll replace. So early in her career, she was a public defender. She also served as a federal district court judge in D.C., and she also served in private practice and was a member of the U.S.'s Sentencing Commission. Now, if she's confirmed, her addition will not shift the dynamic of the court's 6-3 conservative majority, though there's some debate over whether she'll shift the liberal bloc further to the left or if she'll be more of a moderate. So in just more than an hour, we expect to hear from President Biden about his nomination of Judge Jackson. That will happen at the White House, and he's expected to deliver some remarks. And Judge Jackson is also expected to speak at that time, so we'll be watching for that. Now, it's important to note that the last time around in her nomination for this appellate court position, Judge Jackson did get votes from 3 Republican senators who nominated her and pushed her through to that position. That was Senators Lindsey Graham, Susan Collins, and Lisa Murkowski. Now, in the past, some of Judge Jackson's rulings have impacted corporate interests, but if we look at her track record on the D.C. Circuit Court, it's a little bit hard to predict and kind of handicapped how she might be as a Supreme Court justice and where she might fall in that liberal spectrum, particularly just because it's been such a short time there. So there's a lot of debate about whether she would fall much farther to the left and perhaps be one of the most liberal justices on the court, or if she'd be more towards the center, more like a Justice Breyer who she'll be replacing. So we'll be watching those comments from President Biden as well as hopefully Judge Jackson at 2 o'clock Eastern time. Brian and Akiko?
Okay, Alexis Keenan, thanks so much for bringing us that update. We're going to take a quick break here. We are continuing to track the market rally on this Friday. The Dow now up about 760 points, roughly 2% gain here as investors look to round out what has been a very volatile week. We'll be right back. We are continuing to follow the latest developments out of Ukraine as we get some mixed signals here from Russian President Vladimir Putin, Brian, about his willingness to negotiate with Ukraine. Of course, we started out our 2-hour block here talking about those reports from Russian state media saying that he was willing to negotiate with Ukrainian officials over in Minsk. Chinese President Xi Jinping saying that he also had a conversation with President Putin. And he said in their conversation that he was willing to have talks with Ukrainian leadership. But now we're getting these reports here of President Putin calling on Ukrainian soldiers to lay down their arms. Whether in fact all this leads to some kind of conversation, I think is still a big question mark. Meanwhile, we're watching the developments in the capital city of Kyiv there as Russian military moves in on that city to try and take control, on some level. So that's the military part of it. I want to just point to one more development, and I think that it's worth putting this in context because a lot of this has been about Russia, at least publicly, saying, raising concerns about potential for Ukrainian membership into NATO. We're looking at Russia's foreign ministry account specifically putting out a warning to Finland not to join NATO, saying any attempt would have military and political repercussions. This, of course, comes after the Finnish prime minister said that the conversation around NATO membership has now shifted as a result. So that's a bit of a side story here, but I think worth pointing out because really the big question here is still what is President Putin's endgame?
Yeah, and I think that the broad thread that you can kind of string together through everything that you just said is that this is becoming a bigger international story by the moment. It's not just Russia and Ukraine. It never was just about Russia and Ukraine. But when you consider that China might be one of the big brokers of a possible conversation between Russia and Ukraine, that being pretty significant given China's leanings historically to Russia. And then obviously the other countries that are in Eastern Europe that kind of rub up against Russia as, kind of getting looped into these discussions as well. I do want to know when it comes to the NATO angle of all of this, we need to remember that there are two countries that directly border Russia to the west that are a part of NATO. Latvia and Estonia got membership in 2004. They've been part of NATO for almost 20 years now. And, the discussion around their membership in NATO, very different than the ones about Ukraine and then possibly of Finland as well. Although, again, it remains to be seen how much of the narrative the Russian media is trying to drive here in the absence of Finland more seriously taking that under consideration. So very important there.
Yeah, and Brian, of course, all of this as investors continue to rally into the week here. We're seeing all three major indices up in a big way, with the Dow up more than 700 points. That does it for Brian and I this week. Have a great weekend. Much more to come here on Yahoo Finance Live. Keep it right here.
Keep calm and carry on. That seems to be the clarion call of U.S. equity markets, and investors are playing along. After a stunning turnaround yesterday, the appetite for risk has returned. But what's driving it? Meanwhile, the assault on Ukraine continues as the Western nation puts up a brave fight for sovereignty. What impact will sanctions on Russia and Putin have as a deterrent? Energy not on the table, and how serious are Russian media reports that Moscow is ready to dialogue in Minsk? And here at home, what is the economic fallout of the invasion as the latest PCE data show inflation remains red hot? Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christoforous, on this Friday. And Alexis, what a week it has been as markets digest the monumental shift that we have seen in geopolitics this week.
Yeah, the volatility still remaining a constant here, but risk off quickly turned to risk on, Karina. After an initial rush to safe havens like gold and bonds, we see money pouring back into stocks. Investors appear to be encouraged by news that Russia has agreed to talks with Ukrainian leadership in Belarus. We have got the Dow having its best day of 2022, up now 765 points. The S&P 500 up 80 points right now and is actually positive for the week. The Nasdaq composite higher, but not by as much, up now just about 1% as big tech starts to turn around and look attractive to some investors. Of course, investors still trying to understand the Fed's next move after the central bank's favorite inflation gauge, the personal consumption expenditure price index, that's a mouthful, the PCE, jumped 6.1% last month to the highest since 1982. So more proof that inflation remains high and could go even higher in the face of the Russia-Ukraine conflict. Also, investors taking some money off the table over in the bond market. We saw the 10-year Treasury yield move up. It is now at 2%, and we've got the yield on the 30-year at 2.3%. Let's check in with Jared Blickery for more. And Jared, I know that stocks, not just here, but around the globe bounced back overnight. Even Russia's stock index and the ruble have seen a rebound.
Let me show you this, Alexis. The Russian MOEX is up 20% today. That's after it had the biggest single-day loss in its history, the third worst single-day performance of any market, any index at any time. So here's a two-day performance. I'm not sure that's correct. Let me go to 5 days so we can see what's happened throughout the week. There we go. We have this huge, huge loss. It was over 30%, and we managed to climb off of that today. Not we, but the Russian index did. So really interesting to see that development. But you want to take a look at what's happening in the U.S. markets. As you said, the Dow having a really nice day. Now still underwater for the week. We can see it's off 1%, but nicely off of these lows here. Let me just show you the 2-day. And by the way, the markets, the Dow, the S&P 500, the Nasdaq, all having the best 2-day performance since the end of January. Let's also take a look at the S&P 500. The Kahuna, you can see it's up 3% over the last 2 days, but I want to show this year-to-date chart that we have been tracking here at Yahoo Finance. And here's the last 2 days. So we can see that right there. We did sell off precipitously from this failure point. That's 4,600. Let me see if I can get that back up here. And I got to say, we've moved right back into a potential short zone. This is where short sellers in the SPOOs, that's the S&P 500 futures contract, would be looking to re-enter. That goes all the way up from 4,350 to 4,400. So if we don't manage to close above 4,400 today, it puts everything in doubt into next week as to what developments are going to happen in the market, how they're going to react to some of the news flow. A push above 4,600 probably gives the market a little bit of breathing room. But as we've been talking about here, the situation is so unpredictable, we can't say the all clear is in just yet. And in fact, it's probably not in. So we have to tread lightly here, tread carefully. This is our leaders and sentiment board. I have regional banks up the most today. That's as the yield curve is going higher, although it is flattening. We have the lower end, we have the lower end, like the lower maturities, rising faster than the 30-year, for instance, and the 10-year. So have to keep that in mind. Home builders also getting some love, value stocks, transports, and also solar energy. Over the last 2 days, even more impressive. We saw these groups get a ton of money yesterday. Is it a short covering rally? Well, most rallies begin that way, so too soon to tell. But solar, ARK Invest components, IPOs, software, home builders, retail, all of those getting some love this week. Actually, I got to say only the last 2 days. Here's the sector action. We got tech, that's XLK. That's up 4% over the last 2 days. Communication services, industrials, utilities, real estate, discretionary, healthcare, all of those are outperforming to the downside, staples and energy. So nice 2-day run here. You put it in context of what's happened with the week, you can see a little bit of a difference. Healthcare in the lead, followed by real estate and utilities. Very defensive setup, especially considering that consumer discretionary and financials and tech, all the biggest losers here. Want to check in on the travel sector. This is what's happened this week. We have Avis Budget Group. That is a standout. That's up about 6% here, but some serious losses. However, once again, when we consider the prior 2 days, we can see some nice gains here. Finally, just want to put this in context, going back to the sector board. This entire incursion, I would say the market started reacting negatively to headlines on February 11th. So this is the 11th trading day into this mess with the Russian-Ukraine conflict. We can see consumer discretionary, tech, and communication services. Those are the biggest losers, still underwater by 5 to 7%, and those house all the mega caps. So some damage done to the mega caps, although we have seen incremental buying in both those and some of those fringe and hot money groups that we like to see get money when investors are returning to the markets.
Yeah, despite those sectors being underwater, it's been a remarkable recovery, as you say, over the last 48 hours. All right, we'll keep it on the markets and bring in our next guest. Michelle Schneider is MarketGauge.com partner and director of trading research and education. Michelle, thanks so much for joining us. So keep calm and carry on. That's my mantra for what's happened over the last 24 hours. I'd love to know what your take is. And do you think there is a sense of some complacency in the market? And what sort of technicals are you looking at right now to make sense of where we are right now and what's to come?
Okay, so there's a lot of points in that question. So let's start with stay calm and carry on. Really, basically what you're saying is a great lesson that we learned this week, which is if you are going to respond knee-jerk reactions to narratives, you're going to get into a lot of trouble. So you have to have a plan, and you have to really step back and understand that the market and the headlines didn't necessarily line up. All of a sudden, there was all this talk about the Qs being in a bearish phase because they use that 20%. But we like to look at long-term charts, and if you looked at the long-term charts, even though most of the indices, if not all of them, and most of the sectors were under the 50-week moving average, they were still well above the 200-week. So that really has kept us from getting too negative, which brings me to my next point. The market is actually range bound, which is very typical of what happens in a stagflation environment, which is exactly what we have going on. And the one that really has been, I think, the key to watch here of the four indices has been the small caps, or IWM, or the Russell 2000, because it is the granddaddy of the US economy. It rolled over in November before everything else did. And then yesterday, with the dramatic fall, it broke down underneath the January low by 10 cents. 10 ticks, and then came right back through and started turning around. Does this tell me now we're back to bullish? No, but it tells me exactly pretty much what Jared was trying to say, which is we're kind of range bound. And if we get to the middle of the range, we could find some resistance. But unless now we have a lot of work to do to break down under those lows, it would have to be something hugely catastrophic for that to happen. So at this point right now, I think we have to keep that in mind, that we're in stagflation, we're range bound, and stay calm.
Well, I hope nothing catastrophic happens. None of us want to move in that direction. So, but you did say the S word, stagflation. So brings me to my next question. PCE came in at 6.1% growth year over year, core at 5.2%. Income was flat in January, spending increased. How does this Russia aggression impact what the Fed has to do at that March 16th meeting, in your opinion?
Well, Karina, that's a great question. And I think what we're really seeing here is that this has become a great scapegoat for the Fed. They have really wanted to hold on to the transitory narrative. Speaking of narratives, I think even though they came out with a lot of hawkish talk over the last couple of weeks, particularly some of the other Fed members and not necessarily Powell, but Powell actually said today that he's still worried about the fact that the economy has not accelerated coming out of Omicron the way it should. and that the geopolitical situations, he's concerned about that. And in terms of the inflation, he can look at Russia and say, well, yeah, maybe now things are running too hot and things will cool off and it is transitory and we don't have to be as hawkish as we thought. We'll raise, but it's not going to be as aggressively as we have basically been putting into the headlines. And I think that's exactly what we're seeing here. So I would take that with a grain of salt, not necessarily because of what the Fed's doing, but this downward price movement we're seeing today in gold and silver and oil and food commodities, to me, is a buy opportunity.
Okay, absolutely. So let me ask you this. The energy conundrum is a big deal here, right? It's clear right now energy is off the table as far as sanctions. The EU and US haven't moved in that direction. But what if the situation deteriorates? What if, as you say, there's a catastrophic scenario that plays out? How does that impact, what are the economic ramifications of that?
Well, we've already seen economic ramifications just with oil getting up to $100 a barrel, and the fact that we are paying, in some areas, $5 for a gallon of gas. So that's going to pinch pockets, and that's why we've seen this downturn in a lot of the consumer discretionaries, because people have to pay for what they need and not necessarily for what they want. If things deteriorate further, I think there's obviously the negative consequence would be gas will go higher and oil will go higher. And then we can see whether or not OPEC plus moves into the equation. They've been very quiet through all of this, and they are huge producers of oil. There's been talk about reserves being released here in the United States, but I don't think that's going to make much of a difference. But there is a silver lining, and that's alternative energy. And Jared also just pointed out that TAN is up the most, over 10% over the last couple of days. And I think that would actually be maybe the real impetus to get people to seriously say that alternative energy will eventually replace fossil fuel. Maybe it'll take some time, but it's time to go back into investing into some of those solar areas.
Okay, well, I think we're a ways off from a green energy sweep. But you did touch on commodities, and you said that gold looks attractive to you. What do you think about big tech? We saw that huge bounce back in the Nasdaq yesterday and continuing today. Do you think that sector is oversold?
Yes, I think that's why we're seeing a bounce. It is because it's oversold. But I would not necessarily want to be in there for any kind of passive investing. We've just went through some pain, and yes, people are getting an opportunity to see some of their portfolios come back. But that's not, to me, where the growth is going to be this year. I still think that we're in the start of a super cycle in commodities, and that maybe because of COVID in the rearview mirror, we'll see other areas come back. Like I said, if oil continues to go up, we'll be looking more at alternative energy, even if we are far away from green energy. But to me, big tech, this is not necessarily where I would want to put my money right now, because I still think the interest rates will go up. And yes, some companies will survive that, but many that have been borrowing money at zero to make up for lousy balance sheets in the tech area, they won't survive.
Okay, thank you for that perspective. We will leave it there. Michelle Schneider, MarketGauge.com partner and director of trading, research, and education. Have a happy weekend to you. And we want to help you step up your own strategy. You can do that with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek and light experience. You can check it out today at yahoofinance.com/plus. And Alexis, I will send it over to you for what's coming up next.
Thanks, Karina. The European Union planning a third package of sanctions against Russia. Will the U.S. soon follow suit, and will they be effective? We'll talk about it after the break. Welcome back, everyone. The European Union is promising more severe sanctions against Russia as Ukrainian President Zelensky pleads for more and quickly. Joining me now to discuss is Josh Kirschenbaum, a senior fellow at ASD and illicit finance expert. Josh, thanks so much for being with us today. I know that Zelensky is asking European Union leaders for very specific things. I just want to run through them briefly and then get your thoughts. He wants them to ban Russians from entering the EU, to cut Moscow off from the SWIFT banking system, and to impose an oil embargo on Russia. Could any of those, or a combination of them, be enough to make Putin turn around and out of Ukraine?
I don't think that the time horizon of any sanctions can force a withdrawal of a military force on the ground. They can impose costs that will compound over time and affect the Kremlin's decision-making, particularly if those redound politically within Russia and cause a lot of dissent within elites from among the public. But even the most aggressive steps, like a full financial embargo and a full energy embargo, would take time to take a full effect.
Do you think that sanctioning Russia's oil exports is a realistic option for the U.S.? Because I know the EU is closely looking at that and even admitting that it would cause them pain to do that, but they're saying they're willing to sacrifice that. Do you think it's something that's realistically on the table, or should it be for the U.S.?
Yeah, my read of the situation is that there are probably two different analyses happening within the U.S. government and then among European governments. Within the U.S., we are probably looking at American sanctions on Russian oil, whether that's exports of Russian oil, financing, investment. That's something we could certainly do and have a significant impact, particularly in the longer term as their oil sector starts to feel the effects of lack of investment and support. I suspect that the question that economists and intelligence people are looking at is what would be the global macroeconomic effects of taking Russian oil offline if you did that precipitously. I don't know the answer to that question. The big question for Europe is how much and how quickly they're willing to reduce gas purchases. Russia has a lot of leverage over Europe there, and Europe has a lot of leverage over Russia. And to some extent, it's a game of who's willing to suffer more economic pain quickly. And the more that Europe, in particular Germany, but others, the more that they're willing to reduce or eliminate Russian gas purchases, and the quicker they're willing to do that, the more enhanced the effects of sanctions would be on Russia. Those are the real pain points, combined with a financial embargo. All the other stuff about designating senior officials in the government is mostly symbolic. The real leverage comes with oil and especially gas, as well as banking restrictions.
You know, another sanction being bandied about is freezing Putin's assets, his personal assets, and those around him. The EU is looking at doing this, I believe the UK as well. What impact at the end of the day would that really have? And does it come too late? Have they now given Putin too much time to sort of circumvent any freezing of his assets?
I doubt that designating Vladimir Putin's personal capacity, which it says the EU, the news headline to the EU is he has done that or is about to do that. I doubt that would have any major operational or economic effects or financial effects for him personally. You know, there are many ways around that. They're using cutouts, and anyway, at the end of the day, he doesn't need to access assets in Europe. I'm sure it's unpleasant if he does have them there. Sanctioning elites, wealthy Russian members of the government, business class, billionaires, that can absolutely have political effects, because as they lose access to things that they value and enjoy in Europe and the United States, they could become unhappy, and there could be some feedback. That's going to take time to really have a political effect. So none of these things, unfortunately, have an immediate political impact. They all have time lags. And again, the real leverage comes with gas purchases and a banking cutoff, where you have major macroeconomic effects that are going to be faster. I certainly think that politically, Russia has influence over Western members of the business or financial class to some extent because of the reliance on money from Russia. So longer term, if you disentangle Russian elites' money from London or New York or elsewhere, there is a political impact, but I would say that's secondary and longer term compared to banking restrictions on oil and gas.
You know, Josh, in recent history, when you look back, when have sanctions worked the way we wanted them to? When were they successfully implemented, and what could we learn from that?
I think if we look at at least the last 10 or 15 years, we've seen a lot of sanctions programs that have only had marginal effects on their target countries and a few sanctions programs that have had significant effects and probably affected decision-making. First and foremost, Iran, where the sanctions with other tools, including the threat of military strikes, yielded an agreement to roll back Iran's nuclear program in 2015. It has been argued and is arguable that sanctions had an impact on the decision-making of the military dictatorship in Myanmar to give up power and then later staged a coup. And I think that the examples show that they take time and they need to be very, very aggressive. So in terms of the current situation with Russia and Ukraine, I would certainly advocate for more aggressive sanctions than the United States and Europe have thus far imposed. But the lessons are they need to be very, very far-reaching, and they're going to take time to have an effect. They're absolutely not an answer to the ongoing military assault on Ukraine. They're a tool that can add financial and economic pressure over time.
A magical wand, they are not. And even President Biden said they will take time. Josh Kirschenbaum, Senior Fellow at ASD, thanks for your insights today. Appreciate it. Karina?
Okay, and coming up, the U.S. has warned of possible cyber attacks tied to the Russia invasion. What you need to know to protect yourself. That story ahead. Welcome back to Yahoo Finance. Well, it is definitely a risk-on session, and we want to take a check of the three majors at the moment. They are all rallying. The Dow is up more than 700 points, heading for its best day of 2022 so far. It's up by 780 points. It was close to 800 points at one point. The S&P also up by 82 points, and the Nasdaq better by 137 points. A remarkable turnaround from yesterday there. Heading over to the bond market to take a look at the action happening on the 10-year yield. It is inching up slightly. It's now up to 1.99% as the focus remains steadily on Russia and Ukraine actions. The 30-year also higher, up to 2.29 at the moment. But still, the yield curve is flattening. All right, we want to keep it on Russia and Ukraine. And while Russia continues to press its advance into Ukraine, the U.S. is now on high alert for any potential cyber attacks from Putin and his allies. Here with more on this topic is Yahoo Finance's Dan Howley. So we've heard a lot about companies needing to be on high alert. But individuals need to be wary as well, right?
That's right. There's the potential for cyber attacks from Russia and from Russian allies, Russian basically hacker groups that have more or less been conscripted by Russia, or cyber criminals that Russia uses, something that they do pretty frequently against the U.S. And that could come in the form of disinformation campaigns, breaking into things and stealing intelligence information. That's really kind of what we've seen from Russia over the past few years. And, not to be confused, we've done the exact same thing to Russia as well. In fact, basically the entire world is in each other's computer systems trying to steal information from one another. As far as Ukraine goes, though, what we're seeing is kind of a coordinated effort of physical attacks as well as cyber attacks, and the two kind of go hand in hand. So you wouldn't expect to see Russia launch an attack in the U.S. Against, say, infrastructure via a cyber weapon without some other kind of backup for that, meaning, an actual armed conflict. So it's unlikely to see some kind of large-scale cyber attack from Russia on the U.S. It's more likely that we're going to either not see anything at all or see some websites taken offline, but nothing, I think, of the scale of what Russia has previously done in Ukraine, which is, knocking out portions of the country's power grid using cyber attacks.
So, Dan, what can the U.S. do at this point to sort of shore up its defenses? I mean, one would like to think they're already shored up, because if they're trying to do it now, they're probably behind the 8 ball.
Yeah, well, when it comes to kind of cyber attacks and things along those lines and information security, there's really no kind of bulletproof vest against cyber attacks. Really, it's trying to use best practices, trying to use basically zero trust capabilities when it comes to setting up your organization or your government entity. But really, what it comes down to is software is made by people. It's regularly adjusted by people, and people are fallible. And those flaws are what hackers use to exploit to gain access to systems or to launch cyber attacks. So that's really the issue here. Really, when it comes down to the U.S. and Russia and their distinctive capabilities, they're more or less on par with each other. Same thing with China, but and other actors in the world. What it comes down to is basically deterrence on both parts. More or less, Russia knows that it can take out power plants. It also knows that we can take out power plants. So really what will continue to happen is we'll see, or maybe not see, really won't see, kind of behind the scenes espionage between the two countries, where they'll fire cyber attacks at each other, but it'll be along the lines of something that sits in a system for years and allows them to kind of pull intelligence information away from each other. So I don't expect to see a large-scale attack, but just to be clear, those are capabilities that Russia does have and could do, and the same for the U.S. that we could do to Russia.
So, Dan, what should individuals be wary about for themselves to help protect their own sort of, financial, banking, and other valuable assets to make sure that they're not a victim of a hack?
Yeah, I think for the average person, it just comes down to the normal, kind of standard go-to, where you change your passwords, you try to stay up on everything that when it comes to protecting your online life. You don't click any links that you don't know. You don't download things from emails from people you don't know. If you get anything from the IRS saying that in an email, click this link, do not do that, because that's likely, or it is, someone trying to get you to download some kind of malware. So the regular people just follow what are best practices. I think the bigger issue is what would happen to larger companies. And when something happens to them or governmental organizations, that's basically out of our hands. They have our data, and they're the ones that need to continue to protect it. We're basically just making sure that no one can, go in and take money out of our wallets, more or less. These companies and government organizations are making sure that crime rings aren't running around letting people do that. So I think for the average person, though, it really just comes down to follow, your gut, make sure that you use standard procedures when it comes to protecting yourself online. For the larger issues with government, that comes down to the government and organizations protecting themselves and having those big procedures in place.
And one thing is sure, the U.S. is no stranger to those Russian hacks. We saw that with JBS last summer with that big meat packing hack that happened over the summer. All right, we'll leave it there. Dan Howley, thank you so much. We've got much more Yahoo Finance coming up for you. Stay with us.
Welcome back to Yahoo Finance Live. The U.S. stepped up sanctions yesterday against Russia, but left Moscow's oil industry mainly untouched. Here to discuss is Richard Nephew, senior research scholar at the Columbia University Center on Global Energy Policy and author of The Art of Sanctions. Welcome to the show, Richard, and thanks for being here. Now, we saw yesterday when President Biden addressed the nation, he is taking this sort of very controlled, careful approach to sanctions on Russia. Do you think we will ever see the U.S. sanction Russia's oil industry?
Well, I certainly think we will see sanctions on the oil industry, but I think there are many different shades of that and many different flavors of that. I think that thus far they focused on longer term investment and technology aspects of the oil and gas sector. And that's because they're attempting to be careful to avoid interrupting flows right now, right? Especially with the market already with higher oil prices and a lot of uncertainty out there. So I think the theory is start off with things that have longer term impacts, and then over time, you might see them shift to focus on things with nearer term impacts, including on actual flows of gas and oil.
Of course, Ukraine's President Zelensky wants action right now, like yesterday, and he's asking for specifically the EU to impose an oil embargo on Russia. What would that look like, and would that move the needle at all, do you think, for Putin?
I think it would definitely move the needle, but it's a question of what it actually causes him to do, right? You know, the difficulty we have with Russia, unlike other suppliers, is that it's a major oil supplier, producing, millions of barrels of oil, per day, especially, for places like Europe, in a climate in which you already have over $90 a barrel worth of oil. And so the issue that you've got is if you were to all of a sudden have a cutoff on all those imports, where's the oil going to come from? Where's the gasoline going to come from? And I don't think that until you have answers to those questions, it's clear that the pressure would be felt by the Russians, but instead could be potentially felt by the Europeans. I think the focus on what we're trying to do now, what we're seeing the United States and the EU and others do, is ensure that all the pain from the sanctions goes against Russia. And so that's why there's a focus on financial transactions, on banks, going after high technology imports that the Russians need to ensure that the real damage is felt in Russia, not felt in Europe and elsewhere.
Now, you say that Putin can still use the energy markets, and you just alluded to this, as sort of his own weapon. I mean, he could turn off the taps altogether. Would Putin, in some scenario, could Putin and Russia actually become a beneficiary of that scenario?
Yeah, for sure. I mean, this is one of the reasons why, for a number of years, prior to this current crisis, a number of analysts, and myself included, were encouraging Europe to diversify its supply such that it wasn't so dependent on Russia. And so the concern was always that the Russians could turn off the taps and to leave Europe badly exposed, and to some extent badly exposed to blackmail and to coercion by the Russians saying, now, if you want your oil and gas back, we're going to need you to make concessions here. So I think this is a longer term problem that the Europeans are facing. It's a challenge that they have to make in terms of general diversification. And so the question is, in the near term, are there things that can be done that will channel all that pressure against Russia? As I said, I think that's where financial sanctions come into play, longer term investment, technological sanctions. Those are the things that will disproportionately affect Russia and also create an environment in the future, if this crisis drags on, in which you could contemplate doing things that might have more direct immediate impact, where you've got a little bit more protection from it in the market and in European energy systems.
Biden was criticized for not just cutting off Russia from the SWIFT banking system. To your mind, are banking sanctions less or more important than energy purchase reductions at this point?
I think they're pretty integrated, actually. The issue here is that if you cut off banking connections altogether, you'd make it such that the Russians couldn't get paid for energy exports, which obviously would have an impact on them. If you cut off their ability to engage in exports, that would obviously have an impact on what the banking flows are and what revenues look like. So the question is, how do you mix and match, right? How do you do enough of financial sanctions that you have pressure on the financial system of Russia on its revenues, while not at the same time undermining the ability of Europe to be able to import commodities that it really needs? And I think there's more that can be done. I don't think that SWIFT is where it's at. A lot of folks have focused on SWIFT. SWIFT's essentially a banking email system. It's important. And certainly it makes transactions easier to conduct, but there are other ways of getting messages across to allow banking transactions to take place. What's more important are asset freezes and banking cutoffs, where you make it so the banks themselves can't have interactions with their outside Russia partners. That's how you put real pressure on the Russian financial system and deny them access to those revenues, or at least control them to some extent. And I think that's where, at least in the immediate space, you could see a lot more impact while not necessarily clamping down on the resource needs that the Europeans have.
All right, well, we'll certainly be watching to see if these sanctions get ratcheted up in the weeks ahead. Richard Nephew, Senior Research Scholar at the Columbia University Center on Global Energy Policy. We thank you for your time today. Karina?
Okay, we're going to stay on Russia-Ukraine aggression. And what are the economic implications of the conflict in Ukraine? More on that coming up. Welcome back to Yahoo Finance. Well, the U.S. comes into the Ukraine conflict with momentum, a fat balance sheet, and near zero interest rates. And today, sky-high markets with the Dow crossing 837 points up now at that session level. That is the best performance of the year to date. So a lot of things going in the U.S.'s favor, but how do we weather what's to come next? So to help us discuss, let's bring in our next guest, Kathy Bostjancic, Oxford Economics Chief U.S. Economist. Kathy, thanks so much for joining us today. So the U.S. is waging its own war at the moment, right, against inflation. We've got more than a 7 CPI handle. We've got new data that came out today. Personal income was flat in January. Spending was up 2.1% month over month. PCE came in up 6.1% year over year. The core is 5.2% year over year. Throw in the Russia wrench, and how does the Fed react to all of this? Fed's Waller and Bullard wants to hike rates by 50 basis points still come that March 16th meeting. But what do you think happens?
Well, I think the Fed, it certainly has a big inflation problem on their hands. And as you alluded to, the Russia-Ukraine war conflict only exacerbates the inflation potential. So we think they need to act. We had previously expected them to kick it off with a 50 basis point tightening in March. We've now paired that to 25 basis points. But as you said, there are a number of Fed officials, Wallard and St. Louis Fed President Bullard, who are still in favor of 50. So it's not completely off the table, but we think in light of the uncertainty surrounding the invasion, that they might want to tread more conservatively and go 25 basis points. But more importantly, besides that debate, 25 or 50 next month, it's really how much tightening for the full year. And there we still think 175 basis points. So they need to move, consistently and rather rapidly.
And, so the ECB says weaning off stimulus in Europe may take longer than expected. So do you think the Fed has to stay the course? How much wiggle room do they really have as far as rate hikes this year? Some are pricing in 6, 7 hikes. Do they go that far? And then what happens as far as the balance sheet reduction?
Yeah, so, so far, demand has remained strong. As you outlined this morning, we found out consumer spending was up 2.1%, even adjusted for the high inflation in real terms, increased 1.5% for January. That actually has led us to revise up our first quarter GDP estimate. It was flat previously. Now we're about 1.5% for real GDP. It's still soft. Omicron and the soft handoff from consumer spending in December to the start of first quarter was weak. But nevertheless, you're seeing the consumer has real strong resilience here. And we think as the weather gets better, the health conditions are better, you see that rotation, a lot of pent up demand for in-person spending and on services. So that's going to power the economy. And, I think the Fed needs to adjust demand. That's all they can do, right? They can't fix the supply problems, but they can temper demand a little bit to take a little bit of the edge off of inflation, and hopefully things do ease as supply chains get eradicated throughout the year.
Kathy, what's your fear that the Fed possibly makes a mistake? Because so far we've been dealing with boomflation, right? So there's strong growth and then there's high inflation. But now the Fed will be hiking into high inflation, higher energy costs, and possibly slowing growth as well, most likely.
That's right. So 2022, we think, is pretty strong momentum that we're going to see over 3% real GDP growth. So that's still very healthy. Where we start to get a bit more concerned is when we look out to 2023. So the Fed's got to work hard to try to rein in inflation. You have fiscal policy that has now become a drag. That we think is going to weigh on 2023 growth. And there we see, it's slowing to about 2%, but there is downside risk. And, the Fed and all central banks have not had a great track record of getting that, all wanted soft landing. So the risk must be, lying on the downside. And we have to look for financial conditions. If they really become disorderly or over tighten relative to what the Fed would desire, then you're looking at even a weaker profile for 2023.
I have a question for you on energy, but before that, I just want to know these tensions in Russia and Ukraine, what do they signal about growth globally? Because Germany already signaling contraction, right, for a couple of quarters there. So with a slowing economy there, how does that impact us here?
Yeah, so Europe and, well, I guess Russia first bears the brunt of the sanctions and negative impact on growth in our modeling, and then Europe next, of course. And for the US, you do get some negative feedback through the trade channel with Europe. But it's overall pretty modest. We're still largely kind of closed economy. 15% or so is open to trade, affected by trade. So we're largely insulated there. It's really more the energy component. If gasoline prices keep rising, that's obviously going to hurt consumer sentiment even more. We saw a pretty weak number again this morning on that reading. And that's going to impact discretionary spending. So far, consumers been very resilient, but at some point that could weigh on consumer spending.
And so where do you see energy prices going? We just saw them hit 100, cross that for Brent on news of the attack.
Yeah, so our commodity team now thinks that we can hover around that $100 per barrel on the Brent reading. Now, obviously, it's going to be very sensitive to news. Today, we saw a pullback, and what we hear over the weekend on Monday can set the tone for prices for price action next week. But we think roughly you're seeing upward pressure on oil prices, and at least $100, even a little bit slightly above that, 105 is quite possible looking out.
We'll have to see where it goes. Okay, we'll leave it there. Thank you so much for your time today. Kathy Bostjancic, Oxford Economics Chief U.S. Economist. Have a great weekend. And we have much more coming up. The CDC is releasing new mask mandates today. What you need to know coming up. Welcome back. Thanks for joining us this Friday afternoon. New CDC COVID guidelines are coming into effect, laying out a new strategy for preventing the spread of the disease over the long term. Here with more, let's bring in our Young Finance's Anjali Kemlani. And Anjali, a lot of people happy about being able to ditch the mask in some cases, myself definitely included.
That's right, Karina. We've already seen really a lot of states and cities follow this pattern of reducing really protections and restrictions, whether it's vaccine mandates or mask mandates. We have seen that across the board. What the CDC is looking now to do is to really help provide a proper metric or guidelines that states and cities can follow, whether it is, the number of cases, hospitalizations, hospital capacity. All of these are going to factor into how really regions should be thinking about masking, because it's not specifically going away per se, but it's just going to be more caution and approach and looking at it from sort of a risk-based perspective. That's really what the CDC is looking to do when they unveil the guidance later today, which reports say should affect about 70% of the American population. So we'll see how things pan out once we get the details.
So I'm curious which locations might be impacted the most. I mean, who might actually completely lift these mask mandates?
Well, what we know is that it's going to affect many indoor gathering spaces, and that includes schools. Schools have already been given a heads up to start expecting to put this into place as early as Monday. We do know that airlines are still looking at keeping those mandates in place. So it looks like public transportation, those rules will stay in place, but larger other indoor gathering type places, maybe like restaurants and the like, are going to be the ones mostly affected.
And then I'm wondering long term, when do you think the time comes when perhaps we'll just be able to sort of move away from being a pandemic to an endemic, and these, mask mandates and restrictions ease up further?
Unfortunately, there's no timeline for that, but I can tell you what the sort of criteria sort of focuses around, and it's what health experts have been pointing to. I know it's easy to sort of ignore here in the US where we have vaccines so widely available, but vaccination rates across the world have to reach a certain threshold, and the transmission of the disease has to reach a low enough point so that no new variants of concern come into play. That's really the reason why there still is ongoing vigilance in the public health community, because you see that the threat of a new variant that could bypass the vaccines or cause more severe disease is still on the horizon. And so as long as that threat stays in place, you're unlikely to see anyone talking about pushing into an endemic phase just yet.
And what about people who are, concerned about the mask mandates being lifted? I'm thinking maybe immunocompromised people. What does the data tell us in terms of what if they were to continue to wear the mask and be surrounded by people who are not masked?
It also depends on the type of mask, which of course we know is the reason why the White House had been pushing for better masking. We do know that they remain the most vulnerable. And while masking is helpful, it's not 100% barrier, but it does help. Ventilation is another thing to keep in mind as well when you're talking about staying. And this goes down to really the discussion that's been happening in the public health community, which is individual risk assessment. And so it depends on people. If you know someone who is immunocompromised, maybe being sort of aware of that and being careful around them and masking while you're around them. There are some individuals who said they absolutely will not be taking off their mask in any indoor setting until really this virus goes away. So it's all about understanding your own personal risk to this virus as well as those around you. And I think that's a lesson that we're all sort of still learning as a society.
The good news is, I think in this part of the world, we are all moving into the right direction. All right, we'll leave it there. Anjali Kamlani, thank you so much. Alexis.
All right, thanks a lot. Want to get a check of the markets here as we come up on 2 o'clock on the East Coast. Markets staging a really powerful comeback, and the Dow having its best day since November of 2020. The S&P 500 now on course to finish the week with gains, and even big tech not to be left out, bouncing back as well, with the Nasdaq now up 137 points. Coming up in the next hour, of course, much more on the markets and that big rebound in big tech. Plus, what can Congress do amid the Russia-Ukraine fallout? We're going to speak with California Congressman John Garamendi coming up next. Congress struggles for unity on Ukraine. We speak with California Congressman John Garamendi about lawmakers' response to the war in Europe and what's at stake for Americans. President Biden about to formally nominate Judge Ketanji Brown Jackson to be the first Black woman on the Supreme Court. Just who is Judge Jackson? We take a look at what she would add to the highest court in the land if confirmed. And more Americans are returning to the workforce, but they're doing it away from big cities. We look at which metro areas are leading the job recovery in the U.S. and why. Welcome back to Yahoo Finance Live, everyone. I'm Alexis Christoforous, along with my co-host Karina Mitchell, and stocks staging their biggest rally of the year. At least that's true for the Dow and the S&P 500. In fact, it's the Dow's best day since November of 2020. It seems as though investors are encouraged by news that Russia has at least agreed to meet with leaders in Ukraine, in Belarus. It's not been confirmed, but that is the word, and that seems to be what's moving markets higher today. Jared Blickery joining us now with more on the market action, and in particular, some stocks that are trending on our site. Jared?
That's right. We're going to begin with Block, the old Square, ticker SQ. Really nice earnings beats, some positive results that lead analysts to say they like the Cash App numbers, specifically calling them impressive. And I have some analyst notes, but first I want to get to some charts. Block has been under pressure since the start of the year, down 26%, but really it goes back a bit farther than that. A lot of these software names and payment names, anything dealing with tech, started selling off sometime in November, and that's really when we saw these losses here. So it's nice to see a 24% increase, but given the fact that it's still down 55% over the last 6 months, take it with a grain of salt. Cowen, which rates the stock and outperform, price cut is now cut to 188 from 238, so still considerably above the 118 print right here. They're saying the fourth quarter earnings are a relief and figures are in line, while February trends suggest Cash App gross profit growth will beat its previous estimates, and then also saying the Cash App is sustaining momentum in spite of difficulties on year-on-year comparisons and increasing competition. Also got a note from Jefferies, and let me just show you a 2-year chart right here, kind of round-tripping the entire pandemic. You can see only maintaining gains of 53%. This is a stock that had been up many multiples of its current price or of its pre-pandemic price, so giving back most of those gains. Jefferies, which rates the stock a buy, but they are cutting their price target to 155 from 200, saying the Cash App reported and guided metrics should be, quote, more than enough to provide relief, so better than feared. Cash App fourth quarter gross profit was above consensus, and first quarter guidance was better than expected. So they're seeing a much cleaner path forward with medium-term objectives to be disclosed during the Investor Day. So kind of waiting for that, guys.
Okay, and then Jared, Foot Locker, a little bit on the back foot today, sinking after Nike pulled back, fuels some concerns.
Yeah, good one there, Karina. You take a look at this board, lots of green here for apparel, but Foot Locker not selling as many Nikes. And you can see over the same time period we were just looking at with Square, it is now in a deficit of 20% over the last 2 years. So let's take a look at a shorter time frame. You can see over the last 6 months, really falling off a cliff here, 51% down over that time frame. Also, I want to say that from the notes of Evercore here, they're saying that the news that business with Nike is shrinking, combined with the fact that Dick's and other peers don't appear to be facing the same reduction by Nike, makes Foot Locker too slippery of a slope for us to stick with. We prefer to stay on the sidelines until we get a better clarity on what will be the sustainable level and quality of Nike's product allocations to Foot Locker. Foot Locker, they're cutting it to in line from outperform, and they're lowering their price target to $33 from $75. Have one note here from Telsey as well, saying, given the shift in vendor mix seems to take place primarily in the fourth quarter of 2022, it's likely that sales do not normalize until 2023. However, the company's moves to be less dependent on one vendor, shift its base toward off-mall locations and participate in new revenue streams should be positive in the long term. They rate the stock perform with a price target of $48. You can see $20 higher than that price right there.
All right, Jared, want to get to our Yahoo Finance Plus investment idea of the day. It is Palo Alto Networks, I guess the cybersecurity company, beating on our earnings and revenue.
Yeah, and you can see it's up Let's see, 4% today, but over the last 2 days, a huge move yesterday combined with that today gives it a 2-day return of 18%. So pretty impressive to see it tacking on those gains here. So I want to get to Argus Research. They have a couple of notes on why they like this stock and the bullish case. And here's what they're saying. They have a long-term price target of $620, which they are maintaining. And they're saying Palo Alto reported 12% non-GAAP EPS growth on 29.5% revenue growth in the fiscal quarter of second quarter of 2022. This was driven by strength in both software and hardware security products. Management also raised full year guidance, and they're saying we see Palo Alto as a strong and differentiated competitor in the highly fragmented but rapidly growing enterprise cybersecurity space. And we know that has been in focus over the last 11 days because of everything happening with the Ukraine and Russia. We are raising our fiscal year 2022 non-GAAP EPS estimate to $7.32 from $7.26 and maintaining our fiscal year 23 forecast at $8.94. So this is a stock that had been pretty high flyer and is still maintaining a lot of gains. You can see still in that uptrend, 141% over the last 3 years, guys.
All right, thanks a lot for the roundup there, Jared Blickrate. The Russian-Ukraine crisis briefly sent tech stocks to bear market levels this week before bouncing back, and bouncing back they did. Here with the outlook for big tech is Paul Meeks, portfolio manager at Independent Wealth Solutions Management. So, Paul, in just the past 2 days, the Nasdaq is up something like 4.5%. Are you a buyer of big tech right now? And if so, which areas are you focused on?
So I'm a buyer of selected names and selected industries within big tech. You know, I don't have any underhanded relationship with your Yahoo Finance Plus ideas, but I do like Palo Alto Networks and cybersecurity. I'm also a big fan of semiconductors, and not just the vendors themselves, but the semiconductor capital equipment companies, companies like Advanced Micro Devices, Micron, Qualcomm, Broadcom, are all on my fresh money buy list as of today.
How are you looking at these stocks, or should I say cherry picking the tech sector with the Federal Reserve on the fringe of raising interest rates? We don't know by how much, and of course the Russia-Ukraine crisis is going to play into all of that. But if we give into the idea that rates are going to be going up throughout the year, and their impact possibly on these growth stocks and their bottom lines, how is that factoring into what you're buying now?
You know, that's an excellent question, because right now macro trumps all micro and company specific stuff. So what I'm looking for is a couple of things. Obviously, as it goes to increasing inflation, which will increase rates, I want to see companies that can power through that on both their top line revenue and bottom line earnings per share. So I'm screening for companies that, regardless of the environment, macro and geopolitical, are going to grow the revenue and EPS this year and next. And you would think for a tech company that that would be a slam dunk. Not so in this environment. You go from putting a lot of stuff in the funnel to something much more selective. And then when it goes to the geopolitical issues of the day, I'm thinking that with the market rallying so strongly on the first 2 days of a ground war in the Ukraine, that maybe that bad news is in our rear view. You know, I can't promise that, but I'm feeling much more optimistic that at least the bad news had been buried in stock prices, and we might be able to launch from here. And that's why you've seen a couple of tech stocks do extremely well in the last 2 trading sessions.
Can you share with us any names? I don't want to put you on the spot, but do you have any particular tech companies that you think are better positioned to weather the months ahead than others?
Yeah, like I said, semiconductors, because I think we're going to be semiconductor short supply, which is bad for the customers, but great for the companies because they dictate pricing. So in the semiconductor complex, Advanced Micro Devices, Qualcomm, Broadcom, which is part semiconductor and part software company, and Micron Technology, which dominates, at least in the United States, memory chips, both NAND and DRAM. As I mentioned, I do like some of the cybersecurity plays, including your Palo Alto Networks and also Datadog. And I had been away from Apple for a long period of time, not because I'm not a big fan of Apple. Of course I am. But I was worried about the valuation. But their most recent report and their accelerated growth took me from being neutralish on Apple to much more constructive. And that's where I am today.
All right, so you talked Apple, that's one of the biggest. Let's talk a little Amazon, Meta, Netflix.
Sure.
What are you doing with those stocks right now?
Among the FANGs, I'm actually much more sour on most of them. Amazon had a nice overall report, but it was driven by greatness in digital advertising and Amazon Web Services, but actually a fairly significant loss in e-commerce. So I'm actually on the sidelines with Amazon. Facebook, or Meta, is in the midst of changing its business model. And I've covered tech since the 80s. I'm pretty well known for it. And I'm not even sure what the metaverse is. So anybody that tells you what it is or how well it's going to do, I think is spinning some yarn. And then Netflix really showed for the first time in its history that it is being actually impacted by competitors in video streaming. So among the FANGs, I do like Microsoft, and I do like Alphabet, and I do like Apple. And I don't like the others. I actually wouldn't put the others, even though they're so well known and such big market caps, on my buy list.
All right, I think we're all together on, still trying to figure out what Meta is. What about, self-driving cars and a Tesla? What do you make of an AI? What do you make of that group right now? Anything there that you like in particular?
Yeah, I think it's difficult to figure out, at least today, who the winners are going to be on the software and hardware side. But I do know who is going to propel the high-speed computing that's going to make it all happen. It's, again, my semiconductor and semiconductor capital equipment companies. So in that space in particular, I'm glad you asked the question. I like NVIDIA and Advanced Micro Devices, AMD.
I love that you came on and talked real companies with us. You actually did not shy away from giving us some names. Always appreciate that. Paul Meeks, Portfolio Manager at Independent Wealth Solutions Management. Good to see you. And coming up, we are joined by California Congressman John Garamendi. We're going to discuss lawmakers' response to the Ukraine crisis and more. So stay with us. Welcome back, everybody. What can Congress do? What can lawmakers do amid the crisis in Ukraine? Joining us now to discuss is California Congressman John Garamendi. He's also chairman of the Armed Services Committee. Congressman, thanks so much for making time for us. You know, before we dig into the sanctions that President Biden announced yesterday, I want to talk about an idea you have that I haven't really heard other people talk about. You say you would like to see Congress move to eliminate Russia's ability from operating on the crypto markets. Why do you believe that would be effective in harming Russia?
For a couple of reasons. First of all, the sanctions that are going into place are principally at this time sanctions against the banks, major Russian banks, cutting off their access to the markets and the interaction that banks normally do across the board. There's also the probability before too long that the SWIFT program will also be denied to Russia. That then puts Russia in a situation where they may have to find a new way to carry out their nefarious programs, whatever that might be, or to engage in international trade to circumvent the sanctions. That opens a possibility of the crypto market being used by Russia in order to conduct trade, to get the various parts and pieces for their military and other programs that they want to use that they would otherwise use the international markets, financial markets for. The problem, should they go that direction, and perhaps they're already there in that direction, is we simply don't know. The crypto market is opaque. There's no way to, at the present time, to determine who's dealing with it. We do know that it is largely, or we do know that bad actors of all kinds, countries, various narco gangs and the like, all use the crypto market to avoid detection in the normal banking system. So that's why I'm saying we cut Russia off from the normal banking system, even from the SWIFT program, then where do they go to conduct their activities? Well, quite possibly to the crypto market.
All right, sir. And I want to ask you, listen to this quote Senator John McCain once said: Russia is a gas station masquerading as a country. So certainly it's lined its coffers from its energy and its oil, right? And that is what in part has paid for this assault on Ukraine. So why not cripple them by cutting off, by sanctioning their energy and oil? Because that would hit the Kremlin right where it hurts.
It certainly would. It would also hit the rest of the world right where it hurts. Particularly Europe, our NATO partners, the EU systems, they would be whacked immediately if the gas supplies were cut off. A little less immediate, but certainly the price of oil would surge across the world. Here's where I think this is going to go. I believe that we have been the United States for the last 4 or 5 months, has been looking at how can we stabilize the oil and gas market if we are to deny Russia the opportunity to sell that gas and oil on the international market and into Europe. The answer is we have to backfill. We will have to increase the supply of oil from other oil supplying places of the world, including the United States, and we would have to find a way to bring gas into Europe through the liquefied natural gas mechanisms. Some of that is already happening. I've been saying for more than almost a decade now that we need to move Europe away from Russian gas by building liquefied natural gas facilities. These are the ports in Europe. Not much of that has been done. Right now, I would suggest that we take a look at the infrastructure for the Nord Stream gas line that is not going to be used anytime soon, and in my view, never used. There is an intake facility in Germany. Could that be repurposed for LNG? Possibly. We should be taking a look at that. We should also recognize that that facility is owned by Russia, Gazprom. That would be one of the things that we ought to hit Russia on, and that is to confiscate that facility and turn it into an LNG facility so that the distribution network is already set up within Germany. So it seems to me an opportunity that we should take.
Congressman, some lawmakers, within Congress have been critical of President Biden's response and were critical of the package of sanctions that he announced yesterday, saying that they want to see more severe sanctions taken against Russia now. I guess the question is, what is President Biden waiting for to ratchet things up?
Well, let's take a look at the ratchet has been significantly up already. You take a look at what has been done. Those are very, very significant issues. I can assure you that the Republicans would find problems in anything that Biden would do. However, the only other places to go are three. First of all, one we've talked about, which is the SWIFT system, and we've talked about that, why that may not be such a great idea. Secondly, the oil and gas, which we just talked about. I would expect that there will be limitations on that in the next tranche of sanctions. And the other is Putin himself. I've said for a long time, we ought to go after Putin himself. We know that he has squirreled away money somewhere around the world. He has probably been very busy in his isolation, which has occurred over the last 2 years as a result of COVID and perhaps just general paranoia that he has, he may very well have turned that into cryptocurrency or into gold bullion hidden away somewhere. But nonetheless, we ought to go after him. So I would say that there will be additional sanctions coming down. Those need to be worked out in unison with our partners. The current sanctions that are in place have been worked out with partners around the world, from Japan and Australia all the way into the European Union and beyond. So you can go very fast if you go alone. But if you want to go far, you have to go with others.
All right, Congressman, thank you for that. Need a response from you in 30 seconds, if you could. What do you think about the nomination of Ketanji Brown for the Supreme Court seat that is open? And then also you talk about pain, trying to reduce that for Americans. Only a few seconds left. There is an economic disparity meeting coming up next week that focuses on housing, making it more affordable. Just a few seconds left, sir.
The appointment, excellent. Couldn't find a better person to sit on that, to replace that seat. Secondly, with regard to the housing, I've actually introduced some significant legislation to move the housing program forward. Absolutely essential. We've got to have the discussion. We've got to get the legislation in place. And the role of the federal government is going to be critically important here.
All right. Well, Congressman, we thank you for staying within the time limit. John Garamendi of California, thanks so much. We appreciate your time. Want to get to some breaking news now. We learned moments ago that chip giant NVIDIA may have been the victim of a cyber attack. Jared Blickery joining us now with those details. Jared, what do you know?
Right, that's right. We don't know a lot so far. The Telegraph is reporting this, saying that there's a possible cyber attack that resulted in company systems being disabled, developer tools, emails taken offline for 2 days. And we're just getting reports from downdetector.com that some of their services are in fact down right now. Now, we don't know exactly how the Telegraph obtained this information, but they're saying, according to one of the quotes from the article, that their systems were completely compromised, these internal systems, and that's what an insider told the Telegraph. We do have a company statement from NVIDIA. They're saying we are investigating an incident. We don't have any additional information to share at this time. An NVIDIA spokesperson is the one who told that to the Telegraph. Also, the report is saying that NVIDIA is not believed to have identified a culprit. Of course, everybody front and top of mind here is the Russian-Ukrainian conflict, of which we know there's a lot of cybersecurity attention, but nothing in that arena just yet. Now, here's NVIDIA. We didn't really see much reaction. In fact, here's the window. We dropped a little bit right by the unchanged line. Overall, not a big day for the chip maker. We did see a lot of love for this group yesterday, though, still holding on to gains of about 6.5% for NVIDIA.
Okay, Jared, thank you so much for watching that for us. We are going to take a quick break, but we'll meet you back here on the other side with more on Ukraine and Russia aggression. Stay with us. Welcome back. Ukraine isn't making Russia's unprovoked attack on its soil easy, putting up a brave fight. Russian troops have suffered losses and anti-Putin protesters are growing in Moscow. So what's Putin's next move? Here to help us discuss that, let's bring in Christopher Miller, the Fletcher School of Tufts Assistant Professor of International History. Christopher, thank you so much for joining us. So sanctions that are weak or rolled out too slowly, how well do those work? And what did you think of the sanctions that Biden announced yesterday? Were they effective enough?
I think the sanctions are tougher than we've ever imposed on Russia, but we can't realistically count on sanctions alone to help change the dynamics on the battlefield in Kiev. The reality is that sanctions always take months, if not years, to work. And though it makes a lot of sense to punish Russia for its invasion of Ukraine, we shouldn't think that that's going to provide any sort of immediate change on the battlefield.
And I'm wondering, we've heard reports that the EU will freeze the assets of Putin and Lavrov. What effect do you think that will have on Putin? Because so much of his money has been dispersed to, the people around him, his people around him and other oligarchs.
I think it's fine to sanction individual Russian leaders, but ultimately we're facing not just a collection of individuals, but a country whose elite has supported this foreign policy line for 2 decades. And so when we think about sanctions, sanctioning individuals isn't enough. We've got to hit the entire economy to impose a real cost and make it harder for Russia to muster the type of military power that it is deploying in Ukraine right now. So I'd put individual sanctions next to sanctions on Russia's banking industry and other key industries, commodities, energy, that Russia relies on to fund its military.
There's been quite a lot of backlash to Putin's aggression from Russians themselves, a lot of protests. Do you think that he is winning, that he's on the end of a losing battle here, and that perhaps he has taken a step too far in his aggression?
Well, a lot of people have predicted Putin's downfall over the past 20 years, and he's always managed to hold on to power domestically. The reality is that his repressive apparatus is more powerful than ever. It's more dangerous than ever for Russians to express any dissent. And so I wouldn't expect in the short term the domestic dissatisfaction with the war to impact the Kremlin's decision at all.
And sir, are you surprised by how aggressive the EU and the UK has been? Usually they're on the back foot, but they seem to be taking the lead with the sanctions that are being opposed, and the US seems to be taking a back seat.
Well, this is a war on their doorstep. Ukraine borders 4 EU member states. Russia is launching cruise missiles not too far from the EU's own territory. So it makes sense that they're pushing ahead, and I commend them for doing so. I think we need more measures from the EU, more measures from the UK to lock out Russian businesses from their economies and to put costs on Russia.
Okay, thank you so much for your time, Christopher Miller, the Fletcher School at Tufts Assistant Professor of International History. Have a great weekend. And Alexis, I'll send it over to you.
All right, still to come, we're going to wrap up the wild week in the oil markets and also get an outlook on commodities. Time now for a look at the oil close. Jared Blickery standing by to wrap up what was another pretty wild week for energy traders, Jared.
Yes, that's right. WTI settling about 1% down, and it's been a volatile week. I actually want to go back a little bit farther. Here's a 1-month chart of WTI futures for April settlement, and you can see we got this big spike up on all the Ukraine-Russia tensions. You can see actually punctured north of $100 per barrel just ever so briefly. Brent crude hit 105, but you can see the prices have now retreated, and so we might have a new trading range here. Let's put some candlesticks on this chart here. We'll look to a 3-month basis, and you can see indeed just kind of trading to the downside, $88, $89 per barrel. To the upside, got that spike to 100, but really $95, $96 a barrel, kind of the midpoint. And we've seen a lot of activity in this area. So I think we have a new range to look at and potentially get a breakthrough. We just don't know if it's going to be to the upside or the downside. However, I will say the bias has definitely been to the upside over a long period of time. And just want to get a quick check of the energy heat map. We know that this has been a sector that's been leading all year long, and we can see some nice gains today as well, even though oil closed down. Chevron up about 3.5%, Exxon Mobil up 2.5%, and some of the smaller players like Diamondback Energy up even more. That's up 4%, as you see right there.
Hey, Jared, real quick, what's going on in the precious metal space? Because I know gold was trading well above 1,900 yesterday. My earrings were worth a little bit more yesterday. What's happening today?
Exactly. Well, yesterday, look at this big spike right here. This was yesterday's price action. We got to about 2,000, not exactly, but encroaching on $2,000 per ounce, and it was swiftly rejected. Now you can see we were in a short-term uptrend here, and we were just kind of backing off these highs, but we look for these spikes in the market, whether to the upside or the downside. We got one of these downside spikes in equities. So just showing that there's a potential resistance at this level, and it's going to take another catalyst to finally break through it.
All right, Jared Blickery, thanks for that. I want to stick with the energy markets now and bring in Scott Bauer, CEO of Prosper Trading Academy. Scott, always good to see you. You know, I'm curious what is keeping oil prices in check here, because you might have even expected them to explode to the upside even more than they did this week. And of course, they pulled back a little bit today, as Jared was just saying. I'm wondering if the prospect for an Iran nuclear deal is the thing that's doing it. What do you think?
Well, it's not just that, but it's also, talk about release of some of the strategic oil reserves. So you definitely have this big push and pull. As Jared alluded to, the overall trend is to the upside, but that upside is being met with some resistance because of the fact that you do have the Iran nuclear deal potentially happening. And again, there's people out there that think there's a real possibility of releasing some of the strategic oil reserves.
Did it help matters when we tapped into those reserves back in November when, Biden, along with some other countries, tried to make this concerted effort to bring gas prices down? I mean, if memory serves me, I feel like it was a nominal impact and it was pretty short-lived.
It is very short-lived, and typically it is more of an emotional or psychological type of relief to the market than it is an actual, relief of getting more gas out there and lowering prices. So, that is the historical trend, though. When that has happened, it is very short-lived, as you just said.
Now, OPEC Plus members meeting next week. Any great expectations there? Do you think what's happening, what's playing out between Russia and Ukraine, going to move those members to change their output quotas at all?
No, there is definitely some pressure from the United States. I don't think that's going to make a difference at all. That meeting is on Wednesday. Their planned output rise of $400,000 a barrel in April seems to still be in place. I don't think there's going to be any increase. If there is an increase, that can definitely help bring down or at least stabilize some of the prices. But it's not likely at this point that they're going to move anything on the needle.
Are you putting out any kind of predictions on oil prices right now? We already saw Brent, crash through $100 a barrel to 105 this week. I think WTI came right up against $100 a barrel. What are you looking for in the short term?
So I've been in the camp and telling my followers, my students, to sell every rally. Now, on the last one, on the big spike up the other day, I got stopped out on my position. That happens. But I think that you have to sell every rally here, because given everything happening, given all the considerations here, it would seem to me like oil West Texas should be trading well over $100, and it's not right now.
And what's that going to mean for gas prices? I mean, already in parts of the country, mainly out west, we're seeing gas, top $6 a gallon. Where do you think the national average might find sort of its sweet spot?
Well, unfortunately, we're now, coming into the spring and then the driving season here. So, the national average has been ticking up. And in fact, I think over the last week, it's up maybe 10, 15 cents a gallon. So, here in Chicago, where I'm at, I'm paying $4 a gallon, and that's just not even for premium. So it certainly looks to be on the rise, and I would expect that to go even higher moving into the summer months.
Yeah, I'm sure we're going to be seeing that here in parts of New York very, very soon. Want to move away from energy for a minute, because you're more than oil. Scott, you can talk to us about other commodities. And we're seeing, wheat, corn, soybeans, all things that are, specialized there in Russia and Ukraine getting hit hard and spiking. Do you see that being a long-term trend, or was that more of a sort of a knee-jerk reaction?
I wouldn't say it's knee-jerk. There's certainly just a massive amount of volatility in the space. And the grains, across the board, the Russia-Ukraine situation, obviously, there's a major disruption to a global source of wheat and corn exports. Russia and Ukraine, both together, they're both major exporters and account for about 30% of the entire global wheat trade. So a prolonged conflict here, that's going to make things much, much worse. Now, you look at the markets today, and the grains across the board are actually down about 3 to 5%. Wheat is actually down about 8%. And I think that's just because of the initial shock, the initial spike, just like we saw the other day what happened with oil, just on the initial invasion here. But the longer this protracts, the longer this plays out, I think the worse it's going to be for people, the higher these prices are going to be.
And then just quickly on precious metals, your thought there. I'm looking at palladium, which had shot higher. I know that Russia is a big exporter of palladium, and it goes into everything from cars to, your dental crown. It's off about 5% right now. Are you seeing opportunities there still for investors? What do you like in the precious metal space?
So much like I was talking about selling the rallies with oil, I had been doing the same thing, especially in gold and silver. Because when you think about it, when you break things down fundamentally, every reason in the world to have this risk-off asset, when you're talking about the precious metals, gold should have been trading well over $2,000, in my opinion, given everything going on. And we got that spike, but as Jared mentioned here, boy, oh boy, did this get absolutely met with sellers on massive, massive volume. And history says that when there are geopolitical tensions, and let's hope this is, not going to be long-lived, but when there are geopolitical tensions, rallies typically reverse. So I'm not necessarily a seller down here for gold, for silver, for palladium, for copper, but I am a seller on any rally, and I will continue to do so until these break out to levels that we haven't seen in the last year and a half.
You're a man of conviction. All right, Scott Bauer, CEO of Prosper Trading Academy. Good to see you, and enjoy your weekend. Karina?
Conviction's a good thing. All right, we will switch gears after the break and take a look at the jobs market and which parts of the country are bouncing back the fastest on this side of the pandemic. Stay with us. The national unemployment rate is edging closer to pre-pandemic levels, but it's not big cities seeing the biggest jobs rebound, according to a new study from the Economic Innovation Group. Here to help us discuss the results, let's bring in our next guest, Kenan Fikri, Economic Innovation Group Director of Research. Kenan, thanks so much for joining us today. So let's get right to it. Which cities and metro areas are leading the recovery and why?
Sure. Yeah, we're seeing the cities of the Mountain West and the Sun Belt lead this recovery. So we're here places like Austin, San Antonio, Salt Lake City, and Nashville. And these places, they have they're leading the recovery because they were growing fastest going into the pandemic. They had a lot of momentum behind them when the pandemic hit, such that the pandemic recession was really a bump in the road for them, and they continued growing very strongly on the other side of it. On the flip side, the pandemic kind of cut the engine of the economies of many other metropolitan areas, especially big coastal superstar cities like New York and San Francisco, and other tourism-dependent areas that we see kind of at the bottom of the tables right now.
So those big cities have been sort of magnets for talent. Do we see them sort of catch up soon, or is there a fundamental shift away from needing to focus on those centers?
Two big questions, open questions with that. So one is, how quickly do office workers come back downtown? These are advanced, highly differentiated kind of metropolitan service economies, and that's a big open question. The other one is actually international immigration. The country has had about 2 million fewer immigrants or working age population immigrants since the pandemic started. And usually those workers arrive first in places like San Francisco and New York. And that pipeline has dried up of people, of jobs, of economic activity. And that's going to be essential, I think, to restore for these parts of the country that, even in good times, typically shed domestic migrants to recover and regain their momentum.
So, Kenan, even in those sort of metro areas, some of them you mentioned, Austin, Tampa, Phoenix, Jacksonville, where they are seeing growth, it's been uneven. There's been a difference between sort of sectors. So what sectors are faring better than others? What's doing well?
We are seeing a compositional shift occur in most metropolitan economies in the country right now. Doing best are industries like transportation and warehousing. No surprise there, given the shocks that the pandemic has unleashed on the economy. And heartland cities are very well positioned to capitalize on that, kind of being the crossroads of the country. It's also, though, burgeoning tech and innovation sectors. The story of a place like Salt Lake City and Austin. And manufacturing is helping a number of these economies recover too. What's dragging everywhere really is leisure and hospitality. So people are still not traveling as much as they used to, nor are they eating as much as they used to out, etc. And education and healthcare, surprisingly, are sectors that have continued to shed jobs throughout the pandemic. And that's one thing that we're going to be watching over the coming years, since the eds and med sectors have been so important for maintaining kind of the economic base of cities in the former Rust Belt, looking for a resurgence, et cetera, that if these emerge from the pandemic permanently smaller for one reason or another, that's going to have to change a lot of economic development strategies across the country.
And then I'm wondering what percentage of those metro areas have sort of come back to pre-pandemic levels or surpassed them when it comes to jobs? And then which areas are lagging and when do they catch up, do you think?
Yeah. So far, it's about just under a quarter of the country's metropolitan areas have fully recovered back to kind of pre-pandemic 2019 job levels. In the West, that's over 70%. So the West is by far the strongest region economically right now, especially the interior West, not so much the California coast. And then, by the end of this year, it looks like just over half of the country's metro areas are going to reach that level. So that's going to be an important milestone to celebrate, and we will have achieved it much faster coming out of the pandemic recovery than we did after the Great Recession, which was a really long, grinding recovery for much of the country. But from there, there's more uncertainty. How long does it take that remainder to fully recover, and how many places in the country will never reach the peak employment levels that they achieved in kind of 2018, 2019, which after all was the end of a decade-long expansion cycle. It's true after every recession, there are always, parts of the country that never fully regain what they lost as our economy keeps shifting and evolving. And that's going to happen out of this one too. And yet we don't quite know how that's going to shake out yet.
All right, still a lot of things up in the air, but thank you for your time and your perspective and those research results. We'll leave it there. Kenan Fikri, Economic Innovation Group Director of Research. Thank you and happy Friday. Alexis?
All right, coming up, President Biden's historic pick to join the Supreme Court. Welcome back. We have a little over an hour to go in this trading week, which we know has been a wild one. And looks like stocks are holding on to the gains we saw earlier. The Dow having its best day since November of 2020. The S&P 500 now on track to actually end the week with some gains. And the Nasdaq Composite over the past 2 days up about 4% as investors pile back into high tech after those valuations were pretty beaten down. Because we are risk on, we're seeing some folks take money out of the bond market. That is pushing yields higher. We have the yield on the benchmark 10-year Treasury now just below 2%. It was at 2% a little earlier today, and the yield on the 30-year at 2.3%. I want to get you a quick check of oil. We know midweek Brent crude hit $105 a barrel. We thought WTI was going to do the same. It came right up against that level. But today, pulling back a little bit, and we have crude settling a little over $92 a barrel. Well, earlier today, in fact, just a short time ago, President Biden introduced federal judge Ketanji Brown Jackson as his nominee to replace Supreme Court Justice Stephen Breyer. Let's take a listen.
For too long, our government, our courts haven't looked like America. And I believe it's time that we have a court that reflects the full talents and greatness of our nation with a nominee of extraordinary qualifications. Judge Jackson, congratulations, and the podium is yours.
Thank you very much, Mr. President. I am truly humbled by the extraordinary honor of this nomination.
All right, so just who is Judge Jackson? Yahoo Finance's Alexis Keenan has been looking into this for us. She joins us now. And Alexis, I know that the judge here brings, I guess, an unusual set of professional experiences to the table. Tell us about it.
She does. She's unusual in that she has a deep background in criminal justice. She's 51 years old. She's now an appellate court judge for the DC Circuit, and that's a position that she hasn't held for all that long. She was just confirmed for that post in June. Now, if she's confirmed for the High Court, she'll become the first Black woman to serve on the court, as well as the court's sixth woman to serve. She's a graduate of Harvard Law School, and she also fortuitously was a clerk for Justice Stephen Breyer, whom she would be replacing if she is confirmed. Just an experienced criminal defense attorney here. She was a former public defender, also worked in private practice, and before her current position, she served as a federal district court judge in DC. Also of note, she was a member of the U.S. Sentencing Commission, which set some of the policies for how criminal defendants are sentenced when it comes time for them to face that part of their trial. Now, Jackson's addition to the court, it wouldn't necessarily shift the dynamic of the court's 6-3 conservative majority that it has now, though there is debate over whether or not the court's liberal bloc would shift left or right. So let's take a quick look at how those folks who track nominations and court rulings handicapped what the possibilities could be here. Definitely a caveat that this is really not scientific, but there are people engaged in this that love to take a look. So when we look at judicial common spaces metrics, they say Jackson would fall as a Supreme Court justice in the middle of the court of the ideological spectrum there, to the right of Justice Kagan, I guess in this case on our chart above Justice Kagan. Also, we have a separate sort of handicapping metric, and that comes from the database of ideology, money in politics, and elections. And that metric shows that Jackson would be all the way to the left of that ideological spectrum, beyond the left positions of Kagan and Sotomayor. So it's a bit tricky, though. Jackson has very few rulings from her short time on the appellate court, so not a lot to look at there. But what happens next is the nomination will go for a Senate hearing and a vote in the very closely divided chamber at 50-50 with Vice President Kamala Harris, the tiebreaker there. So really could be challenging, but she did get 3 Republican votes when she had her nomination for her current position. So the odds perhaps are pretty good. Alexis?
You know, real quick, in like the 30 seconds we have left, any rulings she's made that can give us an indication of how she might rule on the high court?
Yeah, so there's one that comes, and it's her first written opinion in her current role on the appellate court. And it's on the far right of your screen. I think we had a full screen to show that. What it did is it gave a win to some federal employees that were involved in a case with the National Labor Relations Board. What the court did and what her decision did is strike down the idea that agencies can change the working conditions for these federal employees without first engaging in collective bargaining. So a win for the employee side there, but not too much to go on. Also, as a district court judge, she once did rule in favor of Donald Trump. She said that DHS did have the right to waive certain environmental laws that had to do with the border law with Mexico at that time. Alexis?
All right, Alexis Keenan, we appreciate it. And that's going to do it for us. For Karina Mitchell, I'm Alexis Christophorous. Thanks for joining us this week. Our colleagues Brad, Emily, Rochelle taking you through the closing bell.
Welcome to Yahoo Finance Live. Here's what we're watching today. The US says it will join sanctions against President Putin. Russia says it's ready to negotiate, according to a call Friday between Russia's president and China's President Xi Jinping. The Kremlin saying it's open to high-level talks with Ukraine if they demilitarize, but the Ukraine has stopped responding. This comes after multiple calls by Ukrainian President Zelensky to end the invasion. Markets in Europe and the US optimistic on that possibility of dialogue and trading higher today. The Dow up over 750 points at one point today. Plus, how cryptocurrencies are being impacted by the Russia-Ukraine invasion. Once considered digital gold as a safe haven, now that they're more closely tracking the movements of equities, where do they go from here? And a deeper dive into the role crypto plays in times of conflict. More than $400,000 pours into crypto crowdfunding in just 24 hours for NGOs and volunteer groups supporting the military in Ukraine. And what should you do about your falling 401k retirement account? With markets swinging on volatility from geopolitical tensions, high inflation, and impending Fed rate hikes, it's tempting to get caught up in the panic. We'll have expert insight on how to best position your 401k and adapt your retirement plans accordingly. I'm Rochelle Akufo, along with Emily McCormick and Brad Smith.
And let's kick off this hour, just about 59 minutes until the end of today's trading activity. And what a week, Rochelle and Emily, that we've been tracking and witnessing in front of our eyes. And take a look at how we just might end. The Dow Jones Industrial Average is off of the day's highs, however, still holding on to gains of about 2% right now. 2.1% will be generous and round that up to on this Friday. 685 points in a move higher here. Also, the S&P 500 holding on to gains of about 73 points, just about 1.7% there. And the Nasdaq Composite, that is holding on to gains right now of just about 1%, 133 points to the upside. So standing by with a special look at how investment assets have performed since the start of the Russia-Ukraine conflict captured the world's attention. We've got Yahoo Finance's Jared Blickery. Jared, what are some of the biggest takeaways over this range of time?
Lots of volatility, and just look at the map behind me. This is what happened today. You can see a lot of green. London closed up almost 4%. Frankfurt, Paris, the DAX, CAC 40 up over 3%. Russia, let's take a look at the Russian MOEX index. That was up 20% today, but of course it was down 33% yesterday, down 27% this week. Now, while we haven't seen anything close to that in our markets, we are seeing a lot of volatility. You can see the Nasdaq Composite still underwater slightly for the week, but really just mounting a nice comeback off of those lows there yesterday. S&P 500, I believe, will be positive for the week. Well, looks like it's a little bit negative, just almost went positive very briefly there. And the Dow, which is having the best day, its best day in over a year, that's still trailing the last Friday's settlement by about 1%. If you look at the sector action today, pretty telling that we have materials, healthcare, staples, financials, utilities. These are a lot of sectors that were not getting much love yesterday. In fact, you put a 5-day look on these sectors, you're going to see kind of a bifurcated market here, very defensive. Healthcare is in the lead, followed by utilities and real estate, and then to the downside, consumer discretionary really still floundering down over 3%. That is the sector that houses the Nasdaq. So over the last 5 days, you can see kind of a mixed board here. I want to concentrate on what's happening today, going into the close. Very nice rally continuation from yesterday, but the big question is it a suckers rally? Pretty too close to call. I do have some thoughts on that. I'll be revealing them in an hour with my big take, but for now, we got to take this for what it is. Enjoy the green.
All right, Yahoo Finance's Jared Blickery, thank you for that breakdown, and we'll check back in with you in an hour. Our next guest of this hour is here to bring us more on the market action and what we should be making of it. Michael Sheldon is RDM Financial Group Chief Investment Officer. Michael, thanks for joining us. Stocks are on track for a second straight day of pretty significant gains. What do you think is really driving this renewed risk-on tone right now, and can this be sustained?
I think what's going on in the market today likely is that the markets are rising today because there's some dialogue between the two sides. And there's a possibility that things may not escalate any further, and that maybe there could be some sort of end to this violence at some point before too long.
And on the economic data front, this morning we received some better than expected personal spending and income data, while PCE inflation rose slightly more than expected by the most since 1982. I'm wondering, on balance, what do you think the data is telling us about where the U.S. economy is right now?
Well, I think overall the outlook for the U.S. economy isn't all that bad. We think the outlook for the U.S. consumer is pretty healthy right now. Equity prices have been rising over the past few years. Home values have been going up. The unemployment rate's at 4%. So it's important to track the US consumer because US consumer spending is about 2/3 of the overall economy. So based on a backdrop of a positive or healthy US consumer, even though inflation is rising somewhat, along with a positive manufacturing sector, we think the outlook for the US economy is reasonably positive. The three things we're monitoring, obviously, are the Fed, inflation, and the Omicron virus. On the virus side, there is some positive news that cases seem to be down significantly versus January. The other issue, which we obviously have been talking about, is Ukraine and Russia. That wasn't really on anyone's radar in the summer of last year, but now is certainly an issue, especially in terms of how it affects commodity prices.
And Rochelle here, obviously with growth equities like tech stocks, they do become more attractive as the risk falls. But tech stocks are still faring better today. Is it actually time to move back into them with conviction? If, as you say, we still don't know exactly how aggressive the Fed is going to be.
Right. Well, the outlook for tech stocks in general, I mean, you want to have some technology in your portfolios because that creates sort of the growth or the long-term growth that you need for your to meet your long-term investment goals, excuse me. But I think as interest rates are rising right now, the 10-year, by the way, with everything going on in the world, moved down to about maybe 1.94% yesterday, but now it's back around 2% or so. So as long as the 10-year and interest rates in general are rising, I think that's going to put some pressure on technology stocks or prevent them from, or basically allow other sectors in the market to sort of join in the leadership in the market. So I think as investors, you want to be more diversified and you want to have some eggs in different baskets. So for example, we still like technology, we like healthcare, but you also want to have some exposure to energy and financials.
So then in terms of retail investors versus institutional investors, where should they be hedging their bets when you do have this storm of geopolitical risk, inflation, rate hike concerns? And as you mentioned, COVID, which seems to have taken a back burner to a lot of the headlines out of Ukraine and Russia.
Well, that's important. As investment advisors, we tell our clients that it's important to stay on course and follow the financial plan. And that's going to help you basically achieve your investment goals over the long term. It's really, instead of timing the market, it's time in the market that you really want to focus on. It's important to point out that, for example, since World War II, we've had a correction, meaning a decline of 10% or more in the markets, about every 1.6 years. And so these things kind of come with the territory, unfortunately, and as unsettling and scary as they can be, they're not necessarily a terrible thing. The downside of the markets is really when you have a recession. That's when you have a worse down market. We kind of think the outlook for the economy is reasonably positive. Obviously, we need to get past the Fed and inflation, and that's just going to take some time looking ahead.
Well, for the Fed, the expectation that we would even get past that marker particularly being at the midpoint of this year, is what many economists and investors that we've spoken with were targeting. And so with all of that in mind, of course, over the course of this week, we've had the international conflict. But how far out do you believe the markets are looking now that it seems that we've got this two-day rally that's been put together? Does that sustain itself? And are markets looking out far past even that July marker, that mid-year marker that we had really had in focus prior to the revving up and the invasion of Russian forces into Ukraine this week?
Right. Well, I think until we get more clarity on inflation, it's going to be hard to be too confident in terms of what the Fed's goals are. We know they're likely to start raising rates at their March meeting, and there's been some talk about them raising rates by 50 basis points. We're not really in that camp, especially given the conflict of what's going on between the Ukraine and Russia. So we think a 25 basis point rate hike to kick things off is likely. We'll probably have several more rate hikes as we go through the year. I think it's also important to point out that some of the heavy lifting has already been done. If you look at the yield curve all the way from 2s to 30s, yields have already risen a decent amount here. And if inflation does start to moderate as we go through the year, that could take some of the pressure off the Fed to be too aggressive. And obviously, we don't want to have the Fed become too aggressive and squash the economy, which we don't think is likely, but that's something everybody will be watching.
The other interesting component of the Russian invasion of Ukraine and the conflict overseas, particularly, is where Russia has made its pact with China. How would you be looking at and evaluating companies that have major reliance on China as part of their growth story right now?
Yeah, I have to say, the fact that Russia and China are becoming closer allies is obviously not beneficial to the United States' interests. And after what's going on here between the Ukraine and Russia, you have to wonder about China's intentions with Taiwan. That's obviously been something that was under discussion even before Russia invaded the Ukraine. So I think the sort of the partnership between those two countries is not a welcome one, unfortunately. Having said that, I think if you look at Russia and the Ukraine, they're not a big part of the overall economy if you look at global GDP. But they will have an impact on things like gasoline, oil, wheat, and many different metals. So that's a concern that could raise inflation levels over the near term, and we'll have to see how that plays out.
Michael Sheldon, who is the RDM Financial Group Chief Investment Officer, joining us here today. Thanks so much for the time, Mike. We appreciate it, and have a good weekend as well. And everyone, growth equities like tech stocks, they're becoming more attractive. We're going to continue to watch those, as well as discussing the latest on Russia and Ukraine on the other side of this short break. Welcome back to Yahoo Finance Live, everyone. Let's get a quick check on the oil market, particularly checking in on Brent and WTI, as both of those this week struck $100 a barrel after Russia invaded Ukraine. There you're taking a look at levels as of right now. Brent's crude sitting at $98.64. That's a move lower of about 0.4%, so off of the highs just slightly. And then WTI crude, you're seeing that sitting right now at just above $92 a barrel, sitting about 0.7% lower on the day. And then additionally, let's check in on RBOB and the gasoline futures, particularly here, as we've been tracking the oil market and gasoline prices, gasoline futures here right now over the past 5 days, still up by about 0.7%. But here on today's activity, at least, you're seeing that down by about 1.5% for RBOB.
The world is watching as Russia's invasion in Ukraine intensifies, and major global economies are responding with another set of sanctions. Jeffrey Edmonds, CNA Corporation senior research scientist, joins us now for more on the conflict. Jeffrey, thanks for your time this afternoon. This afternoon, Bloomberg reported that the U.S. is set to place sanctions specifically on Russian President Vladimir Putin. I'm wondering, what message does this send, and what's the significance of this particular action that's set to come from the U.S.?
I think in some ways it labels him as a pariah. I don't think that, I mean, he treats the entire Russian economy as his own bank. And so I don't think they're actually going to change his behavior. And I don't think he's going to be surprised by it. But the mere fact that he's being personally sanctioned is just a mark against him.
And when we think about the sanctions that could potentially be coming in the future from the US, the EU, and the UK, and other major economies, are any sanctions, do you think, really enough to deter Vladimir Putin and Russia from this invasion that we're seeing? Is this really going to make an impact when we think about the potential courses of action?
I don't think it will, for a couple of reasons. First, the whole Ukraine issue is core and existential to him. And I just don't think he's willing to give that up. Second, I also think that the Russian leadership has an overly optimistic view of their economy. I mean, the Russian economy is generally a little bit better than people think it is, but that doesn't mean it's good. It's on more of a war footing with a large reserve. Obviously, it's still dependent on natural resources, but I think they have a little more optimism than I think is warranted, given the types of sanctions, dropping banks, perhaps going after microelectronics. This is going to have a really deleterious effect on the Russian economy in the long term.
And picking up on that point, Russia really has been de-dollarizing itself for quite some time now and building its reserves of gold to reduce its dependence on US dollars and other global currencies. I'm wondering, how significant is that to this moment now, and how effectively will Russia potentially be able to avert financial system destruction and deterioration due to the sanctions that are now coming down on the country?
So I think in the near term, they do have enough. Their economy is strong enough. The military is strong enough that they can sustain this for quite some time. I don't think, well, on the policy side, I don't think we're trying to destroy their economy. I think there's a worry there that if let's say you create a run on the banks or mass panic in Moscow, then it suddenly becomes an existential problem for the leadership, and they might escalate by widening the conflict and kind of calling us out. And so I think we're trying to, put real big, a lot of pressure on them. And that's what these sanctions are doing. But at the same time, I think we're also trying to not absolutely drop their economy.
And when we think about where we could be heading here, today we've been hearing some mixed reports about whether Russia might in fact be open to negotiations and whether Ukraine might be open to negotiations. China's foreign ministry said Putin told Xi Jinping that Russia is willing to hold high-level talks with Ukraine. And a Kremlin spokesperson also said Russia was prepared to send a delegation to Belarus for talks with Ukraine. Now, recognizing that this has been a fast-developing situation and Putin's intentions have been difficult to really understand, how likely do you think it is that these talks do happen in any form?
I'm not very optimistic that they will, one, occur, and two, I'm very pessimistic that they would actually mount anything. And the Russian leadership has called Zelensky and others, neo-Nazis and drug users that have to go. And so from the Russian perspective, any negotiation is going to be a negotiated surrender, is what they're going to be looking for from the Ukrainian leadership. And I don't think the leadership in Ukraine is really at that point at all. In fact, I think they're quite emboldened by the fact they've put up more of a resistance than the Russians had anticipated, and they've got so much international support. So I really don't see the negotiations going anywhere.
And President Joe Biden said during his public remarks yesterday that Putin has much larger ambitions in Ukraine, and that Putin really does want to reestablish the former Soviet Union. Do you think we'll see a Russian attack potentially on a NATO ally?
I don't. I don't think Russia wants this to expand beyond Ukraine. Ukraine is going to be enough of a drain on its military resources. The scenario in which I think that could happen is, like I said earlier, if we did something where that made the Russian leadership fear their actual survival, then I would think that they might reach out and attack a NATO ally to trigger an Article 5 to kind of make the argument, hey guys, if you really want to go down this route, I'm going to go down it pretty hard. So I think that's really the only scenario. I guess another scenario could be unintended spillover. You've got, adversarial armies, around the other side of borders like Poland and others. And so you could have some kind of inadvertent escalation there that could spiral out of control and cause this conflict to widen.
And at the civilian level, thousands have been fleeing from Ukraine, already moving into NATO countries to the west. How do you think a major migrant crisis could impact Europe and other countries in the wake of this?
I think we've seen, like in the past, it just really becomes a human tragedy, right? And Europe is already suffering under, like you said, already has a migration crisis, and this is only going to make that worse. So, hopefully, I know a lot of Ukrainians are staying in place, but either way, it's horrible for the Ukrainian citizens. It actually doesn't support even Russian goals in the long run if they want to actually try to win over the population, and it becomes more of a burden for Europe.
And in absence of military intervention from the US or NATO, which Biden has, of course, said is not going to be happening at this point, do you think Ukraine is fighting a losing battle here? Is Russia ultimately likely to overtake the country at this point?
I think that is probably the case, more probable than not. The Ukrainians are putting up quite a fight, a bigger fight than I think the Russians anticipated. I think the Russians made a couple operational mistakes early on. It's really hard to say right now. We're only 48 hours in. Anything could happen. Everything's very contingent. But the Russian military is quite large, and Russia's only committed a fraction of what it has on the border. And so long term, I don't think this looks good for the Ukrainian military. I guess the big question then is, does this move into Kyiv and you have urban fighting, which could really drag out? Are there going to be partisan movements throughout the country that are targeting Russian logistics and stuff like that? So even if the Ukrainian military itself kind of stops functioning as a large military, you could still have the conflict dragging out for quite some time.
We appreciate your insight on this important topic this afternoon. Jeffrey Edmonds, CNA Corporation Senior Research Scientist, thank you so much.
Thanks.
All right, hold on to your wallets. A look at crypto's rebound, plus how cryptos could be impacted by the Ukraine-Russia conflict. That's just ahead.
Welcome back. The risk-on mood in markets extended to cryptocurrencies earlier today, though that enthusiasm has come down a bit this 3 p.m. hour of trading. As we can see, Bitcoin prices are now back below the $39,000 level after nearing the $40,000 level at today's highs. And recall that yesterday prices for the largest cryptocurrency by market capitalization had fallen below $35,000. Now, taking a look at some of the other major cryptos, Ethereum still trading higher by about 0.4 percentage points, trading just below that $2,700 mark. Litecoin also trading slightly higher, whereas we have Solana as well as Dogecoin trading in the red this afternoon. But we'll continue to bring you updates on the crypto space as we track today's stock market rally as well.
All right, well, for a deeper dive into crypto and its role in the Russia-Ukraine conflict, I'm joined by Jason Williams, Bitcoin Hard Money You Can't F With author. Thank you for joining us today. Now, as we've seen crypto donations pouring into organizations and individuals supporting Ukraine's military, what does this say about how far crypto has come? And how do you think traditional financial institutions are really viewing this?
Yeah, I think that crypto is pretty agnostic to this. So you may see Russia use cryptocurrency to circumvent sanctions, as an example, and bypass some control points. You're also seeing crypto being used to fund the Ukraine and their army and resistance. So it's a really interesting landscape when you step back and you look at crypto's role right now.
Now, another thing we're seeing, of course, cyber attacks. We're seeing those being reported by Ukrainian officials amid this conflict. Talk about the role of decentralized power applications in securing the grid.
Yeah, in the United States in particular, we have a legacy, kind of an older, antiquated grid, and decentralized power. When you look at hydro, solar, wind, geothermal, waste energy even, those are ways to protect the legacy grid and make it more robust. You see the same thing happening all over the world. When you think about cyber attacks, EMPs, direct attacks on facilities, it's certainly a concern. And during times of crisis like this, infrastructure are primary targets. So losing power is a bad thing. Having decentralized power that's either interconnected in the grid or directly connected to a parasitic load that's needed locally just makes the grid more robust.
And to that point, I mean, we've seen crypto roaring back in early trading, but then we see it has waned a little bit. Still, though, tracking what we're seeing with equities. Now, most crypto-related stocks are also doing somewhat better, but still not as well as the tokens. What should investors read into that?
Yeah, I think in the last 24 hours, you've seen the market cap of cryptocurrency down to $1.57 trillion. That's almost a 10% drop, but it's rebounded a bit. This is a very volatile asset class. Some call it a store of value. Watching the price drop from a high of 69,000 recently all the way down to its present price doesn't feel like much of a store of value. But this is a very interesting moment where there's an alternative to fiat currency, and you're seeing it play out. So as a student of life, as a student of monetary policy, and a participant in living on the planet today, it's kind of really interesting to watch.
And I know a lot of retail investors probably looking and wondering, is this my opportunity to come in? How do some of these newer retail investors navigate the opportunities here without getting burned as much as they can?
Yeah, so Bitcoin in particular has been kind of range bound and moving sideways a bit. So a lot of us that watch the price and have a high time preference to Bitcoin in particular are looking at $47,000 as kind of a momentum moment where you'll see the price probably go up and you'll see momentum buyers come in. The price doesn't break 47,000 and it starts to get below 34. You're going to see value investors start to make a move where you'll see buying around 30,000. So I kind of watching that, but I don't really trade Bitcoin. I'm a buy and hold. And so, for me, I bought all the local tops and I tried to come back in whenever I can.
Now, I want to shift gears here and talk about regulation. We saw what happened when Canada's federal government tried to put 34 crypto wallet addresses on a list, saying that these exchanges and financial firms weren't to do transactions with them. A lot of users either just switch to a different wallet or a different exchange. What can regulators actually do in situations like this?
With Bitcoin in particular, because of its programmatic monetary policy and its decentralized nature, it's really hard to seize and censor. And I think that's what makes it special and interesting. The more centralized cryptos, I can't really put in the same category as Bitcoin. So what makes that interesting to me, you've seen in our recent history, moments where citizens were fleeing their country emergently, and they're grabbing things of value. And when they tried to go to the banks were closed. Or they went to ATMs and the lines were long, and then the ATMs just ran out of cash. If I was crossing a border with my family and premiumly concerned about safety, I wouldn't want to have a trunk full of gold. I wouldn't want to have a briefcase full of money. I think digital currencies like Bitcoin in particular are very interesting and necessary.
And I want to shift gears and talk about mining now. We know that China went from controlling up to 2/3 of all Bitcoin mining in the world in April of 2021 to not contributing at all as of July of 2021. Talk about the broader impact of China's moves on other domains, as the US now and Kazakhstan now have the biggest mining share by nation.
Yeah, it was an incredible moment. We faced historically a lot of FUD, fear, uncertainty, and doubt around China's influence in what you would say a centralized nature of having all of this cryptocurrency mining capacity in their country. And then in a moment, they banned it, and it happened very quickly. We saw the quantitative effect of that with hash rate and difficulty dropping. So the amount of hash is indicative to the number of computers that are supporting the Bitcoin network. That fell off a cliff when China banned Bitcoin mining. And then something really wonderful and interesting happened if you support Bitcoin. We saw those machines, the infrastructure, get decentralized across the world. It ended up in North America and other countries, as you've just stated. And today, hash is higher at its highest point ever. So we've not only gone through seeing the China FUD be dispelled, the decentralization or dissemination of those computers to many, many countries, but the recovery of hash globally, and Bitcoin's network is more secure than it's ever been historically.
And just quickly before we go, as we look at some of the trends, you built the world's first waste-to-energy cryptocurrency mine, which ran mainly on car tires, a creative concept there. But how does that tie into some of these concerns being raised by Congress as they investigate the environmental impact of crypto mining?
Yeah, I think the ESG narrative and Bitcoin's impact on power and the moralization of power is a false narrative. I'm going to be more direct than I normally am since I have your attention today. You know, I think Bitcoin actually is creating a renewable renaissance in regards to energy creation. More than 50%, 60% of the power that's used by Bitcoin miners is renewable. It's using tidal and wind and geothermal and waste and solar. And the reason it does that, it's because it's economically incentivized to drive the cost of power down and increase its profit margin. The lower your operating expenses are, and the more efficient your mine is or your business is, the more profit you have. So I think it's a false narrative. It's something used to attack Bitcoin by those who are fearful of it. But I think it's really easy if you sit down and think about and analyze where the power is coming from and how Bitcoin's programmatic monetary policy incentivizes efficiencies and renewables like we do at PRTI, where it's just a play on synthetic polymer science, where we take recycled tires or used tires and we recover them through a patented process and make all types of fuels, and we use that to mine Bitcoin and cryptocurrencies.
Well, we certainly saw it work for you, so clearly it could be applicable otherwise. Thank you so much for your insights, Jason Williams there, Bitcoin, hard money you can't F with, author. Thank you so much.
25 minutes and left until the closing bell. On the other side of this quick break, we put 3 tickers that we're watching on your radar going into the close. Meets, metaverse, and money after this quick break.
Welcome back to Yahoo Finance Live. Now it's time for our triple play where we take a look at the stocks we're keeping an eye on. So today I start with Beyond Meat. Now, Beyond Meat, apart from the fact that I love food, is still taking a beating today after reporting wider than expected loss and shrinking revenue for the fourth quarter. Stocks continue their fall today, down nearly 11% at one point. Now, we're seeing that grocery sales have been slumping as some consumers are seeking cheaper alternatives. Meat is expensive right now. So it's focusing on scaling its production for large fast food launches. We saw that with its KFC launch of Beyond Fried Chicken, as well as McDonald's Plant Burger. Now, the higher cost in using co-manufacturing facilities versus its own manufacturing plants also meant higher transportation and logistic fees eating into profits as well. So a tough day for Beyond Meat.
And it deserves to be a tough day for Beyond Meat, quite frankly. You looked at these results, and as you laid out a moment ago, Rochelle, the retail sector for the U.S. side declined in this most recent quarter by about 19.5%. They did see growth of about 35% in the food service space, and that's those restaurant partnerships that you talked about. And early on in this company's existence as a publicly traded company, it really was the restaurant side of the business that was accounting for the majority of the growth year over year. And so now there's this question where they'll continue to find that product mix, find some of its attribution both in those restaurant experiences, but also in stores. And that is one area where the pandemic had driven so many of those purchases, getting into the freezers, getting into the refrigerators, and then seeing consumers continue to flock back to it. The big question is, will they continue to order it from some of those business-to-business partnerships that Beyond Meat is seeking as well, which is actually far different from what they've seen on the international front, where food services is actually running away with that $30 billion in the net revenues that they're seeing on that side of the business internationally. They've got about $15 billion that comes in for restaurants on that side. So we'll continue to watch shares of Beyond Meat. I also want to throw this one on you guys' radar and get your feedback on Meta, because as we've been tracking the stock over the past couple of weeks here, we've already seen it blow through some of its not just 52-week lows, but also some of the 22-month low levels. We haven't seen some of these levels, and of course here today,
sitting at about $210 a share. And the move higher here today that we had seen is really in concert with some of the other big tech names. But Meta has reportedly looked to break up this 300-person team, and it was so focused on what they call XROS, which is this cross-reality operations system that really looks into AR and VR headsets, and that is critical for Meta and what they've entirely kind of rebranded and reframed their business around. And this is according to an report by The Information. Meta also looked separately on another headline. They said that they refused a Russian request to stop fact checking. So we'll see how that plays out in this near term as well, Emily.
Absolutely, Brad. And just on that front with the Russia-Ukraine tie-in that we have here for Meta Platforms, Russia's communication regulator saying that it's limiting access to Facebook because the company has decided to limit access to 4 Russian media outlets. We did get a response actually from Meta's Vice President of Global Affairs, that's Nick Clegg, who said in a statement about this move, quote, "Yesterday, Russian authorities ordered us to stop the independent fact-checking and labeling of content posted on Facebook by 4 Russian state-owned media organizations. We refused. As a result, they have announced they will be restricting the use of our services." So definitely something to keep an eye on here, and certainly Meta Platforms as well as other social media platforms likely on high alert for disinformation at this point with this conflict. But meanwhile, also on the tech front, also want to highlight shares of Block. I'm keeping an eye on those. They are our top trending ticker on Yahoo Finance right now. The company formerly known as Square seeing a major rally underway for that stock. And that's after the company posted fourth quarter sales that came in much better than expected. And Bitcoin revenue specifically came in at $1.96 billion. That drove nearly half of overall fourth quarter revenue. And Block was also unexpectedly positive on the outlook for the near term. The company saying that it expects gross payment volumes at Square to grow by 35% over last year. So still seeing double-digit growth in that merchant side of the business. And also that Cash App is expected to see gross profit grow on a year-over-year basis in both January and February. So still continuing to see growth in this consumer payments-centric company. This was definitely a pandemic-era beneficiary as we saw more digital payments online. But Rochelle, I think it is encouraging to see these results here from Block.
And as you mentioned there, Square obviously focusing on some of these smaller merchants, which sometimes, though, can expose it to some of these macroeconomic shocks as well, as we've seen that some of these other companies in this space flailing a little bit. But, you know, what we're seeing with their relatively high pricing, that could put a ceiling on its eventual market penetration. But I do think it's interesting that they are still focusing on these smaller merchants. It could be something that will pay off in the long run as we come out of COVID, as some of these merchants get back to sort of in-person payments. That could be something that could end up being their strength in the long run.
Absolutely, and something that investors are certainly latching on to here with this optimism. That stock still up about 25% in intraday trading. But coming up, China's President Xi Jinping has weighed in on Russia's attacks on Ukraine. The country still hasn't acknowledged the attacks as an invasion, but is calling for the conflict to be resolved through dialogue. We'll bring you the details on the other side of this break.
Welcome back. You're watching Yahoo Finance Live. We're going to get a check now on what's been happening with Treasury yields. Right now, we're seeing that the 10-year is in the green, and so is the 30-year. That's up almost 2% for the 10-year, and for the 30-year yield, we're seeing it's up about 2.3%. Let's also check in on the VIX, checking in that volatility index. That's in the red today. It's under that mark of 30. So we'll see how that pairs in terms of the volatility that we're seeing, uncertainty still with the Ukraine-Russia crisis, and where it goes from there.
In a week of international conflict as Russia continues its invasion of Ukraine, prompting sanctions from the U.S. and member nations of the EU, there have now been calls for negotiation as China's President Xi and the reports that Russia is now open to talks with Ukraine. Joining us now with more, we've got Leland Miller, CEO for China Beige Book. And Leland, perhaps we start off with even the point of negotiations now after the invasion has already been carried out.
Oh, well, there's no point whatsoever. These are talking points, by Beijing with the sole purpose of smoothing out the various contradictions in their position. On the one hand, they're backing Moscow. They've made no qualms about that. On the other hand, this doesn't sit very neatly with their professed positions of past years, which is non-interference in sovereign states and other things. So really right now, you're just trying to see a diplomatic dance. China supports Russia right now and Russia's resolution, and they're not going to do anything to impede that.
So we had a guest earlier who mentioned the possibility and the relationship, quite frankly, of what Russia to China actually means to Taiwan as well later on. What should we extrapolate from the political posturing between Russia and China, this relationship amid the Russian invasion of Ukraine, and what that potentially means for Taiwan?
Yeah, it's tricky because it doesn't mean much for Taiwan. The way the U.S. government handles its support or lack of support for Ukraine should not be used to draw comparisons to what U.S. support would be for Taiwan in the case of a Chinese invasion. The problem with that is, of course, we have people watching. Xi Jinping is watching. Other countries are watching. And so there is a possibility that they are viewing what's happening with the West support of Ukraine and the United States position on Ukraine as being relevant to the Taiwan comparison. So, if everyone had perfect information, we'd understand that these are not comparable things. But we don't know who's in Xi's ear whispering what. They could be empowered by this. They could see the lack of a stronger sanctions policy as being a real issue here. So it's a tricky situation.
What type of partnership and in the form of purchases, quite frankly, from China to help Russia circumvent sanctions do you believe is in place? And to what extent will that actually help Russia stomach some of the blow that they are seeing from sanctions from the U.S., other EU member nations, and other countries around the world as well?
All right. Well, this is another question that we have to watch play out, because all sanctions aren't the same. On the one hand, China's made it very clear they don't believe in unilateral sanctions. They bought oil from Iran, even though it was sanctioned for years, evaded sanctions for years on North Korea and others. But at the same time, there are stronger sanctions the United States and the West actually and Asia allies as well have threatened on the tech sector, which could become a real problem for Chinese companies through something called the foreign direct product rule. So you could see a very mixed policy where Chinese companies are evading sanctions in terms of buying agriculture, some other things, but they are adhering to sanctions on tech sector components because they don't want to threaten their own companies being sanctioned down the line. But we don't know what the position is going to be right now. It's going to likely be different depending on which sanctions and which ones they take seriously and which ones they don't.
What do you make of China saying that the U.S. is creating fear and panic over the Russian invasion of Ukraine?
Well, it's obviously nonsense. This is part of the diplo speak that's used to deal with the contradictions in China's own position. So, most of the statements that are being used for public digestion are for a domestic audience. It helps China to talk this way to domestic Chinese. Similarly, every other country is presenting the case to their own people. So, very little of what China has said or has done is meaningful. We have to watch what its actions are, and its actions right now are supporting Russia.
I guess the other consideration here is that you have a pact that's been apparent between two of the world's most prominent cybersecurity threats, and the malicious actors that have emerged from both of those regions in China and in Russia, quite frankly, putting the rest of the world on notice here.
Well, look, I'm not sure I buy into the long-term ties between this, the supposed security alliance or pact, but it's certainly in the short term, you've got a situation where China's supporting Russia and Russia's in a very difficult position. So yes, they're powerful cyber offensive nations. So is the United States. So are some of its allies. So I think that there is an uncomfortable element to this in that there isn't real precedent for what degree the United States will turn on cyber attacks or respond to Russian cyber attacks on its allies. This is relatively new ground. And so again, this is something that I think we'll have to see the degree and the intensity of the attacks before the US has at least a public position on how it's going to respond.
And at what point do you expect there to be more conversation, more dialogue, diplomatic conversation between the U.S. and both China and Russia as well?
Well, it's not clear what could be said right now. Russia wants to subjugate Ukraine and presumably decapitate its leadership. And so I don't think Putin wants to engage in anything until he's accomplished some of its goals. At some point, they're going to have to re-engage. At some point, China's going to want to re-engage, because what we're forgetting right now is the U.S. also has to have a China policy. Right now, it does not have a China policy. And so in the coming months, there is going to have to be an announcement by the Biden administration, if not weeks, what is the follow-up to phase one? What is the follow-up on the trade side? What is the follow-up on the geopolitical side? How does the United States view the relationship with China? Nothing has been done. Previous to this, the administration was working on a handful of options. The question is whether the United States pressuring Beijing to adhere to sanctions has now put some of this back, because the Biden administration may not want to pressure China as much. They have been extraordinarily cautious about any pressure whatsoever put on Beijing. Will they not want to do, for instance, a 301 investigation, or will they narrow a 301 investigation because they don't want to put additional stress on Beijing when it's asking them to adhere to foreign direct product rule, sanctioning restrictions, et cetera?
Right. Even thinking back to 2020, the first kind of iteration of some of the partnership that was going to be unveiled on the trade front and hopefully resolve some of that trade dispute between the U.S. and China, still much of that, to your point, yet to be resolved at this point in time, and even the initial phases to be followed up on. Leland Miller, China Beige Book CEO, joining us here today. Leland, appreciate the time.
Coming up, we'll count down to the closing bell as we have stocks extending gains. The Dow Jones Industrial Average currently up more than 800 points and on track for its best day of 2022. Stick with us.
Welcome back to Yahoo Finance Live, everyone. We're just minutes away from the end of the day's trading activity in the abbreviated week for U.S. markets and seeing some accelerated gains into the closing bell. Yahoo Finance's Jared Blickery has the tabs on where today's activity puts us in the broader context of the weeks-long downtrend. Jared, what are you seeing?
That's right. Nice two-day rally to cap the week. Of course, a few minutes left here, but pretty much in the bag. We're going to say Dow is up 2.5%. Look at the two-day gains here. By the way, still having its best day in over a year, up about 2.75%, and that includes the losses from yesterday. Now, you take a look at some of the gains from yesterday, rather. The Dow is actually down about 75 basis points, 77 basis points from the Friday close, and we can see the S&P 500 now finally in the green for the week, and the Nasdaq probably going to be underwater as well, but just by a few basis points. And we do have an update to a breaking news situation. We are tracking a possible hack by NVIDIA, and they have come out with a statement. This was a story originally reported by The Telegraph. What they emailed to us is, we are investigating an incident. Our business and commercial activities continue uninterrupted. We are still working to evaluate the nature and scope of the event and don't have any additional information to share at this time. When the news broke, stock went down just a little bit. You can see this low here, but we have a risk-on environment here, and we can see it's up 1.5% going into the close. You can see a lot of green on the screen here. NVIDIA, Facebook, Tesla, Amazon, Apple, Alphabet, each up more than 1%. We'll get a quick look at the sector breakdown here. Materials in the forefront, that's up 3.5%, followed by staples, financials, utilities, healthcare, and then to the downside, trailing is tech and communication services and discretionary. So the mega caps, while trailing today, over the last few days, they are still in the lead. Tech and communication services each up about 4.5%, guys.
All right, thank you so much, Jared Blickery there. All right, well, just minutes to go to the close. Just ahead, our sprint to the bell.
That is the closing bell this Friday, February 25th. This is Yahoo Finance Live. I'm Emily McCormick here with Brad Smith and Rochelle Akufo as we see markets closing sharply in the green for a second straight session. The Dow Jones Industrial Average up more than 800 points or 2.5%. That is its best day so far of 2022. The S&P 500 up about 2.2% and the Nasdaq Composite up 1.6%. Now let's turn over to our market panel. Also here joining us now for more on the days and the week's trading action. John Kicklighter is Daily FX Chief Strategist, and Julian Koski is New Age Alpha Chief Investment Officer. John, I'll start with you. Quite the two-day rally that we've seen here on Wall Street. Do you think this can continue, and what do you think were the main factors that really contributed to this risk-on tone?
It could absolutely continue, but the question is how confident would any investor really be of that kind of move? I know I wouldn't be that confident. I'm more concerned about volatility. The higher the volatility, and that means leaping higher, the more likely that a sudden turn in the situation in Ukraine can turn into a dramatic move lower. Seeing the same kind of move through the first half of Thursday trade and just get it again. It's a good probability, but the potential for loss is far too great. And I think it's probably best to be more defensive about being too brash about our calls for a bullish view.
And Julian, what do you think about this? How concerned are you at this point about further geopolitical tensions and the situation that we're seeing right now play out in Russia and Ukraine, potentially sparking more volatility and turmoil in these markets, despite, again, what we've been seeing this week?
I would be amiss to say that I wouldn't be concerned, but there's almost nothing you can do about it except go back to basics and do what you know you need to do to invest. Right. I think this can go either way. You don't know which way this is going to go. There's so much vague and ambiguous information out there right now that it's not very clear which way things could actually go. So, in the absence of uncertainty, you really have to rely on a different way of looking at market metrics. For us, it's looking at probability of outcomes. And so we would focus on that, and we would just urge investors to really look at the basics and the fundamentals of the underlying companies they're picking. I think if you want to try and overlay what's going on in the market, you can only do yourself an injustice.
And John, to that point then, what are some of the metrics that you're looking at amid this volatility that you're focusing on? And what are the safe havens then that people should be looking at for opportunities?
Sure. I take a little bit more of a global macro approach than Julian, but I am interested in terms of what the situation is in Ukraine, and he's absolutely right. There's uncertainty, and that can offer a relief rally if, let's say, the situation dramatically improves and we get a little bit of a bid just from that broader enthusiasm. But at the same time, if that also occurs, we revert back to the situation with inflation and the probability that the Fed is going to start hiking rates, which is also something of a concern for many sectors in the market. So I keep very good view on safe havens. And when it comes to safe havens, my preference is usually with the dollar and the representatives of the dollar U.S. Treasuries, but can't be totally defensive in a market if you're looking to make returns and a long-term opportunity to kind of keep track with the S&P 500, much less beat it. But dollar is my number one. Gold is certainly another consideration in these kind of markets.
And Julian, as you look at some of the share prices, you've noted General Electric as one of the companies with a high probability of failing to deliver growth implied by their share price. You've also felt the same about a lot of other utility companies, saying they look relatively unattractive. What is making them look so unattractive to you right now?
Well, as we've had some of these rotations going on in the market from growth to value, what you've seen inflated stock prices for some of these companies. Now, anytime you have an inflated stock price, you have to think what that means to the company, right? From the company's perspective, the company is going to have to deliver more growth to support the price of that stock. It's just classic math, right? So what's happening is those stock prices are rising at a rate which essentially is dislocating from the underlying fundamentals. The companies haven't actually delivered this growth in the past to justify the current prices that they're trading at. So if you look at it from that perspective and you calculate a probability of failure, in other words, what's the chance General Electric could fail to deliver the growth implied in its stock price, it's quite high just for the simple math. It hasn't delivered the growth that is implied by its current stock price. So when we look at stocks, what we want to understand is, has this company delivered the growth implied in a stock price? And has it done it consistently? Because the likelihood that it would fail in the future is pretty low. So again, we divorce ourselves from traditional portfolio management ideas, and we focus more on this idea of probability of outcome.
John, when we think about the movement that we've seen over these past 2 days, there's this other thought out there that there's a lot of short covering that was potentially taking place. If that fizzles out finally, then what should we make of the activity that is still yet to come, whether that be strictly in relation to the international conflict or whether that be in relation to forecasting or trying to read what the Fed is signaling?
Sure. So I'm very much of the probability projection as well. Those are the two principal concerns that are on my radar. If you have a situation in Ukraine, and this was let's say a short cover rally, then you have a much broader concern and situation. The opportunity that actually comes, something of an opportunity. When you have a pullback in markets because of, let's say, fear related to geopolitical tensions, you also have something of a Fed that has shown historically that it's very corrective when financial and economic stability looks in jeopardy. So it's something of an offset. On the other hand, if the Ukrainian situation improves, they are more likely to push forward with their inflation fight, especially after their favorite inflation indicator just this past session showed that it's hitting the highest level since 1982 on the headline figure. So it really has a greater risk of maintaining volatility principally, but also a much greater probability of seeing continued declines in broader markets as we go into the weeks ahead.
And so, Julian, I guess kind of on the piggyback of that, if we were to see the Fed continue forward in its path, and we did see some sort of a resumption of this broader downward movement that we'd been tracking over the course of the last few weeks on reaction to what we'd heard from Bullard, what we'd heard from Bowman, as well as what we'd heard from Bostic over the past couple of weeks, where do you then position yourself in that time? Do you continue to either buy into some of these names on the dip as we'd seen that buying activity come into play this week, or is this a kind of wait and see mode territory for you still?
No, it's not wait and see for us, because from our perspective, we want to stay invested, and this just represents an opportunity. I think from looking at the Fed, I think that most of the time the reaction is overdone. Right? There's interest rate hikes and there's interest rate hikes. What are we talking about here? We're talking about 100 basis points. I don't know what that number is going to be. But in general, if you look in the past, interest rate hikes like this just don't have the kind of impact the market actually prices into them right now. So you're watching, again, these rotations, right, from growth to value. And, I think actually the classic exact opposite problem is going to happen, which is you're going to find yourself at earnings season owning stocks that you believe were going to protect you from this. But in actual fact, all that's happened is those prices have risen. And now the pressure on the company to deliver growth to support that stock price is actually going to be harder, whereas it's going to be a lot easier for the traditional growth stocks that we've become accustomed to. So I think that often these things are just overdone. I think you stay invested, but you have to do your homework. You have to look at companies individually. It makes me quite nervous when I hear of investors talking in terms of these great swaths. Oh, well, value's in favor and growth is out. FANGs are not working. It just doesn't work. You've got to do your homework at the individual stock level.
There's the message there. Do your homework. A big thank you to our panel there for helping us digest the market movements today. John Kicklighter, Daily FX's Chief Strategist, and Julian Koski, New Age Alpha's Chief Investment Officer. Thank you for your time today. All right, well, let's check out the week that was with our very own Jared Blickery.
What a week. I keep saying that, right? But here's a year-to-date chart of the S&P 500. You know I love my candlesticks. Just want to kind of outline where we are with this trade right now, where the indices are, and where we stand. Now, the first big drop culminated with this big candlestick. We call it a hammer. It has that long tail on it. Means that low was rejected very strongly. We got a few days of rally here, and then we stalled out right at critical resistance at 4,600. came down. Now, the first day we had some negative news with respect to Russia that actually broke the market down was February 11th. And we're writing about this. I'm writing about this over the weekend. And you can see once we came down, we headed back up, failed from that resistance level, and then made this new low here. However, this low is made on less momentum. So the fact that we have a lower price but with less momentum to the downside means that we actually have bullish divergence. And so we are getting a price rise. We're actually got the best two-day price rise in the S&P 500, Nasdaq, and Dow since January. Dow, by the way, just had its best day in 52 weeks. So where are we going from here? Well, as it turns out, the market has kind of stalled out right in a critical area. Shorts could have loaded up if they wanted to on the close today. They'll have another opportunity on Sunday night, and we'll have to see what the news flow brings. But I think the short-term momentum is to the upside here, but it's going to be very difficult to get past 4,400, 4,500. Only then can we think about starting a return to those record highs. And again, difficult to see that catalyst. Nevertheless, any optimism with respect to the situation in Ukraine or central bank? We could have some dovish statements from the Fed theoretically Monday. We'll have to see how that plays out. But that's where we are right now. We got a little bit of a bullish divergence and some short-term momentum, but not exactly sure how long it will last.
All right, Yahoo Finance's Jared Blickery. A lot of great data for that weekend write-up. Going to be looking out for that for sure, Jared. And this week, markets weighed the sanctions leveled by multiple countries during the Russian invasion of Ukraine, while considering the impact to the U.S. economic recovery, given Russia's significant position in the world's oil supply side. Yahoo Finance's Rick Newman has more in this week's edition of Bidenomics. Rick, the president had to acknowledge the potential trickle through to consumers. Where do you believe the administration goes from here?
Well, economically, I mean, they're probably breathing a sigh of relief because we did not see the big surge in oil prices that a lot of people were worried about. I mean, there was talk beforehand of a full-on Russian invasion, and we did get the worst-case scenario with the Russian invasion of Ukraine. Oil prices popped up a little, but they really settled back down because we've seen two things we haven't seen. There have been no actual disruptions in supply, in the supply of oil or natural gas. And there's been no disruption of pipelines or anything moving energy across Ukraine. So that's better than the worst case scenario. But all the forecasting firms are saying, look, there's still a fear premium on energy, in particular oil, for the U.S. market, and that is going to push inflation higher. So we have 7.5% inflation right now. It's probably going to go up more than that. It could actually come close to 10%, I think, within the next few weeks. And this is just creating a very dicey situation for the Fed, which is just going to have to raise interest rates at the time. We're seeing some forecasting firms cutting their estimates for GDP growth. So I'm starting to see the word recession pop up in some of the economic analyses I follow. It's not imminent, and it may never happen, but the risks of a recession by, let's say, the end of 22 or the beginning of 2023 seem to be getting higher and becoming fairly serious.
Rick, shifting gears here, President Joe Biden nominated Ketanji Brown Jackson to the Supreme Court earlier today. If confirmed, she will become the first Black woman to serve as a justice. What would her confirmation mean for the court?
Well, she would obviously replace a liberal justice in Justice Breyer. So it's not going to change the composition of the court. But I think this is going to be a win for Biden. I think she is going to get confirmed. You're going to hear some Republicans grousing about she's too liberal on this issue or that issue, but she's actually pretty mainstream. I mean, she's been confirmed by the Senate for her current position on the circuit court. And I think she seems to me to have the potential as the next Ruth Bader Ginsburg, KBJ as they call her. Sounds kind of like RBG. So I think she's going to be confirmed within a couple of months, and that's going to be a win for Biden. He could use it.
All right. We'll leave it there for now. Yahoo Finance's own Rick Newman, thank you so much for that, and have a great weekend. We want to turn over to Yahoo Finance's own Anjali Khemlani now for some breaking news on the CDC's mask guidelines. Anjali, break down this news for us.
Thanks, Emily. So we know that the CDC was anticipated to roll out new masking guidance, and they have done so now, and it will impact basically all indoor public spaces as well as schools. The CDC saying that this impacts about 70% of the U.S. population, or about 55% of counties. It's also important to note that the definitions of what low, medium, and high transmission has changed, and that is really the focus of where masking will take place. So, for example, low areas now will be those that are have limited impact on healthcare systems, and low levels of severe disease, medium somewhere in the middle of that, and high with strains on healthcare systems, as well as high levels of severe disease. And what that does is really relay the map of current transmission in the U.S. The CDC director, Dr. Rochelle Walensky, noting that a new high transmission is going to be basically about 200 per 100,000 cases, up from 100 per. And so that's setting a different metric really for what high transmission consists of. We know that, for example, when to mask now is specifically laid out according to CDC's new guidelines. If you're in a low area of transmission, you don't necessarily need to mask. If you're in a medium area, ask your health care provider. And this really speaks to those that are immunocompromised or have other disabilities and really need that attention. And when in a high area of transmission, masking indoors in public places and schools is necessary. The CDC director noting that this comes at a time, of course, as we're coming off that Omicron wave, but we do not know what the future holds, saying specifically on this call earlier today, quote, "None of us know what the future may hold for us and for this virus. We want to give people a break from things like mask wearing when our levels are low, and then have the ability to reach for them again should things get worse." Back to you.
All right, Yahoo Finance's own Anjali Kamlani, thank you so much for bringing us that breaking news. And coming up, more analysis on the Russia-Ukraine crisis with a former advisor in the U.S. State Department. Stick with us here on Yahoo Finance Live.
Welcome back to Yahoo Finance Live. Now, as we continue to assess the fallout from Russia's invasion of Ukraine, let's examine the geopolitical fallout as well. Heather Heldman, Lumini Group Managing Partner and Principal, joins me now to break some of this down. Heather, for the companies that you advise with exposure in Russia and Ukraine, what are their biggest concerns right now?
So the biggest concern is obviously the disruption to the financial system for companies that have a presence in Russia. For Ukraine, I think it's just a total disruption of the economy, a slowdown of all economic activity, and also difficulty getting personnel and material across the borders.
So how are you advising companies then to position themselves longer term, since we don't have a clear end in sight to this conflict, despite some of this talk of dialogue, but we're getting a lot of mixed messages on that as well?
Well, I think, there's not a one size fits all answer for countries doing business in Russia and Ukraine. You have to look at them individually. So for American companies doing business in Russia, I mean, it's been a very risky environment for some time now. And I think that the writing has clearly been on the wall for the last several years that a situation in which the Russian economy was going to be under further sanction was right around the corner. It would have been difficult to predict that it would be February 2022 exactly, but the risk of doing business in Russia has been increasing for some point in time. And I think that American companies that are still in that market are very comfortable with the level of risk, and I think obviously, need to be prepared to sort of hold on for an extended period of disruption in their operations, particularly with some stalling in the international financial system. For companies doing business in Ukraine, the situation is very different. I think there's a lot of motivation on the part of the U.S. government, in addition to European governments, to try to prevent slowdowns or disruptions in international commerce. Obviously, there's no desire to punish the Ukrainian people even further, but realistically, there's going to be major disruptions for quite some time.
And as we've seen, unfortunately, so far, the sanctions don't appear to be limiting President Putin's ambitions. And we've heard President Biden there talk about the complete rupture in US-Russia relations right now. But we're still seeing that the most severe sanctions on oil and gas or on the SWIFT banking system haven't been deployed yet. How is this relationship being reframed now in light of the invasion?
Well, I think, frankly, the Biden administration and its European counterparts are still grappling with the degree to which they are willing to feel pain at home over this Russian incursion into Ukraine. I think ultimately a reset in US-Russian relations is long overdue and much needed. And the US posture toward Russia needs to be a little bit more realistic and a little bit less idealistic. We need to be very clear-eyed about Putin and his true ambitions and the threat that those ambitions absolutely pose to US geopolitical hegemony and, frankly, the safety of free Europe. So, it's going to be a difficult calculation, but the time is near to, I think, prepare the American population and probably prepare European populations as well to be ready to feel some economic pain in order to advance what is ultimately a longer term and extremely important geopolitical mission.
Now, you've mentioned the invasion having second and third order effects in every country where Russia has a vested security or economic interest. What could we be looking at in terms of fallout? And do you think we're seeing any sort of sense of urgency in the countries that might be affected on this?
Well, I think, you have to break it down and look at, countries that Russia has a friendly presence in and countries where Russia may not be a welcome visitor. But the most obvious example here is the US presence in the Middle East. And, in recent years, Russia's presence in Syria has been a presence that the US has been willing to tolerate, along with tolerance on behalf of US allies who are also operating in Syria and in the Middle East more broadly. And I think that, this rupture in US-Russian relations brought about by Ukraine is absolutely going to have ramifications for US-Russia dealings in Syria, elsewhere in North Africa, potentially in South America, potentially in the Arctic. So the U.S. ought to be preparing, strategically to engage in a break with Russia in these arenas as well. There is certainly value in continuing dialogue where appropriate and feasible, but needs to be carried out in a manner that does not underestimate Putin's ambitions.
Now, I want to talk about some of these comparisons that we've seen being drawn between the Russia-Ukraine situation and the China-Taiwan situation. You've actually said that the most useful foreign conflict to look at right now is the conflict in the Balkans from the early mid-1990s. How might that inform how this current situation plays out and any best-case scenarios that we might expect?
Well, I think that there are a lot of lessons to be drawn, based on the conflict in the Balkans in the early to mid-1990s. The primary issue is that in that conflict, the United States, with its NATO allies, held off on intervention for quite some time and ultimately decided that it had to intervene, but only after there were significant humanitarian catastrophes. And my concern is that the Biden administration drawing a sort of line in the sand and saying that there will not be any US military involvement in Ukraine may have been a little bit premature. We simply don't know what is going to unfold over the course of the following days, weeks, or months, and what may ultimately be necessary to advance U.S. strategic interests. So I think, when you look back at the Balkans and the intervention that actually did end up happening, it's largely considered to be too little, too late. And I hope that we can learn the lessons of history and not repeat that. I do think that it's important to watch what's happening with Putin and Xi Jinping in terms of their relationship and exchange over the next couple days and weeks. Certainly, Putin's action in Ukraine can be seen as a benefit to Xi Jinping, and Xi is definitely watching closely to see how the US responds here, likely going to make some decisions on an invasion of Taiwan based upon US posture toward Ukraine.
Well, certainly a delicate balancing act indeed. We do appreciate your time. Heather Heldman there, Lumini Group Managing Partner and Principal. Thank you for your time.
On the other side of this quick break, everyone, we've got some tips for the retirement accounts out there. Stay tuned. A week of volatility, however, we'll see how that's kind of shaking up the nest eggs out there.
Stocks rallied for a back-to-back day today, but these moves belie the volatility we've witnessed so far this year, with the S&P 500 still down 8% in 2022. With concerns over the geopolitical, economic, and monetary policy outlooks all elevated, our next guest joins us to discuss how to position for uncertainty in your retirement portfolios as part of our retirement series brought to you by Fidelity Investments. Here with us now is Jamie Hopkins, Carson Group Managing Partner of Wealth Solutions. Jamie, thanks so much for joining us. I think we hear the unofficial advice, don't look at your 401k now when things are volatile, but is there a case for reconsidering your holdings or balances when things do get choppy?
Yeah, thanks for having me on. And it is great advice, right? I mean, when markets are volatile, we do kind of want to, not always ignore it, but not get so worked up on the day-to-day, as you said, right? This week has been volatile. We might see volatility here for a while. And the markets, we saw a drop down below 10% already this year. And that's not all that uncommon. So what we don't want to have is that focus on day-to-day moves and then changing your investments all the time. Now, with a 401k, interestingly enough, I often tell people if we are going to make changes to our investments, the 401k is a decent avenue to do so, really because of the tax benefits that if you have gains inside of there, you can reallocate without triggering really new income taxes and capital gains taxes. Whereas if you had it in a taxable account or a brokerage account, it wouldn't be the same, right? We might reallocate and cause a bunch of taxes. So if we are going to reallocate, it's not a bad time to do so. And the other thing is, I do think that global events, the pandemic, we're talking about retirement as you're nearing retirement, the volatility in the market can also be a good gut check to, are you actually just too heavily invested in the market? Are you too heavily in one sector? And actually go back to some of the fundamentals on just why are you investing? What is your own personal risk tolerance? And maybe you do need to take some risk off the table. And that doesn't mean because we're worried about the volatility, but this gives us a time to go back and review some of those things.
And to your point about the tax advantages here of potentially reallocating in your 401k, who would that reallocation make the most sense for in terms of distance and time till retirement? And what kind of repositioning are you advising right now in terms of sector or style?
Yeah, I'll go with the retirement one here first, which is often what we talk about. If you look at what we say is sequence of returns risk, which has obviously been talked about on here before, is that 5 years right before retirement and the first 5 years in retirement, if you're planning on taking distributions from your 401k to meet your spending needs in retirement, right? That's kind of part of our life, right? We've got to learn how to spend this account down. There's a lot of risk that if there are bad market years, bad return years early in retirement, it can really deplete a portfolio fairly quickly because you're taking withdrawals from a declining account at that point. And there's a lot of risk there. So there's a good argument that probably the most conservative you should ever really be in your life from an investment standpoint is actually those couple years right before retirement and the first couple years in retirement. And then you can actually increase kind of back into some risk a little bit further into retirement. That feels a little counterintuitive because we've kind of been told forever, hey, take your, the old adage of, kind of take your 100 and subtract out your age, and that's your stock to bond portfolio. And I remember there was a bit on TV, somebody said, every time a new James Bond film comes out, buy more bonds. And, but that's actually not necessarily backed by the actual science and methodology. That you probably should take less risk right around retirement. We're going to take those withdrawals early, and you can go back into a little bit more risk once you're through the first couple of years of retirement.
And where do you see cash fitting into a portfolio right now, given the current market backdrop?
So there's two ways to look at cash right now. One is cash brings peace of mind to people. So I often talk about a concept, I say return on sleep. Reality is if you're up every night because all of your money is at risk in the market and you can't sleep, that's not a good investment strategy either, right? We're not investing just for the sake of investing. We're investing to get some outcome, some peace of mind, some enjoyment in life. Now, the flip side is there's a little bit of risk with cash right now in this sense, is that I don't see inflation slowing down a whole lot. I know we're talking talking in the segment right before this, is talking about the incursion and invasion going on right now. And, it actually kind of breaks my heart. It's a tough thing not to just have that human element, but that's going to cause some kind of fear in people and uncertainty. And so you might want to hold cash. You might want to say, I want to take some risk off the table and hold cash. But if we have inflation at the numbers that we've had before and you're holding cash, well, you're in essence like locking in a loss of your purchasing power each and every month. So I do kind of caution people, don't overhold cash. It doesn't mean you can't have cash and cash style equivalents. Maybe you're a little bit more in cash right now to just be able to sleep better at night, but kind of going too heavy in cash, we are creating some additional risk there with inflation. If we see more supply chain disruptions, more cost associated with gas and oil, right? Inflation might actually go up more than we were expecting. So it is something to keep an eye on if you do go heavy into cash right now.
All right, Jamie Hopkins, Carson Group Managing Partner of Wealth Solutions. Thank you for those tips and have a great weekend.
All right, thanks, Emily. Just ahead, increasing funding to make education accessible for all. We'll talk to the chair of President Biden's Board of Advisors on Historically Black Colleges and Universities next.
Welcome back to Yahoo Finance Live, everyone. The president's budget for fiscal year 2022 requested a total of $1.06 billion for HBCU specific funding in Higher Education Act, the HEA. $239 million more than last year's level. Joining us now is Dr. Tony Allen, who is the president of Delaware State University and chair of President Biden's Board of Advisors on HBCUs. Dr. Allen, thanks so much for joining us here first and foremost. Perhaps we can start with how the university would be able to access and activate these funds upon approval of the budget.
Well, thank you for having me. It has been quite an experience with the Biden administration with respect to HBCU funding and support. They've already allocated historical levels of support. I think that comes down to how folks really believe that HBCUs are the single greatest driver to the middle class for so many African American communities. And that's been that way throughout our existence. Relative to the funding that we have received and the proposed funding in the budget, we expect it to really build on some of the work that we have already started right through COVID. Some of that looks like ongoing support for more scholarship opportunities for our students, many of which are first generation college students, and some of which are low resource students. The other piece, when you think about the infrastructure needs of our HBCUs, we already know that we provide an excellent quality education for all, but we want our living and learning spaces to match that quality as well, and need federal government support to do that. And then there is this piece around our comprehensive research effort. You will find many HBCUs are doing cutting edge research across a range of disciplines. We want to make sure that we're getting our fair share of those research dollars as well.
Absolutely. How have you seen the network of corporations and partners grow as they begin to modernize their workplace diversity, equity, and inclusion standards and targets?
You know what? What I think was a moment in the spring of 2020, particularly as it relates to the murder of George Floyd and Breonna Taylor and so many others, I'm hoping will become a movement across many sectors, particularly the private sector. We have seen significant levels of investment there, but we don't want it to be one and done. And I'm sitting here today in a building donating to us by Capital One. It's a $4.7 million building that is 35,000 square feet, 6 floors, right in the heart of the city of Wilmington. And it gives us an opportunity to bring our intellectual capital and our access for all students right to the heart of Delaware's only metropolitan city. That partnership between Delaware State University and Capital One really will build capacity and set the example for many other companies, that it's not just about the donation, but the programming that happens inside that partnership. And we have a unique one with Cap One. We've seen those partnerships come to bear, particularly over the last couple of years throughout the private sector, and we're hoping more to come.
Certainly. I know that area well in downtown Wilmington. A lot of the big banks stationed there and have gotten some of those regional corporate offices, even interned at one of them years and years ago. But when you think about how you're skilling the workforce, the future of the workforce, the hybrid workforce, number one, is clearly here to stay in some respects. And job roles, they are changing dramatically. So where have been the largest material changes to even the curriculum in prepping students for the future of work and the workplace?
Well, you know, at Delaware State University, and I'd say at many other HBCUs across the country, there are two things that folks should know. We believe we return the highest return on investment in higher education. One of the things that makes that possible is making sure that we are on the cutting edge of providing the kind of pedagogy, curriculum, and instruction that is really preparing folks for the world that they will face. I can tell you in our own circumstances, again, back to the Capital One partnership, one of the things we want to do is bring our corporate partners in earlier. So many of our corporate partners come to Delaware State University and other HBCUs in their junior and senior year, looking for the cream of the crop, obviously. But we actually want them to start right at the beginning of a first year student's college matriculation. Why? Because it gives them an opportunity to ask the tough questions, to actually interact with folks in many cases that look like them, to make some mistakes without penalty. All of that as they begin their professional journey before they're ever in an internship or in a job, and being able to really round out the full skill set that we think is going to make them attractive in the future.
Certainly. Lastly, just while we have you here, Dr. Allen, would love to get your reaction to President Biden's nomination of Judge Ketanji Brown Jackson to the Supreme Court, with the historical significance, of course, being the first Black woman to serve on the Supreme Court, if confirmed. Representation that could inspire a new wave of multicultural law professionals. How are HBCUs preparing for the potential inflow and also climbing the law school rankings as well?
Representation matters, and I can tell you that the presidential nominee, Judge Brown Jackson, is a fantastic choice in my view. Her parents were HBCU graduates, so she is steeped in the HBCU tradition. She knows what that means. I'm sure that those parents entered the American middle class because of what happened to them at HBCUs. So I'll say that first. Secondly, we all already know that 80% of all Black judges and about 50% of all Black lawyers started their college experience at HBCUs. So the notion that we are already a big part of the legal community relative to preparing the next generation of legal professionals is one that we have been carrying for some time now. We expect that these symbols, like we saw with President Obama, like we see with Vice President Kamala Harris, and I might even say what we are seeing from the actions of President Biden, will have their effects on the next generation of aspiring legal professionals, public servants, and the like. At Delaware State, we say enter to learn, go forth to serve. And this is exactly an example of that.
Dr. Tony Allen, Delaware State University president and chair of the President's Board of Advisors on HBCUs. Such a great pleasure to have this conversation with you. Would love to keep the conversation going in the near future, too.
Take good care.
Take care.
Shares of Etsy jumped 16% today after the company posted better than expected quarterly results. We'll bring you a chat with Etsy CEO Josh Silverman on the other side of this break. Shares of Etsy soared today after the company reported Q4 results that beat on both the top and bottom lines, with revenue coming in at more than $717 million versus the $685 million expected. CEO Josh Silverman says Etsy was fueled during the pandemic by stay-at-home buying and now says a post-pandemic boom is propelling further growth. Here's what he had to say on Yahoo Finance this morning.
Our largest category has been home furnishings. And you won't be surprised to hear that home furnishings is about flat year over year. People have spent the last 2 years sprucing up their home, and with interest rates rising, probably people will be buying fewer new homes or moving into new homes for the moment. But weddings are up in the mid 20% year over year, and I think people are excited to get out of their house and start gathering again. And so the ability to participate in many different categories, we think is a real strength of the vibrancy and the size of our market.
Yeah, that's definitely interesting about weddings. And it is interesting how the product flow kind of mimics what's going on in the outside world, obviously. Something else I wanted to ask you about is you guys, like many other companies, are raising prices. In your case, specifically, it's the base transaction fee, which is going to 6.5% from 5%. What was interesting to me, Josh, is you didn't talk so much about inflation pushing that change. It's that you guys are reinvesting in the business. So talk to me about how you made that decision and where that money is going.
Yeah, we always think about our fees in terms of a fair exchange of value and making sure that we are the best value for our sellers. And we think that 6.5% as a commission is fair. Etsy now has 90 million active buyers, and sales per seller grew by 23% last year alone. The number of sellers on our platform has more than doubled since the start of the pandemic. Last time we raised fees in 2018, Etsy was spending about $70 million a year on advertising. Last year, we spent $500 million a year on advertising. And so what our sellers are asking us to invest in is marketing, service, and product. So we're going to spend more than $600 million this year on marketing. We're investing significantly in service to make buyers and sellers able to work within our platform in a really worry-free way. We spent more than $100 million on service last year, and doing things like having live phone support and chat support for buyers and sellers, and also making sure we're really enforcing our policies around things like the handmade policies, so we have a level playing field for all of our sellers and deliver on our brand promise for buyers. And on the product side, investing to make sure that search and discovery is really world-class, that things like reliability of the platform work. We mentioned in this earnings call that the work we did on product just last year, added over $1 billion of incremental sales for our sellers through the efforts of our product and engineering team. So those are the examples of where we plan to reinvest in our sellers.
Josh, you shared a stat on the call last night that took me by surprise. You noted consumers that identify as male, 50% of them have never heard of Etsy. Why is that the case, and what are you doing on the platform to get their business?
It's a great point. I'm really glad you raised it. We have always been a female-led company. Over 80% of our sellers identify as women. About 80% of our buyers identify as women. And as we looked at our opportunities going forward, we realized we've never really tried to speak to men. And there's tremendous amounts of merchandise on our platform that are great for men. And so we're now starting to merchandise more directly to men. We're starting to advertise in channels where men are a bigger part of the viewership. So for example, you're starting to see Etsy advertisements in the NFL. And we're seeing great response from men. So we think it points to there's still a tremendous opportunity, and it's early days for Etsy overall.
Welcome back to Yahoo Finance, everyone. We have been tracking a very volatile week this week, but now we want to put on your radar what to watch next week. And Emily, jobs, the employment situation, certainly going to be on the forefront of the minds of investors. They're going to have to wait a little bit until Friday, at least, though, next week.
Right, absolutely, Brad. Of course, the Russia-Ukraine crisis has taken a lot of attention this week, but we do still have some key economic data coming out in the next 7 days. This is going to be the last monthly employment report that the Federal Reserve will see before its mid-March monetary policy setting meeting. So definitely going to take on added significance there. In terms of what consensus economists are looking for from the February jobs report, looking for about 400,000 non-farm payrolls to come back. That would come following 467,000 that we saw added back in January. And the unemployment rate is expected to improve to 3.9% from the 4% that we saw last month. So again, in terms of that non-farm payrolls number, we did see in the weekly jobless claims report that happened in mid-February, which is the survey week for the monthly jobs report, a little bit of softening on that front. So that certainly did inform, again, that estimate there. But 400,000, still a solid number if that is ultimately what we get from that payrolls report.
And something else that I'm watching, I'm going to be keeping an eye on what happens with Kohl's earnings after shutting down a hostile takeover attempt. Obviously, it's been a tough time for retailers as they've gone through COVID and as they start to see these sort of buds of recovery as consumers are now deciding to spend more. We're seeing that pent-up demand still out there in the market. It'll be interesting to see what happens with Kohl's earnings. It isn't faring as well as some of its competitors, like a Macy's. So we'll have to see what happens and how much that takeover attempt is going to weigh on the outlook as well.
Yeah, and certainly going to be keeping an eye on a lot of those retail names that were just up on the screen there a moment ago as well, and how they're reacting. Considering some of the economic data that we're going to get and even more of the earnings data, as you mentioned as well, Rochelle, we're going to be watching the broader averages too, because this week certainly was volatile on the front half. On the back half, you saw a lot of entering, buying on the dip, perhaps some of that short covering as well. And much of this still with two major components in play, one of them being the international conflict and hoping that there is some resolution there, and we'll continue to monitor that, of course, over the weekend and have updates as we kick off our coverage next week. But then additionally, what the Fed is signaling, and that is going to continue to be on the top of the minds of investors. And so we'll see what more we get. We're actually going to get some commentary from the Fed next week, one of the members of the FOMC committee. So we'll continue to watch to see what type of signaling they do and how hawkish it is going into their next meeting. But that's it for our show today, everyone. Thank you so much for joining us throughout our coverage this week. Yahoo Finance Live kicks back off 9 a.m. Eastern on Monday. Have a great night and an even better weekend. See ya.